The market soared after President Trump paused tariffs on most U.S. trading partners. The world's wealthiest, adding a combined $304 billion to their net worth, the biggest one-day gain ever for the Bloomberg Billionaires Index. That beat the previous record of $233 billion set back in March of 2022, when Fed Chair Jay Powell hiked rates for the first time in years, while also reassuring investors the U.S. economy was resilient. Elon Musk seeing the largest individual gain yesterday, adding $36 billion to his fortune as Tesla stock jumped more than 20%. He was followed by Meta CEO Mark Zuckerberg, who gained almost $26 billion. NVIDIA CEO Jensen Huang seeing his wealth rise more than $15 billion as the chipmaker's shares rebounded 19% yesterday. That rally yesterday also benefiting the fortunes of other wealthy investors, but with volatility still swirling, they're making some strategic moves in how they're allocating their money. Joining me now is Barbara Goodstein, managing partner at R360, a premier invite-only peer community for the ultra high net worth individuals and their families. Good morning. Thanks for being here.
Good morning.
All right, so I'm going to ask you, did the wealthy people at R360, did they buy yesterday or were they still worried about volatility?
Well, every crisis presents opportunity, and we've been talking about what are the opportunities and where should we be looking. And we have had a parade of investment specialists and economists talking to us, as well as bankers presenting distressed asset opportunities. So some people are buying, other people are still in the wait-and-see mode.
All right, so wait-and-see mode. I want to get your take on a post from the president yesterday. It was just after the opening bell yesterday.
God.
He posted, it was pretty short. This is a great time to buy. Is this something that you and your
got a
members
problem
talk
with that?
about? What's your take?
So we do think there are opportunities to buy, but just like Warren Buffett, we're also willing to be steady. We're sitting on a lot of cash. Warren Buffett's sitting on $344 billion. We're sitting on a good amount of cash, looking for the right opportunities. We're not jumping into things quickly. We want to find the right opportunities and go forward.
Are your members, are they encouraged about that signaling, or do they have any specific thoughts about the president posting something like that?
Well, I think that we're trying to analyze what the president's doing, which is why we're bringing in this rotation of all the top banks and bankers and investment managers. And when you're in a community like this, you have the benefit of all of these great minds. So everybody's trying to sort of figure out where things are going. He's playing 3D chess, and we're all trying to anticipate what's going to come next.
So right now you're kind of listening and learning.
Yes.
Now, I thought this was fascinating. You said that most of your members only have about 16% of their assets in the stock market, and most of them are holding about 10 to 12% in cash.
They're
So
fools.
what now?
Well, now there are lots of opportunities in private credit markets. There's opportunities to buy in defense. We're spread across different sectors and across different regions, so we're looking at making different moves in both those areas. Private credit, as I said, has huge upside opportunities. We're looking at hedge funds again. Gold is popular. And then, of course, there's Bitcoin, which has been a popular favorite with our members.
You said that before. So we've seen a lot of volatility in Bitcoin. In all fairness, a lot of volatility in the equity markets. But it seems like Bitcoin kind of moves with big cap tech or the triple Qs. Is that still seen as an alternative to the stock market when it kind of moves in a similar direction? It's more volatile, but still moves directionally the same.
So actually, Bitcoin is not really correlated to the stock market. It seems like it is over a few days and a few weeks, but if you look at it quarter by quarter, it's not correlated. In fact, it's a good hedge against the stock market. Bitcoin is like digital gold. So basically, we're advising people that everybody should have some Bitcoin, and Bitcoin at 82,000 is a buy. Bitcoin's a good opportunity now.
What about bonds? Bonds have become such a big part of the market narrative, and it seems like even part of trade policy after yesterday, according to reports. How are your members, how are they viewing the bond market right now? Is it attractive right now? Are they thinking that Fed cuts coming up? How are they seeing things?
So we think that the Fed cut probably will come up, but again, we're consulting some of the best advisors in this space because nobody knows. It looks like that's what Trump is trying to create. He's resetting the global landscape. He's resetting the domestic landscape, so we're all waiting to see what happens.
All right, Barbara Goodstein, it's always great to hear from you and your members from R360. Have a great day.
Thank you.
All right, coming up here on Worldwide Exchange, we got a lot more. Futures are pointing to sharp losses at the open, while my next guest says now may be the time to get more exposure to big tech. And if you haven't already, you should follow our podcast. If you miss Worldwide Exchange, check us out on Apple, Spotify, or other apps. We'll be right back.
Jim.
And welcome back to Worldwide Exchange. We close in on the 6 a.m. hour. Check on a few big stories that we're following this morning and give you a little tip. It's all about China. Top leaders in Beijing reportedly meeting today to discuss additional economic stimulus in the face of Trump's new 125% tariffs. China's own tariffs on U.S. goods also going into effect today. We're hearing from Bill Ackman and Ray Dalio on the China issue. Ackman says time is not on China's side. Dalio says he hopes China will negotiate in good faith and Trump will cut a deal. And Goldman Sachs revising its GDP growth outlook for China in light of the tariff picture. 2025 now pegged at 4% revised to the downside from 4.5%, 2026 falling to 3.5%. All right, turning back to the U.S. markets, giving back some gains following yesterday's massive rally. Taking a look, futures in the red across the board right now. The Dow looks like it would open up 500 points lower. We also take a look at small caps, getting the worst of it after it's their best day since 2020. Small cap futures pulling back just about 2.5% right now. Let's bring in Nimrit Kang, CIO and Senior Portfolio Manager at North Star Asset Management. Nimrit, good morning. Good to see you.
Good morning, Frank.
All right, let's start off. After a historic rally on Wall Street yesterday, what is your word of the day today?
My word of the day, week, and month, and the year is fortitude, because that's what we need to navigate this headline-driven market.
Okay, well, easy answer right there. So it sounds like you got a lot of fortitude. I want to ask you about your pick for us today. Your pick for us today is Microsoft. We just had Dan Ives, noted bull when it comes to tech. He actually reduced his price target on Microsoft from 550 down to 475 and said tech spending in general is going to be reduced anywhere from 10 to 15%. Are you keeping your fortitude on Microsoft and some of the risk in that name?
We definitely are, and we would take a measured approach, so it's not an all-in kind of an approach. We take a dollar cost averaging approach to building positions, but Microsoft
She's
is
very
one where
professional.
we have a long-term conviction in the fundamentals. We think AI is here to stay. Microsoft is one of those companies that benefits both on the revenue side, being able to monetize AI to generate more revenue, but also cost reductions because of their huge distribution on cloud and Microsoft 365. Now, what has changed, Frank, is that the stock from its highs in July of 2024 has derated almost 30%, from a PE of 35 to about 27, 28. Can it go lower? Of course it can. And we're not going to know for sure, but that's where we would leg into the position. You know, if you've been sitting on the sidelines, this is where we have a long-term conviction.
All right, you have a lot of long-term conviction there. I want to tell you about an economic report coming up later today. This used to be the biggest thing in the world. It doesn't seem like it has the same weight, at least not this morning. We have CPI coming up later today. Estimates have it declining. How important is the CPI picture, the inflation picture, when you're looking at your portfolio?
The trend is towards higher inflation expectations, right? So, you know, the Michigan consumer inflation expectations came up where forward inflation expectations are around 5% for consumers. That's at a high level. But again, you know, a lot of that is not related to monetary policy. It's one of those tariff shocks. We don't really know how it shows up until it shows up. And that's why there's a lot of wait and see. And it's difficult to anticipate the reaction to what the CPI is going to be ahead of that, only to risk getting whipsawed.
So you're still seeing some risk of getting whipsawed right now. One area we've seen a lot of movement in, I don't know if it's quite whipsaw, but the bond market. Just very quickly, what's your take on the bond market? Is it attractive, short end, long end?
The long end, our general approach is anywhere when you see 10-year going above 4.5%, it's a good indicator of forward 5-year returns. So a 10-year long end to us, especially, well, we would say intermediate term, you know, anywhere from 5 to 10 years, we feel comfortable there. If we think 4.5% 10-year is a normalized range for the 10-year, which we think it is, then on that metric, the lower end is definitely, needs to come down.
Nimrit Kang, your pick for us today, Microsoft. Great to see you. Thank you very much.
Thank you.
All right, we've got a market flash for you right now on autos. Goldman Sachs and UBS cutting their price target on Tesla this morning. UBS also downgrading General Motors. Goldman downgrading Ford. Take a look at those shares this morning. You can see they're in the red across the board. All of them down more than 3%. We want to take one last quick look at futures this morning. Futures in the red across the board as well. Looks like the Dow would open almost 600 points lower. The S&P and the NASDAQ, again, also deep in the red. That does it for Worldwide Exchange. Squawk Box starts right now.
Good morning. Our 500-point Dow swing du jour is lower this morning. Some fairly significant losses, but obviously pale in comparison to what happened yesterday. It's been, was it last Wednesday? Was that Liberation Day? So today's is Thursday. So we've been in this world for just over a week. Countries are going to face, after yesterday, a 10% levy for the next 90 days while the White House attempts to strike deals with dozens of different countries, except for China, which is now facing a 125% tariff rate. China. We're going to hear about tariffs, the consumer, and much more in an exclusive interview with Amazon CEO Andy Jassy. Stay tuned for that. It's Thursday, April 10th. Let's see, 10 minus 2, that's 8 days. 8 days in this new world. Squawk Box begins right now.
Good morning, everybody. Welcome to Squawk Box right here on CNBC. We're live from the NASDAQ market site in Times Square. I'm Becky Quick along with Joe Kernan and Andrew Ross Sorkin. And as Joe mentioned, our 500-point swing of the day, the swing du jour, is now a 600-plus swing of the day. It's down by about 615 points for the Dow futures this morning. S&P futures are off by 100. The NASDAQ futures down by about 415. Of course, we're coming off a historic day in the markets. President Trump's tariff pause on countries around the world, except for China, sparking a massive afternoon market rally. Man, you had to be watching closely and watching every minute of the day yesterday. The S&P actually gained 9.5%. It was its best day since 2008. FactSet said that it was the S&P's third biggest daily gain since World War II. The NASDAQ was up by more than 12%. That was its best day since 2001 and its second best day ever. And the Dow was up by more than 7.8%. That was just shy of 3,000 points, and it was the Dow's biggest point gain ever. You watch this Fast and Furious, and wow, talk about the old adage that you have to be in the market because those big days that you miss will be the days that set back your
or just be careful if you're short. I mean, if you were short with this.
And that would be wrecking. So we've watched this volatility continue. Again, we're down today. Still a lot of questions about what this means.
Yeah, and hopefully you didn't sell. And we made the point. We keep talking about trillions, 5 trillion loss. Those paper losses, unless you sold, you weren't locking in.
Locked it in.
Those. And some people probably did sell, which is probably unfortunate.
Well, somebody did. There was a lot. The volume was the highest we've seen in more than 8 years. So a lot of people were selling.
People that were yippee, as
the president said.
The president said, might have been, unfortunately, people. There might have been people who were close to retirement and didn't feel comfortable staying in the markets, and that's not good.
If you had sold though last week, you would still be ahead of the game. I'm not saying that if you're trading this, you would still be ahead of the game if you had gotten out before the tariffs. Right. And then given where we are this morning, and where this may all go over the next period of time, I think it's hard to suggest that somehow it's going to be better before Liberation Day in the stock market than after Liberation Day.
We're nowhere near back.
Figure out what the situation is. These are still significant tariffs.
We got
across the board, and you have a lot of trading partners that you're going to have to try and set agreements with.
We got faked out on Monday and Tuesday because everybody in the world knew the tariffs were coming, and I think Monday last week. And Monday was a big day up, and then all of a sudden it came on Wednesday, and everything. Absolutely hit the fan over the next 3, 4, 5 days. I mean, it moves of 2,500 in the Dow. So that, I don't know I don't know if people really sold before it happened. I don't know how many people sold afterwards. All you had was a week to do all
but you had massive volatility, and you had incredibly high volume. So a lot of people sold.
For every person selling or someone buying, I guess.
Right. It's just. Depending on who you are, as you mentioned, if you're somebody who's near retirement, you panicked and you pulled out of this, then this is nothing to laugh about at all. This is and nothing to think that it's an all clear, all calm. If you're looking at the Treasury market today, that was really the 800-pound gorilla that was pushing a lot of the decisions behind the scenes. The 10-year Treasury this morning is sitting at 428. The yields had skyrocketed, and that created a lot of concern. The 2-year right now is at 385. We have seen the spread narrow.
The high yield spread, I guess, got people spooked too. But the 10-year all it did was go back to where it was before the flight to quality after the tariffs were announced.
But the moves intraday moves that you were saying of 35
Right.
plus basis points. I mean, that is.
I told you what happened during the credit. I had someone long bonds, and it was 300 basis point move that day, three full points or 2.5 points. Trump knew we got a market. President knew we got a market. A trial balloon. What was that, Monday or Tuesday? Where Hassett looked like he had, and he's going to be on today. But it looked like he was. Some people took it on social media that he did announce a pub. Remember, the market turned around and went up. So they knew that this would be. They had an idea of what was going to happen.
Interesting tweet before. Stay cool.
Good time to buy.
Good time to buy. If you look right now in Europe, markets are up there. The DAX up by the most, 5.25%. The CAC's up by almost 5%. Actually, I take it back. Italy's up the most. It's up by more than 6%. FTSE is up by 4%. And then Japan's Nikkei jumping by more than 9% in the trade there today. South Korea also up significantly, 6.6%. Japan and South Korea are among the first of the countries that are expected to be negotiating with the Trump administration. But again, this is far from settled. There's a lot to work through on this. And these tariffs are still considerably higher than we were just a week ago. And we'll see what that means for all of this. Andrew, I think that somebody was making the point today that USMCA, NAFTA 2.0, that took 2 years to negotiate. My guess is they're not going to have fully negotiated deals on this, but starting a dialogue may be the thing that is enough to kind of set in motion and see where we get to with the different.
Well,
Yeah, that'd be 150 years.
You may disagree with me.
75.
I imagine this is going to go on for a very long time, possibly longer than 90 days. I think the only thing that's really happened here is there's a little bit of a floor, or at least a put, that we all will now acknowledge that maybe the president is not going to be willing to go, quote unquote, all the way if he sees the bond market moving in the wrong direction, or if he thinks that there's going to be, these issues about rare earth minerals. I kept hearing overnight from a number of CEOs that was something they were concerned about. So I think there's a whole bunch of things that were happening where he, I think, recognized that he might put us on the losing end of this.
Well, and losses on Wall Street that translate
back
into losses on Main Street. The idea that you had a president who was elected to try and bring inflation down. If you're bringing prices up and then borrowing costs up for the average American too, that's not a good situation.
It's a false dichotomy, Wall Street.
But it puts him. The truth is, it puts him in a terrible negotiating perspective point. That is the truth, because I think the rest of the world literally does think he blinked. So when it comes to actually getting what he wants, the question is how far he's going to be able to push things in truth. It also is going to raise
90 days, he
all
could put
sorts
them
of
right
questions.
back on. I disagree with that. In 90 days, he could put them right back on.
We'll see about that, because if the bond market starts to move the other direction again, and if Elon Musk starts to get concerned that we're not going to have access to rare earth minerals and all of the other things that played out over the last 72 hours, I think changes the dynamic in terms of how much he's able to push. The other piece of this, though, which nobody's talking about uncertainty, is all of a sudden the budget conversation is going to almost invariably have to get pushed out, because part of the, Mike Johnson came on our air and said, oh, we're going to have taxes and the budget and everything squared away in May. That's 20 days from now, right? That now almost can't even be conceived of, because part of the whole rationale of putting the tariffs on beyond everything else is that they were hoping to be able to use some of that money that they think that they would have raised from it, whatever those numbers were, and build them in to the ability to therefore take down, tips on taxes on tips and all sorts of other things. So
Ackman has entirely 180 degrees from your take, Andrew. By doing it Trump's way,
understand that.
The entire world and their citizens got to experience the visceral impact of what massive tariffs would do. It wasn't, Ackman said he would have done the pause first and then do it, but now he sees a method to the madness, and that everybody experienced what it would be like, and that's what you're looking at in 90 days.
You see what Cliff Asness?
Yeah, so I have no gimp. I had to figure that out. I didn't understand it. I didn't understand it originally in Pulp Fiction. I didn't understand what was that thing that came out. And I guess it's a BDSM. That's what you call someone in that suit. Is a gimp, but they brought out the gimp. Zed's
I
dead.
don't think it was a compliment.
Zed's dead.
I don't know if I'm on the other side of Bill Ackman or not on this. I didn't see exactly what he
Well,
said. All I'm suggesting to
He
you
just
is
said that was the
I
right
think
way to
that
do it
you're gonna
because
have
people
uncertainty.
now,
You're gonna
people
have
now experience what it would be like, and now they were, shaken to the core. Now they're going to want to negotiate even more. So I don't know how you come down with now they don't want to negotiate and they're emboldened.
Because all of a sudden you have two things going on, Joe. You have all these countries now have 90 days, not just to make a deal with the U.S., but to make a deal with each other. That's what's happening. So the calls that I was making last night, these countries are now going to band together against us. And now they have time to do it.
Yeah, he is, and I think
you
that's,
you
they can
also
band
have
with each other all they want. It's still going to add up to the United States. You can't. We're most of the world's consumption, and it's always been that way. And you're going to see with China, if you don't play ball, we'll see. I'm more interested in how it all plays out with China at this point because.
And by the way, that's not going away either. So the world has not actually changed that much this morning relative today, with the exception of the fact that I think the market now understands that Trump can blink. That's what
I think
the
if we
lesson
can
of
do
all this
this,
is.
I think the end result is if we can do this with allies, that puts us in a much better position. I don't know why we rankled our allies to begin with. Never thought that was a great position to be in. If you can move forward with allies, I think that allays some uncertainty. But again, we have to see how this plays out over the next 90 days.
Right,
depending
but I don't
depending
think
on how you
Canada
view the world,
I don't think
depending on
Canada
how you
sits around
view
and
the
says,
world,
I
the
want to go
prism
make it.
you look through, the prism you look through. With your prism, we know how your prism works, and it's either he blinked and folded, and he got hit in the head. Leisman, I think, said he saw, he saw something coming at him and had to duck. The other side is, and you're hearing it from all of his acolytes, and we're going to hear it from Hassett today, it was all in the plan, all part of the plan, and it was the art of the deal. I think it's somewhere between art of the deal, somewhere between it's working, somewhere between art of the deal, and you
working how?
It's working how? Did you? When the market went down 300 points, I thought when the market went down 300 points, it went 300 points. You were ready to jump. Goes up 3,000 and nothing's changed. And how did it work and everything? But that's your prism,
right.
Which is fine. But it's somewhere between art of the deal and you hit your head against the wall so hard it feels so good when you stop. I think it's somewhere in between there, and that's what we all did for 8 days, and that's what he did for 8 days. But it finally was driven home. But if you get, why 75 countries wanting to negotiate? Why is that not a good thing, Andrew?
Why do you believe that, and why do you believe that over the next 90 days none of those countries are going to try to team up? Are going to try to team up with each other? What? Who said it? Because the president said it? Did you hear from the other countries?
Because the Treasury Secretary said it.
Okay. I mean.
Okay, they're all liars, and none of these countries are actually calling. None of them actually want to try to change their ways.
Oh, I'm sure they're calling. I'm just suggesting to you that if you think that the folks in Canada who don't want to be the 51st state of America to begin with are desperately trying to make a deal with the U.S. I don't think they wanted this deadline to happen, but now that they may have 90 days, do you not think that they're going to call Mexico? Do you not think they're going to call the EU? Do you not think that they're going to spend the next however much time they can to try to actually band together themselves? Come on, that's what you would have to do if you were even trying to negotiate.
I think we'll watch with China whether they learn the lesson of not getting first in the queue.
The one thing I will say is I went back and looked at an interview that we had done with Warren Buffett, Charlie Munger, and Bill Gates 6 years ago. The last time we were going through these negotiations with China, we happened to have them live on the air as it was happening, and they all acknowledged that it would be good to get more out of China. That there's nothing that says we have to stay with a situation that is not a great situation. But they also, one of the things that Warren Buffett said at the time was, if you're in a negotiation, you want to make the other guy feel good while still getting everything you want in that negotiation. And that's an interesting reminder of. It'd be nice to maybe have people feel a little better about some of the negotiating.
Andrew,
at least for our allies, less so with China.
Did you not want Trump to make that move yet? So when he was not relenting and just sticking to it,
Right.
you had so many complaints and so much TDS, and now he doesn't,
no,
and
I think
you've even stepped it up from there. So it's crazy. I don't know.
No,
damned
this
if
is
you do
better.
and damned if you don't.
No, this is better. Well, yes, to me, there are very few good outcomes from all of this, at least the way it was approached from the beginning. So this is a marginally better way out than where we started the ball game.
Okay, that's about
There's
as good
no
as we're going to
question
get
about
from
that.
you. It's more,
So-
okay, that's as good as it's going to get. All right.
But the truth is, as we
The
said
movie.
from the get-go, you were always going to have these negotiations, and they were always going to play out, and the uncertainty that that was going to create, whether it was going to be done, I mean, over 90 days. Before, I think we thought it would still maybe take 90 days. It would just be maybe more painful because he was going to try to keep them on during that period.
Well, he was going to do it because that's what he ran
his
on.
own negotiating leverage. We'll see.
This was coming, whether it's a good thing or not, to try and get a more level playing field with bad actors in global trade. That's what he was elected to do. So if you wanted him to do nothing and just have the status quo, that did not happen. You're right. So in terms of knowing he was going to do this and try to extract some deals in terms of tariffs and protectionism and what happens with India and what happens there, you knew that was coming.
I don't want to speak for all voters, but I think that that most voters, if you look at the polls of those people who voted for President Trump, they voted on issues of immigration, they voted on issues about wokeism, they voted on issues about the economy, and to the extent that they voted on the issues about tariffs, it was mostly focused on national security around China.
Been saying it for 40
That's
years.
what they voted on.
He's been saying it for 40 years. It didn't prevent them from voting for him, knowing that he was going to take a very...
This extremely in the last. This is a very.
No, but he did it,
this
and
is
he
a
put it
different
on, and
take
Biden left him on.
4 years ago. No, but doing it to everybody is very different than what he had done in the first Trump administration, and that may have caught a lot of people off guard.
But shouldn't have surprised anyone that it was happening, and we'll see what the ultimate outcome is. But,
I think when you look at the border, you look at taxes, you look at inflation. Those were probably the top three things that people were focused on.
I think the hollowed out middle class and in America first. I mean, if Make America Great Again was talking about getting a more fair playing field for.
There's a million things you can look at that they were talking about. Make America healthy again.
You don't think that
Joe,
you
may be right that people
lunch scale people were all voting for it, that have been left out of the economic.
Like the Reagan Democrats.
Joe, you may be right that that's what some people wanted.
Why the unions
So now
decide?
you get the UAW cheering for these higher tariffs, and now he's.
Well, to say that we didn't know that tariffs were coming. I mean, that's what he ran on. That was one of the things he ran on.
What do those voters think?
Do you think, Joe?
Do
Do you think that Elon Musk? Do you think that Elon Musk supported him for this reason?
I don't think Elon Musk was.
Straight up.
Elon Musk was part of the negotiate. Elon Musk and Scott Bessent were negotiations on this side. We got Howard Lutnick, and Peter Navarro, Ron Varro, or whatever his name is. We had them on the other side.
Huh?
Right? We had. So we've known all along
and you think
where the
that
two
tariffs across
factions
the board were something that Elon Musk wanted?
They're all on board with something. In fact, you talk to people, Mark Rowan, I mean, you try to talk him out of it, but Mark Rowan said he appreciated trying to take on some of these intractable issues where we've gotten the short end of the stick
I think
for a lot of reasons.
Joe, the thing that's
right,
important,
but not this way at all.
90 days is coming back.
Not this way at all.
Anticipate that, and I wonder.
So now you'd like to do it, but this is just the wrong method or something? How would you have done it?
I think the way Rowan walked it through with us yesterday is the right way to do it. You try to make, to the extent you can, a better deal with Canada and Mexico first. You go from Canada and Mexico to try to get to the EU, our next big ally. You go from them to maybe India, and then maybe go to China. And
so
and
on the
as
edges,
you go, you have more
on the edges, you don't like
leverage
it.
with others.
On the edges, you don't like it, but the basic premise that we need to do something, you do think is true.
I think that you can ask for other things and probably get some things without putting a series of tariffs that are going to effectively create lots of protectionism around the world. Yes, I think that you can make some changes around the edges, which will have a big impact, even if they're marginal. But not the way it's being done thus far.
All right. Well, let me know
It's a longer debate, and we'll get to do it.
Let me know if he does do something. Let me know if he ever does do anything that you approve of. And we'll actually have that in a little banner at the bottom.
When we come back, Amazon out with its annual letter. I'm here in Seattle this morning because we're going to be speaking with Andy Jassy, the CEO of Amazon, one of the most powerful companies in the world. That's going to happen at 8:30 Eastern Time. We're going to bring you details on the letter right after the break. Plus, Wharton School's professor Jeremy Siegel is going to join us in yesterday's market rally and today's futures drop. Stay tuned. Squawk Box coming right back.
roadbeauty.com.
News just out from China. State media reporting that Beijing will moderately lower the number of U.S. films imported to China. And media stocks this morning, I don't know if that's necessarily, Disney I think was
They're
up.
down in a down market. So.
Yeah, and Disney was up 10 points I think yesterday.
Yeah.
Comcast was up quite a bit too.
Yeah.
Right. Okay, I'm live in Seattle this morning because we've got a big interview coming up with the CEO of Amazon. We are here at Amazon.com's headquarters. And new this morning, just publishing their annual letter, Amazon CEO Andy Jassy writing that he feels quite quote, quite optimistic about the progress and potential of our existing businesses. A key theme of the letter this year is Amazon's efforts to operate as, quote, the world's largest startup as it takes on artificial intelligence in the tech race. Jassy writes that, quote, generative AI is going to reinvent virtually every customer experience we know, and says substantial capital investment is going to be required. We're going to talk about that. He writes, quote, the demand is unlike anything we've seen before, and our customers, shareholders, and businesses will be well served by our investing aggressively now. Of course, a whole number of big tech companies investing aggressively in AI, and big questions about how much they're going to continue to spend. Key areas of those investments include custom chips, frontier models, and services. Amazon has also invested $8 billion in Anthropic. That's one of its key partners that makes the large language model. Jassy also writing about the company's culture. An interesting, almost Buffett-like letter in that he talks about this idea of what he calls the whys here at Amazon, and his efforts to flatten the organization by increasing the proportion of individual contributors versus managers, and try to bring people back into the office. He makes a big take on work from home, or work from the office, saying that things are a lot better together whenever possible. Not in the letter, though, any mention of tariffs and of China. Of course, that's probably where we're going to start when we speak with him this morning, and we're going to talk to him all about this, what it means for the company, and so much more, and that's going to happen at 8:30 Eastern Time. Couldn't be happier about the opportunity to speak with the head of Amazon at a time like this, Becky.
It certainly is. It's something to look forward to. Again, that's coming a little later in the program this morning. In the meantime, the futures have improved slightly, but you're still looking at the Dow off by about 450 points. S&P futures down by 84, the NASDAQ down by about 350. It follows yesterday's historic market rally when President Trump dropped worldwide tariff levels to 10%, with the exception of China. The S&P 500 had its third best day since the end of World War II, and the NASDAQ was up by even more. It was a gain of 12% for its second best performance ever. Joining us right now is Jeremy Siegel. He's Professor Emeritus of Finance at University of Pennsylvania's Wharton School of Business. He's also the Chief Economist at Wisdom Tree. And Professor, you say that even though we saw these big moves yesterday, you're not ready to signal the all clear moment just yet.
Yeah, well, Becky, we are much better off than we were at this time yesterday, but are we as good off as we were 3 months ago? I don't think so. Actually, interestingly enough, with the 125% tariff on China, the 10% blanket tariff, the average tariff actually went up yesterday with the raise in China, and JP Morgan calculated at 23%, which right now is higher than the Smoot-Hawley tariff at this moment. So, we're not out of the woods on the tariff. I mean, we'll see what gets negotiated. It definitely, will have to be a negotiation with China. I don't know whether Trump holds as many cards as he thinks he holds on that. But I know that Trump will declare a victory. And by the way, it is good to the extent that he has 75 countries he will be negotiating with. But the shock of what happened, I don't think you can get that out of consumers' mind or investors' mind for quite a while. And so I don't think we can challenge those February highs for quite some time.
And again, that is just a situation of people being burned in the past, thinking like, okay, we got to wait and see how this really falls out.
Yeah, well, but the fact is that you still have a big tariff on you, which is gonna raise some prices. The fact that, oh my God, this volatility, I hadn't seen that. I didn't expect that. Could that happen again? Listen, I've got to be cautious about equities. And by the way, I mean, I don't know if you people listened. Dan Ives was on about a half an hour before Squawk Box, big bull on tech. He said, hey, this isn't over. This shock, the decline in orders, there's still uncertainty. Now, in my opinion, he's not going to put this back. But July 9th is still a date out there. It appears the 10% tariff is permanent. which is still 5 times as what we had, before the Trump presidency. So that's still.
Although isn't that the 10%? Isn't that still a temporary permanent? If you can negotiate better deals and get to a position where you feel like there's less inequity, that tariff would eventually get dropped on a maybe country by country basis too.
Yes, hopefully that will. That is across the board, and we'll see what happens. Listen, even if we negotiated, I mean, if every country said, let's go to free trade, all right, U.S. would still have a trade deficit. I mean, it's part of being a reserve currency. We pump out capital, the world uses it. They use it for transactions. They use it for liquid assets. We had a $900 billion trade deficit. If Trump negotiates and gets $200 or $300 billion back, and all my colleagues said that's crazy. That would be unbelievable. That's less than 1% of GDP at the best possible. Well, the stock market fell 10%. It's still 10 times that amount. $3 trillion, $4 trillion below where it was before all this tariff mess is happening. And by the way, everyone, maybe recession is off the table. I don't think slowdown is off the table. And because these gains are, I don't think anyone is. They're going to take recession off the table. No question now. The Fed is holding. They don't have to worry. They're going to be holding in May and holding until now. Listen, with July 9th out there, they'll probably be holding on the June meeting, which is an important meeting too, because again of that uncertainty. So we're going to have hold. We're not going to have lower interest rates on that. We're not going to have lower interest rates on the refunding of $9 trillion on the debt. I don't want to paint a terrible scenario because I'm so happy, we took off the reciprocal tariffs yesterday. But again, I think it's going to be tough. I know people are talking about new highs now being an easy goal, and I think that the market's going to be treading water for quite a while on stocks and on bonds.
Treading water is better than where we were earlier in the week. We may settle for that for the moment. Professor Siegel, thank you.
Thank you very much.
Some breaking news from Earth right now. The EU has agreed on a 90-day pause in countermeasures that were due to take effect on April 15th. The president of the European Commission said that if negotiations are not satisfactory, those countermeasures will kick back in, and preparatory work for further countermeasures will continue during this pause. Again, though, a little bit of a de-escalation from what we had seen as things were ratcheted down here yesterday as well. The Dow futures improving a little bit on this. The Dow futures are still off pretty substantially, but not the worst levels that we'd seen, down by 376 right now. We were down by 450 just moments ago. The NASDAQ is off by about 310, and the S&P futures down by 73.
And coming up, Elon Musk recouped a little bit of his recent pullback, whatever you want to call it, building a base in his net worth. Obviously, he's a bit richer, but that's an understatement. We'll tell you how much the net worth of the world's richest person shot up yesterday as the markets rallied. Stay tuned. You're watching Squawk Box on CNBC.
Welcome back to Squawk Box this morning. Elon Musk having a pretty good day yesterday when the market surged just yesterday. Shares of Tesla jumping more than 22%, according to Bloomberg's Billionaires Index that helped Musk's net worth rise by close to $36 billion. But a little context to put that in perspective, that was more than the market caps of Electronic Arts, Kraft Heinz, and Lululemon. Still, though, Musk tops the list at a net worth of $326 billion. Of the top 10 people on the list, only Warren Buffett has grown richer this year. He's up by $20 billion. But of course, Elon Musk's wealth was even higher before all of this began. Becky?
All right, when we come back, House Republicans punting on a budget vote. We could see more movement this morning. We've got the details on this and where things stand right after a break. In the meantime, though, take a look at yesterday's S&P 500 winners and losers. Squawk Box will be right back. Good morning, everybody. Welcome back to Squawk Box. We're live from the NASDAQ market site in Times Square. The futures this morning are in the red, but again, it's a pretty volatile morning. We are not near the lowest levels of the morning. We were down by more than 630 points about 40 minutes ago. Right now, the Dow futures are off by just under 350 points. The NASDAQ is indicated off by about 290 points, and the S&P futures down by about 68 after a pretty historic run yesterday.
Yeah, House Republicans punting a budget vote from last night, possibly to this morning. Emily Wilkins joins us now with the latest on the negotiations in D.C. Were there actual whipping sounds that you could hear overnight anywhere, Emily?
I mean, Joe, we've honestly been hearing these noises all week. We knew there were concerns all week. A group of more than a dozen House Republicans have raised concerns, and now they've gone ahead and stalled Trump's agenda over worries that the Senate-backed plan that moved the other week is going to add trillions of dollars to the deficit. And so far, they are resisting pressure from the White House. Trump has been active in pushing them. Other White House advisors have as well, but so far it's a no-go. Speaker Mike Johnson does plan to hold the vote again this morning, and this, remember, is on a measure. It would really set the bar for how much Trump's agenda is going to spend in certain areas like taxes and then cut in others. But there are some deep divides right now between the House and Senate Republicans on these spending cuts, because under the measure, you've got two different instructions. The House would be required to cut at least $1.5 trillion in spending, but the same measure only requires the Senate to find $4 billion in cuts. The leaders say they're going to reconcile the two amounts later, but that's not good enough for some of these lawmakers. They want to see it now. Congressman Lloyd Smucker, he's a Pennsylvania Republican, not one of the usual suspects when there's a rebellion against leadership like this, warned last night that the Senate bill has the potential to add trillions to the debt.
We know the fiscal trajectory that we're on. We know this won't end well if we constrain, if we don't restrain our runaway spending. I think this is our opportunity to do it, and the $4 billion floor in spending savings in that Senate bill just simply are not acceptable.
Senators say they ultimately do want bigger cuts, but setting a low floor now leaves them leeway later on as they figure out the specific policies that are going to go into this bill. Things like Medicaid cuts, lifting the SALT cap, no tax on tips. That's all expected to be tough negotiations. They want to give themselves some wiggle room. Johnson's working with the holdouts and the Senate to see if the two chambers can potentially bridge the gap before lawmakers are scheduled to leave town for 2 weeks. But remember, this was supposed to be the easy part of moving Trump's agenda. It was just the framework. Things are only expected to get more difficult and more contentious as details are added on taxes and other items. Guys?
All right, very good. Thanks, Emily. Later today, more stuff to look forward to. All right, thank you.
The movable feast that is the news cycle these days. When we come back, we're going to talk more about President Trump's tariff negotiations, specifically the growing tensions between America and China. Is there actually room for a deal in the near future?
now.
Welcome back to Squawk Box. We are live in Seattle this morning at Amazon's headquarters, and we have some more news on tariffs that relate to Amazon. Reuters reporting that some Chinese companies that sell on Amazon now preparing to raise prices or leave the U.S. market altogether. An article quoting the head of a Chinese e-commerce association that represents more than 3,000 Amazon sellers is saying that businesses' entire cost structures are now at risk of being overrun. We're going to get to talk about all of this and so much more at 8:30 Eastern Time. We've got a big exclusive interview this morning with Amazon CEO Andy Jassy, Joe.
And coming up, much more about the China angle. We're going to talk about what a potential tariff deal with that country would actually look like. Stay tuned. You're watching Squawk Box on CNBC.
Go with timber tech.
We have a big job to do. No other president would have done what I did. No other president. I know the presidents, they wouldn't have done it. And it had to be done. What was happening to us on trade, not only with, if you look at it, not only with China, but China was by far the biggest abuser in history, and others also, but somebody had to do it. They had to stop because it was not sustainable.
That was President Trump yesterday explaining his move to hike tariffs on China now to 125%. That's in response to China boosting levies on American goods to 84% in retaliation to Trump's earlier plan to raise tariffs on China itself. Joining us now on tariffs, the tension between the U.S. and China, retired Air Force Brigadier General Robert Spalding is a veteran of 3 administrations in roles at the Pentagon and the National Security Council. He's now the CEO of tech security firm Sempri. Good morning to you. Help us understand where you think this all goes. We have a 90-day reprieve for tariffs on a lot of the other countries, or at least some of the elevated tariffs. China, obviously, those tariffs staying exactly where they are. Does this put us in a better negotiating position now? Where does this go from here?
Well, I don't think the Chinese are going to negotiate. They, they see this pressure. They're going to fight it. And I think that what we have to prepare ourselves, and particularly the companies that source their goods or subcomponents from China, are going to have to figure out alternatives, because this is just going to increase. And I think it's going to force an actual decoupling that we've been talking about for several years now.
When you game this out, though, one of the question marks is, do you imagine that the U.S. is going to take this 90-day period to try to make deals either bilaterally or collectively with places like Canada and Mexico and the EU and India and other places, and therefore will have more leverage ultimately over China? Or do you think that China is going to take this time to start making its own deals with some of these other countries?
I do. I think the administration is going to take advantage of this to negotiate. Of course, they have to look at the non-tariff barriers in addition to the tariff barriers. And of course, China is going to try to use it. But really, I think what they're going to try to do is use these other countries as places to transship goods to get around tariffs like they've done before. So I don't think they're going to change their behavior. They're going to change their tactics in terms of how they try to get around the tariffs. But I think they realize that the decoupling is going to happen. Back in the first Trump administration, they began that when they tore up, if you remember, the trade agreement between Lighthizer and Liu He. And so I think this is something they've been expecting to happen. The thing that I would be concerned about now is how does it affect Taiwan, and therefore the chips and the other subcomponents, particularly microelectronics that come from that part of the world.
What does a quote-unquote win look like for President Trump in this context? Meaning, what do you think that Trump needs to get where he can declare a win, and potentially so that President Xi can declare a win or save face in some way? And let me throw into the mix, to make it even more complicated, the chess piece that is TikTok, and how you think that may play in all of this.
Well, I think TikTok's more of a sideline. I think a win for the president is doing exactly what he said, is bringing back manufacturing. As we as a company look at the subcomponents and especially the talent, in telecom, your talent is typically coming from China or India these days. So I think a win for the president is reestablishing some of these capabilities, both in terms of talent and technology in the country. So manufacturing coming back. This is not a short-term win that you're going to see. It's going to evolve over the next 4 years.
But so that's the last question then, which is maybe this game of chicken that's happening. If you're a CEO and watching us speak about this right now, do you say to yourself, I'm going to bring manufacturing back to the U.S.? Do you say, let me watch this whole thing play out? There's no reason to make a decision quickly because who knows where this goes? I mean, those are sort of the really big questions as to what China does, but also what the business community does.
Well, I think that the companies that are going to be advantaged are the ones that had already started and anticipated what was going to happen, have already started looking for those alternatives, or maybe moving their manufacturing. For others, I think it's going to be a tough, going in the next couple of years as they reset, because quite frankly, I don't think we're going to get to some kind of post-normal where China is going to figure heavily in our manufacturing going forward. So, I think it's high time they got prepared to shift things. And if they're not, again, it's going to be tough for them for the next couple of years.
Robert Spalding, we appreciate your time this morning. Thank you, sir. Good to see you.
Thank you.
All right, still to come this morning, Wall Street gearing up for big bank earnings. Those kick off tomorrow. We will tell you what to expect, if anything, in this season of market volatility. Obviously, we'll be listening to banks to see their forward guidance on some of this, too. This is all coming up right after a break. Squawk Box. We'll be right back.
Jim.
It is 7 a.m. on the East Coast. You're watching Squawk Box on CNBC. I'm Andrew Ross Sorkin, along with Becky Quick and Joe Kernan. This morning we start with tariffs and the markets. President Trump's tariff pause on countries around the world, except China, now sparking a global rally that started yesterday afternoon. The S&P gained more than 9%, its best day since 2008. The NASDAQ adding back 12%, its best day since 2001. The Dow was up nearly 8%, just shy of 3,000 points. That was Dow's biggest point gain ever. But do take a look at the futures right now as we get ahead of the market today, because we are looking at a little bit of red, giving back some of those gains. Dow off by about 450 points, the NASDAQ off by about 360 points, and the S&P 500 off about 85 points. Take a look at what's going on in the European markets as well. The EU now agreeing on a 90-day pause and countermeasures that were to take effect on April 15th. Those markets looking up pretty much across the board by 5%. And then Amazon CEO Andy Jassy, he is out with his annual letter. Jassy saying that he's feeling quite optimistic about the progress and potential of our existing businesses. We're going to have a lot more on that letter coming up in just a few minutes. I'm in Seattle at Amazon's headquarters, and we're going to get to talk to Amazon CEO Andy Jassy about everything that is going on, tariffs and so much more. That's going to happen at 8:30 a.m. Eastern Time. Becky.
Andrew, thank you, and we will all be looking forward to that. Obviously, huge news given Amazon's perspective on where things stand. In the meantime, though, we want to get over to Dom Chu. He's got to look at this morning's pre-market movers. And Dom, you got a lot to pick from.
Yeah, there's a lot, and big tech has got to be the big story so far, given what Andrew just told us about the moves yesterday. You are seeing some of the give back this morning after that record surge yesterday. Most of the names in that so-called Magnificent Seven group of stocks are about 1 to 2%, maybe lower. You can see here maybe 3.5% for Tesla, 3% for Apple. That's after moves of between 9 and 22% higher yesterday. But let's look at the names going back to last week when those markets plummeted following the tariff announcements. Apple is still down roughly 13% in that span. Tesla, Meta Platforms, Alphabet are also in the red too. Microsoft, though, is the outlier in the green, up by just about 0.5% or so. So keep an eye on the relative moves, given what we've seen since the tariff regime has started. Meanwhile, chip stocks are also pulling back this morning after a huge run-up yesterday. NVIDIA, Broadcom, and Micron all climbing around 18%. AMD, by the way, sort of about 24%. Going back to last week, though, let's put those in context. Those names still in the red. Broadcom is, though, up about 4%. NVIDIA is up 0.5%. AMD, though, Micron and Qualcomm shares all down between 9 and 15%. So, again, put those moves in context. And we'll finish off with a check on retail and travel names that are down between 2 and 3% pre-market. United Airlines was up 26% yesterday. Nike and Target both rose about 10%. And over the last week there, all of these names are still in the red. Ralph Lauren is down 15%, and Nike's down about 11%. So, big moves, Becky. But we got to put them in context for you. We'll see if there's any more room upside to get back to where we were last week before the tariffs all started. Becky, I'll send things back over to you.
Hey, Dom, it's really interesting. We did see Walmart and Delta both give not great guidance, basically yank things and come in below expectations, and those stocks rose, but we were 9.5% lower at the S&P 500 at that point. It's going to make next week's earnings season all the more interesting to see how this plays out.
Oh, absolutely. I think no doubt about it. If you take a look at the pulling of guidance, the lack of clarity, the idea that we are not going into a season where we're supposed to get a lot more clarity on not just what's happened, but maybe some commentary on what's going to come in the coming quarters. That's big. And by the way, the other thing that caught my eye, Becky, amidst all of those sharp moves, the number of folks, I guess, based upon volumes, that have used those kind of levered ETF instruments in yesterday's trading. All of those tech stocks, semiconductor ETFs, huge moves higher on the levered side of things as well.
Who you got?
I got to say it's Rory. It has to be. It almost feels like destiny at this point. He won the AT&T.
I have him too.
Yes, he won the. He's already won 2 signature events this year. He's come in second place or between second and fifth place for pretty much every major in the last year and a half or so. So this is the time.
Tell me we don't need a diversion. from the haters and I mean it's
it was funny
God.
on social media. Everybody had to remind me on Monday. Don't worry, amidst the market turmoil, it's Masters Week.
But
it's a
we
reminder.
didn't know how good we had it during the Biden years, when the mainstream media was sleeping. But anyway,
I would just say Joe featured groups. I think Scotty Scheffler's he's off in the 10 o'clock hour, and I think Rory's in the 1 p.m. Eastern time hour as well today. So
great.
You got to root for him. I just love to see it happen.
Career Grand Slam would be great.
Betsy's here and said, Betsy Gray said, let's talk JP Morgan, Morgan Stanley, Wells Fargo, all set to report financial results tomorrow. We need an analyst. So we have Betsy from Morgan Stanley, Global Head of Banks and Diversified Financial Research, U.S. Large Cap Bank Analyst. There's a famous book called 8 Days in May. I think it's about World War II and the end of World War II. This was 8 days in April, wasn't it? It was since it's exactly 8 days.
Has been.
After it happened on on April 3rd, the day after Liberation Day, you pointed out you knew tariffs were coming, but nobody knew this crazy formula they were going to use and that it was going to be set so high. And at that point, if it had continued, you were forecasting a bear case of a moderate recession.
Yes,
That's right. Is that off the table or?
Well, we have to see how it rolls from here.
Yeah.
And maybe 8 days will become, 16 days.
Yeah,
Let's see
90
how
days.
it rolls.
But
Yes.
anything in the results that we're going to see that will already be apparent from the 8 days in April?
Well, I think the outlook will be changing. So results itself, I think, will be very good, solid. We've got great trading numbers coming our way, and banking's in line. But it's going to be one of the best quarters that never mattered, right? Because it's all about the outlook and what's happening from here.
I mean, obviously, the past 3 months, we were waiting for something like this. And there are people that said that already business leaders were, pulling in their horns. The uncertainty was causing them to act differently. But you don't think we see any negative look back. The past 3 months are going to be positive for the banks.
Well, what I would say is it's going to be solid. We'll have solid earnings. And we did see during the quarter loan growth picking up a little bit. We ended with 3% loan growth, year on year. Not bad from where we started. But look, the uncertainty about what your input costs are and how much you should invest in that is real. And I think what we'll hear from CEOs is how their customers are thinking about reacting to all of this.
It's kind of interesting how the banks themselves are reacting to it, though. Are they going to be tightening their lending standards? Is it going to be harder to get a loan out of a bank, whether you're a consumer or a business?
Right, exactly. These are the questions we'll be asking, Becky, definitely.
Yeah.
My sense is that they will say they're not tightening standards, but given the situation, fewer people will cross that bar. Right, so maybe
it
that
feels like it's a higher bar, just
Yes.
out of caution that the banks would naturally fall into after a situation like that.
It will be great discussions starting Friday, definitely.
I like your stock picks. You don't like those competitors to Morgan Stanley very much. No, I'm kidding. But you got an equal weight on Goldman, equal weight on JP Morgan. You do like Citigroup, though, quite a bit. But go through who the big winners and the sort of average banks are.
So our rating, we do have an overweight on Citigroup, we have an overweight on Bank of America, and I am equal weight on JP Morgan and Goldman Sachs.
Right.
And the reason for being overweight on Citigroup is a view that with the stock trading below book and below tangible book right now today, they can buy back the stock in a very, very, very accretive way and drive that ROE towards their goal of 10%. And right now, the ROE is below that. And the stock is trading below book and below tangible book. As they execute on their plans of taking share in M&A and ECM and banking, as well as getting more efficient across their platform, we do see them marching up towards 10% ROE over the next several years. And with that, the price to book multiples should expand. So it's a valuation call on Citi, as well as they are executing on their program to drive up their ROE. JP Morgan, great firm, just really knocking it out of the park in so many ways. The valuation's a little more expensive though. It's trading, much more richly, and it's really a valuation call, Joe.
Big turnaround, a tough turnaround. That is truly turning around the Ocean Liner, I think, Citigroup.
You're talking about Citi, yeah.
Isn't it? And then you're looking for $90. That's like $9, all right, after the 1 for 10.
That was a long time ago.
I can't get past that because I'm still dancing.
Hey, you gotta move
with
on.
Chuck.
Okay.
But yeah, all right.
My view is that they are turning that around. Jane is turning that Ocean Liner around.
Yeah.
Yes, and she's had some really strong successes here in the past several quarters. There might be a little bit of a slower ride here, along with the rest of the group as we work through.
Yeah, this other stuff.
Yeah.
There's other stuff happening. The Masters? No, hey, Betsy, thank you. Coming up, the pause that refreshes President Trump's decision to put tariffs on hold, except for China, sparks a rebound in the markets.
I'm trying to think of how many people you're channeling in this video.
Yeah, exactly.
Who was?
China. National Economic Council Director Kevin Hassett's going to join us next with more on this latest turn in trade, possibly latest twist. Then later, Skybridge Capital's Anthony Scaramucci on all the volatility in the crypto markets. He had a great plan for an off-ramp for President Trump, but I don't know. We're going to talk about what he thought he should have done and what he thinks of what he did do. Squawkbots, we'll be right back.
insurance.
President Trump announcing a 90-day pause on some tariffs, excluding China. Joining us now with more, National Economic Council Director Kevin Hassett, who all along, I think, we divide people up into the negotiators. That was Bessent, and you're going to probably won't like this. So that was Bessent and Elon, and I would say you. And then we had the stand firm, no negotiators, and that was maybe the Commerce Secretary and maybe Peter Navarro. It looks like something that you said earlier in the week, Kevin, that sort of got, I don't know, circulated as fact instead of fiction. That was like a market check. Yesterday it happened, and indeed, 3,000 points.
Well, first of all, I don't really like the characterization that we're divided amongst teams. In fact, I would say that the person who, right at the final minute, was with the president when the president decided to do the pause that we had been talking about all along was Secretary Lutnick. Secretary Lutnick and Secretary Bessent were in the room for the final call with the president. And I think that's a nice clarification of how we're not on different teams.
Oh, wait a second. Okay. I know boys will be boys, according to Carolyn Levitt, but are you not on X? You didn't. I still don't get anything except talk about that whatever you want to call it, that food fight between Elon Musk and Ron Varro. Peter Navarro.
Well, as you know, that I practice a martial art called Aikido, where basically what you try to do is redirect negative energy so that it works against the guy and doesn't turn it into an all-out scuffle. And I think verbal Aikido is a better choice. It's a better choice.
So Kevin,
it's a better choice for people.
I characterize it as the art of the deal on one side and hitting your head against the wall until, because it feels so good when you stop, and that the actual what happened yesterday was somewhere in the middle. I guess you'd say it was all art of the deal. This was the plan all along to goad China into being isolated.
Well, I think that what's been going on all along is the president recognizes that in order to get the big change that we need for America's workers, like these are really fundamental changes that we're talking about, that we need to create enough pressure on our trading partners that things that American presidents have been asking for the last decades are actually offered at the table. I can say that I was on a call with the Swiss president yesterday with President Trump. We've got a whole system set up through Susie Wiles and the cabinet secretaries that we're starting to have a meeting today after lunch, where we prioritize our allies and other countries and decide who is going to visit and when. But I can tell you that the amount of stuff that's coming to the table came up really a lot, long before the market movements this week. And so it was looking like that there had been enough action to get us to the point where we should really genuinely start negotiating. And if you go back and look, you can see the negotiation signals were out there already, even on that Monday where somebody made a fake tweet that suddenly said that I was saying something that ended up being kind of mostly true on Wednesday. And so anyway, I think that everything was moving forward in an orderly fashion, and there's no doubt that the Treasury market yesterday made it so that the decision that it's about time to move was made, I think, with perhaps a little more urgency, but it was going to happen at the moment anyway.
You expect real negotiations over the next 90 days. Right. People say it's happy talk. And it's in fact, all these trading partners are going to be emboldened now to not do anything because they know that the president's not serious or he's going to blink. So they can just wait out, and they got 90 days now, and they don't have to do anything.
I talked with Jameson Greer, the U.S. Trade Representative, yesterday, just to get an update on the number of countries. And of course, saying you've got a lot of countries calling, that's one thing, right? But they could be calling to say, how's the weather out there? But then having people really begin negotiations to make offers, that's a different number. That number is like closing in on 20. There's a little bit of discussion about exactly, well, did they really make an offer? But for sure, there's a bunch of offers that are really sensible offers, and they're coming from our top trading partners. And it's some of the most progress in trade negotiation that I think probably the most progress that we've ever seen. And so I think that this system that the president set up to say, hey, we're serious about negotiation, we're serious about reciprocity. If you guys come down, we'll come down. To do that, we've got to have some negotiations. The fact that people started to send stuff, we had 2 deals almost closed as of last week, almost closed. Getting them closed requires the lawyers to work forever. and so on. And so getting them closed by yesterday was not quite going to happen. But yes, there's a big inventory of deals that are right close to the finish line.
All right, that's interesting.
Kevin, how much of the decision was led by, in terms of to pause yesterday, was led by the bond market and what you were seeing there and anxiety on that front?
My view, and you know, I've been on the show for 20 years, right, is always to just shoot straight. My view is that they were very, very close. It could well be that the announcement that came out yesterday was going to happen anyway because there were so many deals teed up. There was a discussion about whether a general pause or a few deals that are just about finalized are the way to move to the next step and to make it clear to markets that we're serious about the strategy that we're following. And I think in the end, everybody decided as a team, you know, all the way from you know, Peter Navarro to whoever else you think is on the other side, agreed to do it this way. And I think, you know, the fact that the bond market was telling us, hey, it's probably time to move, certainly would have contributed at least a little bit to that thinking. But it wasn't the bond market that made a panic move because there was a very systematic, well-planned move that was just about to happen that just turned out to be at the same time.
Right. Now, the reason I ask about the bond market, Kevin, is as this plays out over the next 90 days, and we all watch the bond market as well, and I imagine you folks will too, if we see a spike in the bond market in a similar way to what we saw, you know, in the last 48 hours prior to the pause, how you think that changes the negotiations, or if it does at all, and also how our allies or folks who may not be our allies or negotiating against us on tariffs are going to be thinking about that bond market.
Well, I think that you can think about there being two phases. Phase one is going to be where we demonstrate the truth that with the guidance of Susie Wiles of Chief of Staff's office, that we've set up a process so that these negotiations can proceed in a very orderly, well thought out fashion with timelines and so on, and priorities. And again, there's a big meeting about that with senior cabinet officials today here at the White House. And then once we show you, well, here's how we're doing it, then I think that'll be very reassuring for markets because I understand not only are they serious, but we can even see the schedule and we can see the priorities. So the priorities make sense. And then I think that the second phase will be when you start to see the actual deals and see the characteristic of them and saying, oh, not only are they talking about it, but they're delivering, and oh my, that thing they delivered is really great for American workers. That second phase is going to be much faster than you might think, because basically we've got a few deals that we've been working on ahead of this that are really, really well advanced.
And Kevin, I think that's a big part of the question, what those deals look like. I mean, there had been questions asked because even renegotiating NAFTA took 2 years to do. Are these just kind of straight across the board, bring tariffs down here, cut these non-tariff barriers? Is it a formula that's kind of working, or is every country different?
Well, in the end, the asks are going to be put forward by the president, guided by the same trade team that got us to this point. And I think that the asks will be sometimes extremely clear to the public, and sometimes they'll be quiet things that involve things that people don't even talk very much about, involving military matters or so on. And so it's an all of the above approach to make the relationships between our countries much stronger than they've ever been before. And I'm really highly excited about it. It's going to be a heck of a time. And when you talk about timing, when I talked about, well, 60 days, 90 days, the book Around the World in 80 Days kind of ran into my mind. And I'm thinking, well, if we say 90 days, then let's shoot for 80 days. And I think that when I look at the schedules that we're getting ready to debate and talk about, I think it's very doable, very doable.
Hey, Kevin, when we were still in negotiation mode, we were hearing that we could go to 0.00 with a lot of these countries, but that doesn't cut it. There's so many other things in terms of currency manipulations and VATs and all these other protectionist things that went into that crazy measurement that the administration used to try to summarize all of them using trade deficits. That seems like no way you could get some of those deals done in 90 days. Are we going to accept much less than what we were promised in terms of getting rid of all the impediments to trade?
I don't think there's any chance that if Secretary Bessent or Secretary Lutnick, the two of the main negotiators for this, are going to go out and come up with a deal, and then they show it to the president, that if the president doesn't think that it satisfies his objectives for the American people, then those negotiators on our team are going to hear from it. And boy, I can tell you, I've seen what happens in the past in the previous administration when deals are negotiated that the president doesn't like. He sends them back to the drawing board until he's ready to strike a deal that he thinks is right
What are
for
we
the
doing?
American people.
What are we doing with China? Are we isolating China to finally decouple, which is something that's a something that's been talked about, but I don't know in practice whether it's really possible, or do you expect them to come to the negotiating table? Because most pundits say that that Xi is backed into a corner and there's no way he's going to come around at this point.
President Trump has a strong relationship with President Xi. They've had conversations in the past that have been very productive. Those conversations haven't begun yet. When they begin, I think, is a decision that President Trump will decide. And I don't have any clarity on whether that's going to be soon or later. But I know that the president has had made a lot of progress in the past by speaking directly with President Xi. And I'd be shocked if at some point that doesn't happen.
We had Professor Jeremy Siegel on earlier this morning, and he brought up a few questions about this. He said, look, first of all, it takes the markets time to recover from the psychological damage that they've experienced the last 8 days. And he also said he did not think that the United States holds as many cards as we think we do when it comes to negotiating with China. What would you respond to that?
I think that given the massive trade deficit that we have, that there are really quite a few cards that are held that are very difficult for China to adjust to. So think about it right now, that there are whole container ships filled with stuff that might be sitting in port in China right now, wondering what they're supposed to do, and then the factories that reload the incoming container ships, wondering whether they should shut down for a while because they don't know where they're going to be shipping the stuff. It's an absolute extreme disruption for the Chinese economy right now that's come because of repeated terrible behavior on their part, including aiding and abetting the fentanyl trade. And so I think China's going to have to figure something out, and my guess is it's going to involve reaching out to us and setting up talks. But their economy is certainly right now going through the kind of shock that they probably never expected.
Hey, Kevin, how does this whole pause change the timeline to the extent it does around the budget talks, around taxes? That's something that, House Speaker Mike Johnson has talked about. He thought completing in the month of May, given that I imagine these talks are now going to play out in a longer way in terms of the tariff piece and potentially the revenue that could come with that. And I know that was something that was important to the administration in terms of thinking about how to therefore construct the budget. I imagine we're now talking about sometime in the summer. Does this get pushed to the fall? Where are we?
I don't think the very ambitious timeline that the White House has signaled has been changed at all. If anything, things can even go faster. What's happening is that the Big Six group, which includes Scott Bessent and me, and then the leadership of the House and the Senate, we've been meeting every week and negotiating the tough negotiating things so that both the House and the Senate, when they move forward, that they're moving forward in a kind of ratcheted way so that they don't slip back. And I think that we're going to hopefully see that this week when the House passes the Senate budget instructions. And then from there, all of a sudden, the committees are going to start writing the stuff. And a lot of that stuff the committee's been working on since last summer. And so I think that absolutely the big, beautiful tax bill is right on schedule. And then it is a technical matter that I know that market participants like to think about, is that now that we've got, say, $2 billion a day in tariff revenue coming in, that's a lot of revenue that can help reduce budget deficits, should be good for bond markets. How does that influence the package? And the bottom line is that what will happen will be that the CBO, when it sees the revenue, will start to adjust the baseline for revenue to include the tariff revenue that comes in. And that will reduce the deficit. Right, it'd be good for bond markets, but it won't affect the overall numbers that they agreed to. It won't count as a tax increase, right? It's just like a baseline adjustment.
Kevin, I appreciate the perspective that it won't be part of the full CBO scoring. That's something that we've talked to Secretary Bessent about. But I always thought that the administration, and at least some Republicans, were thinking of trying to include some of those numbers, at least in terms of how they were going to sell the plan to the public and to others when if we're talking about taking down taxes on tips and things like that, and part of it was creating some kind of permanence around those tariffs so that you knew that that revenue was also permanent. If that revenue is not permanent, because there's still talks going on, that will therefore change the dynamic with which you would negotiate around the budget, no?
Well, what I mean to say, Aaron, is that the tariff revenue, if Congress decides to write into law the president's objectives, then we would, of course, celebrate that. But there's a plan right now that gets this tax bill done, before we all go home for vacation in August, and well before then, and that it doesn't require any tricky maneuvers with the tariffs. The tee, right? Like the ball is on the tee, and they can hit it. And the tariffs are going to be something that should make the budget hawks really happy, because the deficit will be lower than they ever dreamed possible, but it won't affect the reconciliation process.
So, Kevin, the 10%, you add the 10%, the tariffs on Canada and Mexico, and you add in China, and these are still the highest tariff rates I think we've had people say since Smoot-Hawley. So, is that permanent? Is this now? We heard the other things are going to be permanent. It's hard to really gauge what's real and what is sort of more posturing. But do you expect this to be a permanent situation, or this is fluid as well?
I think everybody expects the 10% baseline tariff is going to be the baseline, and that it's going to take some kind of extraordinary deal for the president to go below there.
In the way that I don't know if history is ever going to really come down with sort of the administration's spin on how it all happened. You've seen some of the articles that that the president was watching some TV yesterday, and saw different things happening that finally forced his hand, and that some of his closest advisors didn't find out. Exactly what was happening. It just seems like a lot of this, if you're going to call it the art of the deal, should we just assume that it is an art, it's not a science, and you can get to this point and it was all deliberate when it's all said and done, or are you just sort of being buffeted by circumstance and finally arriving at a policy that affects the entire globe, frankly?
No, this policy was discussed at length with a whole bunch of trade advisors over many, many weeks. In the end, the president had multiple options to decide between, and he knew that he had to create leverage to get people to the table to begin negotiations. He did that before the final decision, and the negotiations lifted off like really crazy, right? A couple days before markets started gyrating. And so then the question is, how do we start to show that we're genuinely going to have these negotiations? And we had a couple of deals that are close to finished, and we also had the idea that we could have a pause. And the president decided to pick the latter approach, which was something that had been studied all along, all the way to the beginning, about like how do we go from first let them know we're serious to second getting negotiations that actually deliver for the American people.
Right.
And the president chose this path, and it was not something that he thought up the last minute.
Was it deliberate overkill on the calculation used for those very high tariffs that allowed the United States, to cut it in half and have very high tariffs? Was that all part of the plan?
The original IEEPA was meant to address the trade deficit, which is viewed as a national emergency, and having the tariffs be a function of the trade deficit seemed like the logical thing to do for the lawyers at the USTR. And those numbers ended up being pretty high. And I think, did the higher numbers help get people to the table, help people understand the urgency of what we're trying to accomplish? I'm sure they did.
Okay, good. Kevin, thank you. Kevin Hassett.
Thanks, guys. Great to be
Okay,
here.
hope to see you again soon. Thanks.
Okay, coming up on Squawk Box live from Seattle this morning, Amazon CEO Andy Jassy is going to be with us. He's saying he's optimistic about the company's future and making big investments in AI in his annual letter. We'll tell you about what's in that letter next. And media stocks moving lower this morning. China's film administration saying it would moderately decrease the number of U.S. films that are imported to China, citing, quote, reduced domestic appetite for U.S. films due to tariffs on China. The tariff war continues this time in soft power and economic power as well. Squawk Box, and right back after this.
Time now for today's Aflac trivia question. Which Hall of Fame basketball player is the co-owner of a NASCAR team? The answer when Squawk Box returns. How you guessed. And now the answer to today's Aflac trivia question. Which Hall of Fame basketball player is the co-owner of a NASCAR team? The answer, Michael Jordan.
Welcome back to Squawk Box. We are live in Seattle this morning at Amazon's headquarters because this morning the company publishing its annual letter, and we're going to have an opportunity to spend some time with Andy Jassy, the CEO and author of that letter. This is what he's writing this morning. He says that he's, quote, optimistic about the progress and potential of our existing businesses. A key theme of the letter is Amazon's effort to operate as, quote, the world's largest startup as it takes on artificial intelligence in the tech race. Jassy writing that, quote, generative AI is going to reinvent virtually every customer experience that we know. And Amazon is investing aggressively in this new technology. Last month, Amazon formed a brand new unit at AWS that is dedicated to agentic AI. And yesterday, CNBC spoke to the leader of this new unit about how the tech giant is leaning into the technology.
Within Amazon, we have been embracing AI in almost every aspect of what we do. Last year, we used our Amazon Q developer agent to upgrade our Java software internally, which saved the company more than 4,500 developer years and more than $250 million in CapEx savings.
Joe, they're not doing C++ anymore, so it's you know.
Hey Andrew, I've used that. I've used the AI assistant that they have on Amazon. It's pretty awesome because you can check out to find out what the ingredients are and things. Like I was trying to make sure that some sunscreen for your lips didn't have oxybenzone. No, you want mineral-based sunscreens. I was using it. It was real helpful with some of the things I was going through because it's hard to find that stuff naturally, and the AI assistant helped.
You want mineral-based?
Yeah.
It's too late for me, I think.
You just said some.
No, I got things, you know.
You don't want.
I find new things that, you know, I have a dermatologist like on retainer. I guess that's the the ruddy-skinned.
I think that's all of us who are.
You haven't had. Have you had things?
Oh, yeah.
We
I
got,
still got
Becky, it
things. I
sounds
got
like we
things
got to get
built
you a.
up. I need to have done. What's
We
that?
got to get you Alexa Plus. That's the next development in all of this, because that's going to be sort of the AI version of Alexa, sort of the next gen, where you'll be able to just talk to it the whole time and it'll tell you all this stuff. So it's all pretty cool.
Should really
We're gonna
listen.
talk.
Should really listen to what I said, to what all of us say, and send it to the proper people. That's just what I need.
We're going to talk to Amazon CEO Andy Jassy about tariffs, about what's going on in the global economy, AI, and so much more. So much news literally coming out even this morning as it relates to sellers on Amazon, China, and everything else. That's going to happen at 8:30 Eastern Time after we get consumer price information, which we'll also talk to him about. So a lot going on.
When we come back, Bank of America's latest consumer checkpoint, we're going to find out if the fear of tariffs is impacting shopping habits and spending. And check out the performance of some of the big box retailers. Walmart and Costco in the green over the course of the last month. Target down 15% still. Squawk Box will be back just after this.
Done.
Bank of America is out with its monthly consumer checkpoint that provides real-time spending estimates, and the latest data shows consumers are still spending despite fears of higher prices because of tariffs. Joining us right now is Liz Everett-Chrisberg. She's the head of Bank of America's Institute. And Liz, the numbers were good. I think it was an increase of 1% in consumer spending in March over the drop that we saw in February. So that's great, but this data ended at the end of March, and it's been an interesting couple of weeks since then.
It's been an interesting time since then. But you're right, we did see consumers across the U.S. continuing to spend in March. But the question is, was that spending boosted by consumers who were trying to get ahead of tariffs because they knew tariffs were coming?
Like buying a car if you were going to wait?
Like buying a car, like buying durables, exactly. And so what we did is we looked to try and understand how much of that spending was really an increase in durable spending. Was it a pull forward? And we found some evidence of it. In terms of durables, durable spending on our card data was up 1.5% after being down in both February and January. So you did see a little bit of a pull forward there. But when you look at the ratio of kind of high value durables in our card data to total spending, it actually declined. So a little bit of a mixed message overall. Where there was no mixed message, though, was in autos. And auto sales went up fairly significantly, but if you look at the daily data, so tariffs were announced on the 26th. We said the tariffs were gonna go into place
of March.
on April 2nd.
Yeah.
So in those 6 days between the 26th when they were announced and the 2nd when they were going into account, our applications for vehicles, for consumer vehicle loans, was up 23% in just those 6 days.
Wow.
So we did see some evidence on the auto side of pull forward of demand. It'll be interesting to see, if we get that payback, given what has happened in the last
We're going to
couple
start hearing from the big banks tomorrow on the first quarter earnings.
Right.
And we've all decided that, first quarter is probably going to be pretty good, but it doesn't really matter. What matters is the guidance and what they're telling us now. What can you kind of anticipate? What can you look for? What will you be watching from consumer spending? Because it seems like it is happening on a day-by-day basis.
Yeah.
Watching the market's massive gyrations. What have we seen before when there's big gyrations in the market?
So I think the key thing with all of this, with gyrations, with volatility, is always to go back and look at wages. How much is the consumer bringing in, and how is that relative to what they're spending? And what we saw in March in terms of wage growth is wages continue to go up for all income groups, but they're pulling back. So higher income wages, they, after 4 months of accelerating growth, pulled back about 100 basis points. So that's up 2.6%. I mean, it's still greater than their spending. But what I really pay attention to is lower income wage growth. So lower income wage growth continues to come down. It dropped another 100 basis points, up 1.4%, which is the lowest level of lower income wage growth we've seen in 8 years. Since April of 2017.
Still wage growth.
So it's still wage growth. It's still wage growth.
At a time when inflation has not been quite as strong, when you have a relief, at least from things like gas prices.
Relief from gas prices, but where we're not necessarily seeing relief is in services for necessities, right? So looking at rent, looking at utilities, looking at insurance, we are continuing to see inflation there. Okay. And when you're thinking about the lower income cohort, the percentage of their after-tax income that's going to those necessities is significantly higher.
So you could potentially be seeing a slowdown before the tariffs were introduced as part of this too.
And we have. I mean, we've seen consumers trading down from premium grocers to value grocers. One of the other things that we saw this month was in terms of services. And services spending continues to be the big driver of spending. But there was a shift from to necessities from the nice to haves. So restaurant spending down, travel and tourism down, leisure down, as the consumers are shifting some of their spending towards more of the necessities.
I think next month is going to be the interesting month to watch what happened during these 8 days. And you could tell us on a day-by-day basis.
We will look at it, and we will certainly tell you all about it. The other thing that I think was really interesting, where we did see a bounce back, and we talked about this last month, DC in February saw a decline in spending, right, given all that was going on. So we wanted to see, was that a blip or is that a pull forward? We did see a rebound in DC, so it's back to positive spending growth, but it is lagging other eastern cities. It is lagging the rest of the U.S. And some of that obviously has to do with increased unemployment there. When we look at our data, there was a 135% increase in households in DC getting unemployment income. So that's not necessarily surprising, but we are able to quantify it. They are still spending, but something we're going to keep looking out for in our data.
Liz, thank you.
Great to be here.
Right, coming up, volatility in the crypto market and so much more. Skybridge Capital's Anthony Scaramucci on the wild swings in Bitcoin, the future of regulation, yesterday's tariff pause. He's going to join us next. Squawk Box coming right back.
androidbeauty.com.
Shares of CarMax are falling. Earnings coming in at 58 cents a share. That is 7 cents below estimates. The revenue of $6 billion was just ahead of expectations, but comp used unit sales grew by 5.1%. That was below the street's consensus of a 6.2% gain. And used car sales increased by 7.5% to 4.84 billion. That was just shy of expectations, but guys, I think this is indicative of what's happened with the market overnight. You come in with expectations that were below the street's thoughts, or guidance that's below the street's thoughts, or even numbers that were below the street's thoughts yesterday, and they would give you a pass on it. Now, the S&P has moved 9.5% overnight. Now, it may be a little more disappointing because you're talking about different prices for what these stocks were just yesterday. Right. CarMax shares up, giving up about 7.25% based on what they're saying here today.
We got 3,000 points to slowly give back theoretically.
Well, we were priced for a recession.
Right.
And that was taken off.
I don't know, though. We weren't that. Is a recession only 4,600? I don't know.
We were
last recession we were down. Last recession we were down. We were 2,300.
And by the way, if you were looking at the Russell 2000, it was down by about 30%. So depending on which stock you are, which sector, which index you're following, there were some real flashing signs of potential recession.
Right. Well, that might have been part of the calculus.
Yeah.
Bitcoin prices are back over $80,000 after yesterday's rally. Right now, Anthony Scaramucci, founder and managing partner of Skybridge Capital, is here. And we'll get to Bitcoin, but I think there's other things we can talk about. First, I was going to say, having you in studio and everything else, I thought you'd bring some wine for me. That was always the greatest thing about Davos.
I have some left. If you're nice to me,
I have leftover. We'll see.
I have leftover
the Scaramucci wine.
Leftover wine in the reserve.
That was the one thing I looked forward to in Davos. Was your
wine farm.
That was about it.
Be nice, Joe. Maybe there's like packages of wine somewhere.
We'll see. Earlier,
it's probably Ernest and Julio Gallo though with the script top.
Apple, whatever it was, Apple wine. That's right.
The Boone's Farm. Truce for the.
We were talking earlier in the week, Anthony, and that was before the pause yesterday, and you were making the case you wanted to present what you thought could be an off ramp but let me read this to you before just to soften you up a little. This is Bill Ackman. I was one of the first and certainly one of the loudest to raise concerns about the tariffs, but I also believe in giving credit where credit is due. The outcome of the Donald Trump strategy was highly favorable. I focus on the outcome, not on how the sausage is made. The unfortunate state of politics is that the never-Trumpers want to see Trump fail, regardless of the impact on our country. I want Trump and our country to succeed. He goes on to talk about Scott Bessent. I think you have said you admire Scott Bessent, and that was a pretty good pick.
I admire Scott. I think he's handled this well. I know you think I'm a never-Trump. I don't want Trump to fail. I'm an American. I'm also a patriot. I love my country. I'd like to see him succeed. I think in our conversations off the air, what I was suggesting, he's got a historic opportunity now to tie us up with our allies. And I think the aftermath of what happened yesterday is a great opportunity to do more or less what Elon Musk said over the weekend, which is if you set up a free trading zone between Mexico, Canada, Western Europe, that would be, I think, a huge economic boon for the United States. We've had a problem with China, Joe. I've talked about that problem. I'll admit that in 1999, I got the World Trade Organization protests wrong. You guys reported that in 1999. The workers up there said, don't give all of these privileges to China in the World Trade Organization unchecked. Donald Trump has been speaking about that for 25 years. You've got to give him credit for that. As a Wall Streeter, as a young Wall Streeter, I got that wrong, and I'm willing to admit that. So, but I
did too. And I thought capitalism, there's winners and losers, and let the chips fall. Globalization lets the chips fall, but that really did close 60,000 factories in this country.
65,000 factories lost since that happened, and so I appreciate what the president's doing in that respect. But here's what I would say: you brought the tablet out. Bring another tablet out, because there's a lot of lack of clarity on where things are and where things want to go. The president's a declarative guy. Tell us where you want things to go. You've spoken with great seriousness about the markets. You've shocked the markets. Tell us where you want us to go so that we can settle the bond market and we can restart our growth. I mean, we're not litigating the election anymore. Election's over. He's the president. I'd like him to succeed. Those are the things that I would be recommending.
His unpredictability that I think he sees as a strength in negotiations is part of what unsettles the market, the lack of visibility. And I guess, what's the friction point between those two? Did we actually see a Trump put come in yesterday, or how do these things match up?
I'm gonna take the president and his staff at his word. Maybe he was trying to scare everybody, and maybe he was trying to make a statement to the world, and maybe there was some systematic things that are
Kevin
going
Hassan
on.
said the bond market did play a role in it yesterday when he just joined.
But now that we really got our work.
By the way, Joe pushed him pretty hard. I was impressed, Joe.
We really got our work cut out for us now, though, in terms of deals. I don't know what a deal with the European country looks like when it wasn't just about tariffs. It's about all. And then China. I don't know what happened.
Joe, he looked like Moses with the tablet.
I do.
Have him come out with the other tablet. The first tablet.
Are we decoupling from China? Is that what we're doing, or are we negotiating?
Listen, I don't think we need to decouple from China.
What's he trying to do?
They're producing more than. Yeah, go ahead, Andrew.
I was just going to ask about you've negotiated things before. Where does the leverage lie at this point? I think that's the big question, which is to say, if you're the EU, if you're Canada, if you're Mexico, if you're India, and you've watched all of this play out, do you say to yourself, oh, I want to run into their arms and do what they say because now I have 90 days? Or do you say, I have 90 days now to figure this out, and by the way, maybe I can actually capture some leverage because clearly this president and this administration is willing to take a pause when they see the bond market going in a way that may not be favorable?
Well, listen, I hope that doesn't happen. That is a possibility that could happen because of the unpredictability of what just happened. But Andrew, I would say this, if you really want leverage in this situation, team up with the Canadians and the Europeans and the Mexicans, and then you'll have more leverage on China. I think that's really been where the pressure point is.
100%.
If you look at the whole
By the way,
thing.
Anthony, you're right. But what do you have to give for that? Now, what do you get for that? That is the hard part at this point, which is to say, up until yesterday, we were talking about getting things from Mexico, getting things from Canada, getting things from the EU. If the new position is, we need you to be part of us, that's a very different approach. And we have a trust problem right now. I mean, I can't say how many emails I've gotten from CEOs in Europe and in Canada that are furious with the United States, that are very upset about the direction of the relationship. So how does that play itself out?
Well, listen, I agree with you, and I get the same emails, but it is healable. And let's face it, we've had this 80-year connection with each other. And to me, I think that's where we got to go. And I think Elon Musk said it better than all of us. I would prefer, and I think all of us at the table, from a capital perspective, would prefer a free trading zone across the Atlantic and just make it more fair to the United States. And there's your leverage with China. But I don't think the Chinese are going to back off, Joe. I mean, you guys may think so, but if they really understand their culture, they're not going to back off. So, and we need like a Henry Kissinger in there, frankly. He's not around anymore, but we need a Kissinger moment to mediate between the two groups and to get this thing dialed in properly. Because remember, there's a lot of small businesses in this country that rely on Chinese manufacturing, whether we like it or not. If you want to reshore things, it's a 7 to 15 year reshoring. Let's not blow the marketplace up right now for no reason.
Suddenly we look askance at 30 years of disinflation that we've all benefited from. Like, oh, we can live without that, and I don't know how possible that is.
There's an intersection. There's an opportunity for a great reset and an intersection.
I'm getting texts from Trump world saying Anthony is phenomenal today.
No.
Under no there's no circumstances where you'd go back. There's no circumstances you'd go back to be communications director.
Yeah,
Would you?
Yeah, Joe. I'm going to be your communications director and your sommelier.
How many did you?
Those are the two things are going to be. Those are the two things.
You're going to help me with soup? Is it what is sommelier? Oh, that's
wrong. I'm not pronouncing it right, but it has something to do with wine.
I got that. That was on. What was that? Who Wants to Be a Millionaire? That was one of the answers. A sommelier does, wasn't it? Says soup, and the guy said soup. He did, and I believed it. That was what the Anthony. What about Bitcoin back to 100,000 anytime soon?
Well, I think this whole thing is helping Bitcoin. I mean, you have to, if if you take a moment and say, okay, what are going to be in my risk-off assets? I think Bitcoin is transitioning finally to a risk-off asset. If you look at the bid that Bitcoin's had throughout this, yes, it went down, but it didn't go down NASDAQ-like, it didn't go down NVIDIA-like, and I think that's where the reset happens. Once things calm down, sure, Bitcoin could be on that. And by the way, since you love Trump, I will say this, okay? I am very happy with the Trump regulatory
No, am I just supposed to just sit here and you say something? Okay, can I say, okay, since you hate Trump.
This orange is not Trump orange for me. This is Bitcoin
good,
orange.
you did. You
But I love Trump.
You wore an orange band on your way.
Yeah. But
I've known him a long
Bitcoin
time. I understand him. Let's not say love. I love you, but let's not say love.
Hey, that's why I'm back on set.
Hey, let me tell you my one knowledge about.
You know, it's like a marriage,
I wasn't
right?
here that day.
Becky, after he beat me up, he brought me back on set, but he's being very nice.
Hey, so I have one. This is all I know about wine. Verite amuse. You know, I'm sure you know what that is.
Yeah.
That's good,
Truth
isn't
and
it?
fun, verite amuse.
Yeah.
In wine, there is truth.
Yeah. In vino veritas, that's a big.
What are you thinking for me? You already said Boone's Farm, apple.
Well, I think you need strawberry mash.
You know what? I don't look at vintage year. I look at alcohol.
Hair.
I look at alcohol. I want
hair.
MD 2020. I don't care about the year. I care about the. Thank you, Anthony.
All right, it's good to be here with you, Joe.
All right, good.
You want to get your money?
Are we far enough away, Becky, me and Joe? I mean, I think so, right?
What do you mean? I want to get close.
I thought you were going to put me out.
I want to get close now.
All right.
All right, it is 8 a.m. on the East Coast, and you are watching Squawk Box right here on CNBC. I'm Becky Quick, along with Joe Kernan and Andrew Sorkin. Among today's stories, breaking news on the tariff front this morning. The EU has agreed on a 90-day pause in their countermeasures that were due to take effect on April 15th. The president of the European Commission said that if negotiations are not satisfactory, those countermeasures will kick back in and preparatory work for further countermeasures will continue during the pause. We're counting down to the March CPI data that is due out at 8:30 Eastern Time. The headline number year over year is expected to have risen by 2.6%. That would be down 2.8% from 2.8% in February. And the futures this morning, as we watch all of this and try and figure out where we stand today, are markedly lower. Of course, this comes after a huge rally yesterday, but this morning the Dow futures at this point are down by more than 500 points. S&P futures off by close to 100, the NASDAQ down by about 390 points. If you take a look at the Treasury markets, the yields have come back down a bit. The 10-year is now sitting at 430. The 2-year is at 386. So that spread tightening as well. And for more on the markets ahead of today's key inflation data, let's go to Mike Santoli, Stock Exchange. And Mike, man, talk about whipsaw, talk about getting thrown around with this stuff. I was watching you yesterday. This is a lot to kind of take in. It's drinking from a fire hose.
It is. Becky, it's really of historic magnitude. It's happened before, similarly, when you had these episodes Friday and Monday of forced indiscriminate liquidation, very rare declines in such a short period of time, leaving the upside possibility of forced indiscriminate buying, which is what happened yesterday. People literally forced back into the market because there was so much hedging and so much selling before that. Now, what does that mean? 10% pop in the S&P 500. We're going to give back maybe almost 2% at the open. It essentially gets us back to where we were around a week ago, but above some levels. Remember, I don't know, I was on here probably several days ago saying, oh, we're hoping maybe the September lows hold for the S&P. We crashed below them. Now we have upside hurdles, of course. The mere 20-day moving average for the S&P 500, which is often where a dead cat bounce in a downturn will stop, is still a couple, 3% above where we are right now. So we're still going to be tested here as to whether there's genuine follow-on buying beyond this. If you look at the history of these massive one-day gains, you have some like the ramp off the 87 crash. You have some like March 2020 off of the COVID low, where it was up and away from there. But most of them have happened in ongoing bear markets when the market was struggling to find a floor. And so maybe that's where we are. This is just a 1 week of the NASDAQ 100 ETF. So essentially, just rewind right back to before the reciprocal so-called tariffs were announced there. So again, we're just taking back the overshoot to the downside. There is a world in which some of the non-specifically tariff-related mega-cap growth stocks have done enough on the downside that maybe they can act as ballast for this market. Also want to look at semiconductors, some of the biggest winners yesterday because they've really been first into this downtrend. So this is semis, this is home builders. I've been showing these in tandem for a while now because they are these sort of bellwether cyclical risk appetite groups with a lot to say about the underlying economy compared to the S&P. So you see over a 5-year span, this group has still maintained its outperformance even with this sort of mini crash we've had in those. That's what you want to watch to see if basically the risk appetites are being rekindled and maybe semis, which usually are both a cyclical and growth bellwether, can start to do a little more work to help support this market, guys.
You know, Mike, we get earnings kicking off in earnest again with the banks starting up tomorrow and then next week. And it strikes me as unfortunate timing for all those companies that now have to report, because from going and reporting into a tape that was so disappointing and there's so much destruction that was taking place, it was a lot easier of a bar to step over. Now that you've added basically 10% to the S&P overnight, minus today's losses at the open, it's going to be more complicated. They will be looking for more answers, and you're probably going to have to prove a little more in order to keep the street happy at this point.
Probably so. Yeah, obviously, if we would stayed at the lows of earlier this week, then maybe it seems as if anything but the worst news might have helped. Although I still think most stocks are way off their highs. The market has kind of front-run an expected kind of cloudy outlook and maybe poor guidance. So we'll see. The early reporters have not really done well in terms of relative to expectations. To me, it's a matter of not what the analysts have said in terms of the consensus, but what the market has implicitly priced in. That's going to be the game for the next couple of weeks.
Mike, thank you. You've been doing yeoman's work, and we'll continue to watch you through today.
Okay, coming up after this, Nuveen, head of equities and fixed income, Sarah Malik's going to join us. Why she thinks a mild recession is still, though, on the table. And then we are here live in Seattle with a very big interview after the inflation data today. Amazon CEO Andy Jassy will be our special guest. Squawk Box coming back right after this.
News.com.
The fact that the bond market was telling us, hey, it's probably time to move, certainly would have contributed at least a little bit to that thinking. But it wasn't the bond market that made a panic move, because there was a very systematic, well-planned move that was just about to happen that just turned out to be at the same time.
That was National Economic Council Director Kevin Hassett joining us earlier this morning. Joining us now is Sarah Malik. She is Chief Investment Officer, Head of Equities and Fixed Income at Nuveen. And Sarah, I'm guessing you feel a little like the rest of us. I slept through my first alarm this morning. We've had other guests who have slept through their alarms this morning. It has been a lot to follow, to take in, and then to try and figure out what to do with it all. Where are you?
Well, Becky, I always set 3 alarms when I'm on the show, and I'm glad I did that today. I don't think we're out of the woods yet. The Trump put and the 90-day pause did take the worst case off the table, but we're still worried about 3 things. What does this mean for the economy, for China, and also earnings season? So starting with the economy at 10% base tariff rate, plus what's happening in China, that still takes about 1.5% off GDP for 2025. At best, that's skirting a recession. I still think it gets us into a mild recession. And it should add about 1% to PCE inflation. So that's going to tie the Fed's hands. Now, looking at China, the continued escalation there, I think, is going to create noise and volatility for the markets. And it also brings about the worry that we have about bond yields, which have been spiking, which really doesn't make any sense during this period where people are expecting the economy to slow. The worst case scenario there is our concern that perhaps the rest of the world is not viewing the U.S. as a safe haven anymore. And that would be a headwind for equities and fixed income. And then finally, as you were just talking about, first quarter earnings season kicks off tomorrow with banks. I think overall earnings season, about 7% growth is expected, but that's going to be backwards looking. What we're thinking about with the banks is what's going on with capital markets. We expect strong trading, but weak M&A. Is there any risk in the consumer credit cycle? What's the consumer doing? What are loan loss provisionings look like? All of that's going to be important as a forward look from their commentary.
Yeah, that I guess is a big part of the question. I guess we're fortunate to have earnings season hitting us now. It will give us a lot more insight into how companies are thinking about these things. What do you do ahead of that? Do you hold, wait and pause? Anybody who sold last week or earlier this week got punished massively yesterday. But Jeremy Siegel was on with us earlier saying he doesn't expect us to get back to the all-time highs anytime really soon. Certainly not this first half of the year.
I mean, that's the issue with trying to time the markets. Usually investors tend to do it at the wrong time. So we highly recommend, we highly recommend staying invested for these reasons, because when the markets whipsaw, you could never get in early enough to catch something that happened yesterday. While we may have hit the lows for this period yesterday, but I think going forward, we're still going to be in a trading range and very dependent on tariff news and some of these negotiations that we see for the next 90 days. I don't think a strong 7-8% earnings season of earnings growth is going to get us out of this, because we're going to be worried about the earnings slowdown that we see that may be coming in front of us. So for investors, I think, hang in there, keep a diversified portfolio. Hold on to quality stocks. We like areas like dividend growers. These are companies that consistently raise their dividends, so they're well protected during a recession. We like infrastructure companies, which tend to be more economically resilient and are a play on building more in the U.S. And then look at select tech. A company like Broadcom seems very resilient here. AI demand actually looks quite inelastic during this cycle. So in tech, you can start to pick through the carnage with something like Broadcom.
Sarah, you were just pointing out that we're going to be pretty dependent still on the tariff news that comes out. If we were to hear that there were some deals that were cut, maybe with countries like Japan, South Korea, Vietnam, the UK, would that ease concern? Or is it really the biggies between China and the EU that matter, just in terms of what kind of an impact that will have to earnings and to our broader economy?
I think what the last week has told us, and yesterday, is that the Trump administration is increasingly focused on China, and I think that is where a lot of the escalation will happen. Some of the winners are exactly who you mentioned. If China loses, who wins? Areas like Korea could win, Indonesia, Thailand. These could be emerging markets that actually benefit with increasing escalation of tariffs on China. I think a lot of that, though, would be short-term news. So this is why I think volatility will remain high. It was great to see the VIX drop from 60 to the mid-30s yesterday, but I think volatility is going to remain high on all of these data points because we cannot really get a handle around what does it mean for the U.S. economy at this point and for inflation. We can only take guesses here. I think you can run your numbers with a 10% base tariff. You're getting very close to a recession. Where we were on Liberation Day, I think, was pretty clear that we would have gone into a mild, at least a mild recession, probably a deeper recession. And so it's great to see that worst case scenario taken off the table. But it doesn't mean that there aren't some fairly poor scenarios still on the table that are likely to happen because of these tariffs.
Sarah, thank you.
Thanks for having me.
Well, we're counting down to the March CPI and weekly jobless claims. The data due out in just minutes. And then Amazon CEO Andy Jassy on the state of the consumer, tariffs, the company's AI strategy, and much more. We'll be right back.
Universal Orlando Resort.
I think it was.
All right, a call on the auto stocks this morning. Not laughing about this. Other stuff. Goldman Sachs lowering its U.S. auto sales and global auto production forecast to reflect tariffs and weaker consumer demand. The analysts there saying new vehicle prices will rise roughly $2,000 to $4,000 over the next 6 to 12 months to reflect tariff costs. The firm lowering its rating on Ford to neutral from a buy also saying that the headwinds from tariffs as a percent of earnings per share will be slightly lower for GM than for Ford. As for Tesla, the firm remains neutral on that stock, saying that long-term AI-related efforts could offset some tariff costs. Goldman lowering its 12-month price target on Tesla to $260 from $275. Stock's right there at $262 right now. But you can see across the board all of the auto stocks giving back some of the gains that they made up yesterday, anywhere from 3 to 3.7%. Squawk Box, we'll be right back.
Billionaire hedge fund manager Bill Ackman posting on X in reaction to the tariff pause. Thank you on behalf of all Americans. He also posted that the move was, in his words, brilliantly executed by Donald Trump, a textbook art of the deal. And he said, in his words, once again, Secretary Bessent rocks. And I was looking in the rundown to see what was next, and it's your read, Becky, and it's Trump on showers. So I have no idea where you're going with this, but did you read ahead?
I did. I saw what was in the rundown too.
They're good, right? They should be taken daily. Is that?
Yeah, they're talking about shower heads, I believe.
Oh, okay.
That's part of what we're talking about. This was a story that was overshadowed by yesterday's tariff news. President Trump signed an executive order aimed at relaxing rules that limit water flow for shower heads. The order ends water conservation standards that restrict the number of gallons per minute that are allowed to flow through shower heads.
In my case, I like to take a nice shower to take care of my beautiful hair. I have to stand under the shower for 15 minutes till it gets wet. It comes out drip, drip, drip. It's ridiculous. And what you do is you end up washing your hands 5 times longer. So it's the same water. And we're going to open it up so that people can live, and we're going to hopefully have Congress approve it so it's memorialized.
You may have seen this movie before. The rules were first put into place by President Obama. They were rolled back during Trump's first term and then reinstated by President Biden.
I know what he's talking about, though.
So,
especially when this shampoo is in the hair, and I keep shaking. I keep shaking the hair.
Shut it off.
I keep shaking the hair to try and get
Put it back on your head.
Yeah. And
We'll be right back.
The heart. We are live in Seattle, and we are just seconds away now from March CPI data and weekly jobless claims. Take a look at the futures, because we are in the red this morning after powering back yesterday. Dow off about 554 points. Rick Santelli is in Chicago this morning. He's standing by at the CME. Rick, the numbers, sir.
Yes, these are March reads on the Consumer Price Index, coming in under -1/10 on headline, -1/10. We're expecting the exact opposite. We're expecting up 1/10, -1/10. Well, we equal where we were in May of 2020 to find a lower number. Here all the way to April of 2020, the heavy COVID-affected months of the calendar. If we take food and energy out, still coming in on the under, up 1/10. We're expecting triple that number, up 1/10. Well, that would equal where we were in June of last year. To find a lower number would be 0 in January of 21. These are definitely low numbers. Now, let's look at year-over-year perspective, shall we? Up 2.4, we're expecting 2.6. 2.4 would equal where we were in SEPA 24. You have to go to Feb of 21 to find a lower number. Now let's go year over year. Ex food and energy, expecting 3, comes in light 2.8. That follows 3.1. 2.8 would be lowest since March of 21. These are really low numbers. Now let's look at initial continuing claims, shall we? On the initial claims, we're looking for a number that would be roughly in the 224 camp, comes in at 223, very close to expectations. And if we look at the continuing claims, last month they reached 1.903 million, and once again they revise it away. 1,893,000 is last month, and the new number 1,850,000. 1,850,000. That really is a nice drop, and if we want to comp the last time we were at that level, well, it would be the last week of January when we were under 1.84. So that would be your comp. You could see yields haven't moved under in a dramatic way, but I will say there's a bit of irony here considering all the tariff stories on inflation. To see these numbers coming in light for March, well, it's somewhat enlightening. Now, let's go to Steve Leisman for some thoughts as he peruses some of these data points. Steve?
Yeah, Rick, thanks. I'm looking at here this core goods number, which the Fed had flagged as something that they were worried about, which was perhaps a pop that you saw in prior months because of front running on tariffs. That came back and was well behaved. If you look at the commodities, ex-food and energy core goods, it resumed a negative downward move. Nice help on vehicle insurance, was down 0.8%, at least on the month. It's up quite a bit. And you did not get, you went the other way on the owner's equivalent rent, 0.4, not as bad as it had been. You had some pop up in food prices, 1%, 1.3%, and you got an awful lot of help from energy this time around. The key here is going to be, well, this may be the calm before the storm, a lot like the employment numbers. Do you have higher inflation numbers coming through because of some of the tariffs that are out there? Real quickly on the tariffs, the market seems to think it got a lot of relief, and maybe it did. Maybe there's a change in stance of President Trump, but I'm reading a lot of the dismal scientists that say, you know what? There might have been a lot less there than you think. Average tariffs in the country are still very high, even after that relief, much higher than 10%. Wells Fargo just sent me a note. They say the average tariff in America is 27%. I'm seeing numbers 23, 22, and they're still predicting negative numbers on GDP and surges in inflation from the existing tariffs, unless they go away, Andrew, from negotiation. To you, Andrew.
Thank you, Steve. We got a guy who knows a lot about the consumer. We are in Seattle this morning at Amazon's campus in downtown Seattle. We have an exclusive interview with Amazon CEO Andy Jassy out with his annual letter today, and there's so much to talk to you about. Couldn't be more thrilled to talk to you, especially right now. We have the CPI number. You don't focus so much on these. I mean, how often do you look at that number and think this is going to change the direction of my business?
Not that often.
Not that often. But I imagine you do when it comes to tariffs.
We look at all the things that could impact consumers and customers.
So what is going on right now in terms of the way you're thinking about the tariff position? Obviously, the China piece of it is still on, and a huge portion of your sellers and other and manufacturers that are selling through Amazon manufactured in China.
Well, it's hard to know what's really going to happen. You know, there's a lot of flux right now, and what we're going to spend time on, where we spent all our cycles trying to figure out how we have the right customer experience. So we know customers care a ton about selection. We're going to try and do everything we can to keep prices as low as possible for customers, and we're going to ship things as quickly as possible as we can for our customers, and that's what we're going to spend our time focused on.
There have been some reports that you've already started to cut back, though, in terms of buying certain product from China. Is that true?
Well, what I would tell you is whenever you have any threat of any kind of discontinuity, as a team, you have to think about what are the things you can do to help customers. And so we're doing everything we can to try and keep prices the way they've been for customers, as low as possible. And so we'll do things like we've done some strategic forward inventory buys to be able to get as many items as make sense for customers at lower prices. And there are some cases where we have deals we were negotiated that weren't done, where we'll renegotiate terms to make it easier for customers to have lower prices. So we're going to do everything we can to keep prices as low as possible.
Are you seeing, by the way, any pull forward in terms of folks saying, I need to buy? My son, just yesterday, who's been desperate for a new laptop, said, Dad, maybe we got to buy the laptop now because it could cost a lot more later.
You have a smart son. How old is he?
14.
Oh my gosh. I think, again, it's such little data at this point since the first set of tariffs came out, and then yesterday there was a pause. But we have seen, we see people have not stopped buying, and in certain categories we do see a little bit of people buying ahead. But it's hard to know if it's just an anomaly in the data because just a few days, or how long it's going to last. But we're going to do, as I said, everything we possibly can to keep prices low for customers.
Who is going to eat the cost, though? Because I think that's one of the big questions. How much can get passed on to the customer? How strong do you think the American consumer is right now? And how much of it gets eaten by Amazon? How much gets eaten effectively by potentially a third-party seller?
I think we'll have to see how it all plays out. But if you made me guess, I'm guessing that that sellers will pass that cost on
fully.
I think they'll try, and I understand why. I mean, depending on which country you're in, you don't have 50% extra margin that you can play with. So I think they'll try and pass the cost on. And as I said, it's so early right now, but we haven't seen any change in consumer behavior in a meaningful way yet.
Is there any change in terms of your own behavior, meaning the company's behavior? And one of the things you're doing is building data centers, for example, and having to invest heavily in that space. Obviously, there's component parts that are coming in from China and all over the world, and how you think about that, for example.
Well, every finished good that's got any degree of complexity in it has parts from all over the world, and that's been true for a while. And actually, in our AWS business, really starting about 5 years ago, we very significantly diversified our supply chain, and so we have components that are from everywhere. It's not just one country. But we have such high demand right now for AWS, and the AI growth is so significant that we don't see any attenuation in demand, and we're going to keep building.
And so it would be depending on what happens with the tariffs, there'd be no change to that view.
I don't see us attenuating our building data centers right now. We have very high demand.
Can I ask one related question on terms of data centers? One of the other sort of major shocks to the system, it was now a couple months ago, was the creation of DeepSeek, which was this new large language model that people thought was remarkably more efficient. And there was this view among some that said, maybe we don't need all of these data centers, or we're not going to need all of this processing, as much processing power and as much energy as some had forecast. Did it change your forecast at all when you saw that?
No. I mean, in some ways, we would like nothing better than to make the cost of AI meaningfully less expensive for customers. The cost of AI today, because of the chips and because of the cost of inference still, even though the cost of inference has come down several times, but it's still more expensive than it should be and than it will be. And then what you need for companies to be able to deploy AI as expansively as they want. And so when DeepSeek came out with this model, which people were excited about, it felt like it cost less, it felt like the inference was less. I think if you're building frontier models like we are as well, you're all working on a lot of the same types of problems, and you're going to see all this leapfrogging. You have seen all this leapfrogging every month, and you'll continue to see that. But for me, the lower that we can make the cost of AI, the more customers are going to use it. And I think people get confused. I saw this in the beginning of AWS too, which is customers love when you take the cost per unit of something down. It allows them to save money on what they're building, but they don't actually spend less. It actually unleashes them to do a lot more innovation, and in absolute, they spend more. It's the same thing when we started AWS. We pretty significantly changed the cost of compute and storage and database. Customers loved it, but they actually spent more on infrastructure because it allowed them to build more for their customers.
But that's the thing you talk about a lot in the letter, bringing down the cost of compute when it comes to AI. And obviously, you also make an allusion, I don't think you use the word NVIDIA, but I know there was maybe a friend of me, partner, and a competitor at the same time. They have controlled this marketplace for a very long time. What do you think has to happen to bring the price down? Because I assume that's going to come from you and AMD and everybody else who's going to try to do this. But how quickly does that happen?
It is going to happen. I mean, first I would tell you that if you sat in the meetings with the AWS team right now, they feel like it's their responsibility and their mission to make the cost of AI meaningfully less for customers than it is today. And I think there are two big drivers of it. One is the chips. And, what's interesting is most of the spend today in AI has been on training, these giant training runs.
Right.
But when you get to scale of the production applications for AI, it flips. And the overwhelming majority of the spend is actually on the inference, which are the predictions from the model. And so the two things that have to happen is the price performance of chips has to be meaningfully less, and that's part of why we built our own chips. We have our own custom AI silicon called Trainium 2, where the price performance is 30 to 40% better than what's out there in the current GPU instances. So we're working on trying to take the cost of chips down, and you have to take the cost of inference down. And that has to do with a whole bunch of things, including techniques like distillation and prompt caching and how you handle different model architectures. So it's both the chips and the inference. They both need significant cost decreases, and we're working hard on that.
One related AI question, which is, last time I think I talked to you maybe a year or two ago, there was a different administration in Washington. We were talking about the possibility that you would consider to buy a company like Anthropic or something like that. You were in the middle of the iRobot situation, and it didn't seem like any deals could get done. In this new environment, do you say to yourself, maybe there's acquisitions that we could make and maybe buy an Anthropic?
We never stopped trying to do acquisitions that we thought made sense for our customers and the business before. But I do think that it's possible that this environment will be a little bit easier to start to acquire companies. We'll have to see.
In the letter, you do talk a lot about the consumer. You talk a lot about the culture at Amazon, about trying to bring down prices. You just said you thought that, and you talk about how optimistic you are. You've seen no change in the consumer at all in terms of what they're buying. I mean, we've had conversations over the years where you've said, you know what, actually, I see people going from bigger screen TVs to smaller TVs and other things like that. Is there no shift right now in terms of what the consumer's doing?
I'd say not a lot in the last. I mean, over the last couple of years, off and on, as we've talked about, customers have gotten more careful.
Right.
And they're whenever they can trade down on price, they do. Wherever they can find a bargain, they do. We've seen significant growth on discretionary items, but not at the growth rate we typically see as people have just been careful. And so that trend has continued. But as I said, we haven't seen meaningful impact yet from all the noise around
But are
the
you
tariffs.
thinking there is? I mean, we've heard from, I think Walmart around guidance. You heard Delta talking about how they think that I don't know if it's a slowdown, but not going to grow as fast. We heard Warner Brothers, I think, is worried a little bit about advertising. I know you're in the advertising business. What does this feel like?
By the way, I completely understand why they made, companies are nervous right now. And it's so early, you don't know. But the worry, of course, when you have things like tariffs, is that it'll create macro issues where, it depresses demand or drives inflation. But we just haven't seen it yet.
Have you either been in Washington yourself or had your team in Washington talking to this administration about all of this?
We talk to the administration all the time.
And what are you telling them?
We talk about a broad number of issues with the administration all the time. And so, we share with them different, things that we think matter to consumers, things that we think matter to enterprises. We have some conversations about tariffs as well, and we share what some of the concerns are, and they're aware of them.
One of the things you talk about a lot in this letter is sort of the management and culture that you've instilled in this business over the years, and how long you've actually been at this company. But one of the things that you've talked about is this idea of why. That every question starts with why. Why are we doing this? And why? It sounds like really the question is not why are we doing this, but why can't we do something?
Mm-hmm. Yeah.
What is the new right now? Is there something that you're looking at where you're saying why can't we do something?
Oh, I mean, we have so many why questions all the time. I mean, we have this concept inside of Amazon of one-way and two-way door decisions. And a two-way door decision is when you make a decision, and if you get it wrong, you can walk back through that door with little harm. One way to our decision is when you walk through that door, if you get it wrong, it's pretty tough to walk back through it. And so both those constructs, though, assume that the doors are unlocked.
Right.
And when you're trying to invent, you're often trying to, you're actually trying to unlock a door that seems previously shut tight. And so a lot of times, why is the question that starts to open up that door. And we're constantly asking ourselves why questions. So today we're constantly asking, why can't we ship items to customers even faster? You know, why can't we ship items to people who live in rural parts of the country who don't have, you know, it's much harder to get items same day or next day in rural parts of the country. And most of the logistics providers are actually stopping investing in rural areas, whereas actually we're increasing our investment. You know, why can't we give broadband connectivity to people in rural parts of this country and around the world? You know, why does AI matter so much, and why do you have to invest the way that we think we should right now? We're asking lots of why questions.
I'll give you a why question that some investors ask. They say, why necessarily go down some of these roads which might eat into margin, right? Yeah. So one of the questions is, if you were to be able to get stuff faster in rural areas, I assume the cost goes up, or do you think overall it makes the business better?
I think there's no question it makes the business better. And for us, what we're after, and we've talked a lot about this over the years, is we're trying to make customers' lives easier and better every day. And we're not trying to optimize how we do as a business in any one quarter or any one year. We're trying to build a business that outlasts all of us. Right. And when you're actually, what we learn, I get asked this all the time, and we get asked this a lot, which is, haven't you reached the law of diminishing returns on speed? Like, isn't it enough at this point? And I can tell you definitively from the data that it's not. We have not reached that point. Every time we're able to show customers on a product detail page a delivery time that's faster, they actually choose to buy more frequently, and they actually they spend more of their purchasing power on Amazon and make more of their purchases with us when they know they can get it reliably and quickly. So, you know, I think that in any short period of time, as you're quickening the pace with which you deliver, you may have cost increases. But if you innovate the right way and you build the right infrastructure and the right architecture, you actually can relentlessly take your cost to serve down, which we've done over the last several years. And we're very confident we'll be able to do that in rural areas as well. They deserve to get products same day.
Question on cost to serve, or maybe it's cost of everything. When you think about employment at Amazon, one of the things you talk about in your letter is this idea that you want everybody back in the office. You've been a big proponent of that and how successful that's been. I'm curious, though, with the advent of AI and everything that's going on, and you look at how many more people you want to hire in the future, or maybe how many you don't need to, what does that look like in this new world to you?
I think it's so early right now with respect to AI. You know, you're starting to see companies employ it in a really broad way. And they're going to, you know, like everything else, as technology evolves, certain jobs become more important. Other jobs that you used to do with people, you do in an automated way. But we have found over many years that human beings find other jobs to do that are the ones that get automated by AI. So I think we'll have a lot of people for a long time, but they're just going to be working on different things.
I want to pivot back to the news, a different piece of news. You made it a couple weeks ago, which is that you're bidding now for TikTok. Give me the why behind that.
I don't think we said that.
Did you not say that you were one of the bidders for TikTok? It's just been reported that you were
Yes.
one of the bidders for TikTok? Okay. Well, can you give us the rationale for bidding for TikTok then?
Oh, well, you know, we have a long policy, as you know, Andrew, we're not commenting on M&A rumors, so I'm going to stick to that policy.
Okay, let me ask you then a slightly different question. You don't need to comment on whether you're bidding for TikTok or not. Do you think that TikTok should be part of the question, part of a chess piece in this tariff conversation or not? Because I think there's TikTok has always been a question about national security, but it now is also being sort of brought into this tariff discussion.
I don't know. I mean, I think the conversations that the administration is having, probably was having before and more intensely is having now with each country, are complicated. And I imagine that each have their set of variables. And I've read that this may be one of the pieces in that negotiation, but I'm not privy to it.
if this doesn't work out being a politician, Mike. So it's a good answer. Let me ask you about a couple other pieces of the Amazon business. One of the sort of next legs of the stool for you, if you will, is Kuiper, which is the satellite business. You're putting up a satellite, you believe, this year. It's finally going to happen this year.
We're starting to put satellites in the air this year.
What's that going to cost, and how quickly do you think that becomes competitive, if it does, with Starlink?
Well, I mean, I just start with the need. There are 400 to 500 million households around the world who don't have broadband connectivity. So they can't do things that we all take for granted, like education online or shopping or watching entertainment or doing business. And then there are all these enterprises who have assets in remote locations that they need to communicate with, they can't. And governments need that visibility. And so there is a high need for it. We will have our low Earth orbit satellite. We'll have the first set of satellites up in 2025, with more coming in 26 and 27. I think that people are going to really like the offering. I think that it will have an advantage price point for customers in those three segments. I think they'll like the flexibility and the price point of the antennas. And then if you think about it, we have at Amazon, we have in the three segments that are going to consume this product, we have a lot of relationships with consumers, a lot of relationships with enterprises, a lot of relationships with governments, all of whom are excited about this, and they're particularly the commercial customers, enterprises and governments, are going to want that data to come down into the cloud.
The first real competitor, Starlink.
Yeah, I think people are going to really like the offering, and I think they're going to like the connection between Kuiper and AWS to be able to analyze that data and do computing and AI ultimately, and so very optimistic about it.
How many of the satellites end up going up on Blue Origin? How many end up going up on SpaceX? And is that a concern for you, given that you have to rely to some degree on Elon Musk to get some of this in the air and then compete against him?
Yeah, we have 4 rocket providers, and all those rocket providers, they're very professional. You have contracts for a reason, and I would say that we have more in absolute going up on Blue Origin than we do maybe in SpaceX. But we have 4 providers, and they're all going to be an important part about getting our constellation into orbit.
Right. 2 other pieces I want to ask you about: Video Prime, and want to talk to you about pharmaceuticals for consumers, because you mentioned that in your letter. Is that the next? Is that the next big leg of your stool? Meaning getting into healthcare in a big way. You've been talking about it forever.
Yeah.
I just don't know if you think there's been some kind of unlock that's happened in the past year.
I think if you look at our Amazon pharmacy business, it's really growing very substantially, and I think that there are a couple of reasons for it. First, if you look, I don't know if you shop in the pharmacy, it's a pretty awesome experience, but the team has done an amazing job the last 2 years or so in changing that customer experience. It's so much easier. You have price transparency. A lot of times you go to the pharmacy, you don't know what something's going to cost. You get to the counter, you can't believe it. And so the experience is better. The delivery is much faster, and then I think people have gotten used to buying their pharmacy items online. If you don't feel well, if you can get it same day, we can deliver same day now in lots of cities around the U.S. If you can get it same day and you can get it actually in a few hours, it's a huge advantage if you don't feel well.
How much are you spending time thinking about tariffs as it relates to pharmaceuticals? Because that's something else the president's been talking about.
Again, it's hard to know where the tariffs are going to settle, but wherever they settle, we're going to do as much as we can to keep prices low for consumers.
What's going on in terms of video for Prime? You've been investing heavily in sports. Does that mean you're going to invest away from some of the drama and comedy? What does that look like over time to you?
I think it'll be a mix. I think what there's a reason why something like 95 of the top 100 rated shows every year are sports. It's kind of the last appointment only viewing. And we've learned it with Thursday Night Football. It's been really successful for customers and for us. And we have the NBA coming in 2025. We have NASCAR coming in just a few months. And so sports has been very successful. I expect we'll continue to invest more there. But we'll continue to invest in shows. I love the new season of Fallout, the new release, and Reacher and The Boys. I think the content continues to get meaningfully better.
The economics of that on a standalone basis, would they work, or does it only make sense in the context of the sort of larger Prime package?
we started Prime Video as something that we thought customers would love and would be very attractive in Prime and would help, convince people to decide to pick up Prime. And then what we find is when people start Prime via video or for video reasons, they actually end up spending downstream in our commerce business, our e-commerce business. But what we have over the last few years with some of the changes we've made and as the business has matured, we actually think Prime Video will be a very good standalone business as well.
Any shows that we need to watch? By the way, First Lady. You have a documentary with the First Lady. How did that come about?
Yeah, there was the people making it shared it with a number of folks. We thought the show was really interesting, and we were fortunate enough to earn it.
Do you think you'll end up getting into the business of news? The reason I ask is you did that broadcast the night of the
Yeah, it was an experiment, and actually it was a really successful experiment. Customers really liked it. I don't know. It's something, it is something that people watch very frequently, as you well know, and we'll have to see.
Okay. Andy Jassy, it's great to have you. It's great to congratulations on the letter, and great to have you on a day like today when we're all trying to make sense of these tariffs, and we hope to talk to you again as all of this plays out. So thank you very, very much. Appreciate it. Guys, I'm going to send it back to you. Squawk Box will be back right after the break.
Insurance.
A quick programming note for you. Tomorrow, a first on CNBC interview with Minneapolis Fed President Neil Kashkari. That's tomorrow right here on Squawk Box at 8 a.m. Eastern Time.
Let's check the markets. You can see that we do see a little give back. We're down 500, but that's still up 2,400 from yesterday, but still down a couple of hundred from a week ago.
Where we were before this all began.
Make sure you join us tomorrow. Squawk on the Street is next.
Thursday morning. Welcome to Squawk on the Street. I'm David Faber with Jim Cramer. We are live from Post 9 at the New York Stock Exchange. Carl's on assignment. Let's give you a look at futures, of course, after that historic rally yesterday. In the afternoon, we are looking for a down open, perhaps a fairly significant decline when stocks do begin to trade a half hour from now. Our roadmap does begin with that tariff turnaround, of course. And as I just said, we may see a bit of a give back of that historic gain. This after the president reversed course and instituted that 90-day reprieve, at least on some of the global tariffs that were in place for a very short time. We're going to talk with the latest, with one of Trump economics aides, the chair of the White House Council of Economic Advisors, plus the fragile outlook for technology. Apple, mega cap names, they had huge gains yesterday, but Amazon's Andy Jassy telling CNBC there remains to be a, quote, lot of flux right now. And I might weigh in on U.S. Steel, although frankly, I got nothing to tell you there, other than what the president said. We needed something. We needed something for the third item on the roadmap. And you got to have 3 items on your roadmap.
Is that what it is?
Yeah, every day. Got to have 3. All right, let's get back to number 1, which is the market. So here we were yesterday, all about the bond market, of course. Right. The last 2 days, in fact, we really were focused on that 10-year, and rightly so. Totally. It does appear the bond market gave power to Scott Bessent, perhaps our Treasury Secretary, when he walked in and said to the president, and I don't know what was said, but hey, you may want to think about reversing course here. The president actually later in the day yesterday indicated he'd been thinking about it for a few days. And then we saw a day like the likes of which we haven't seen in a very long time.
Well, David, the word that I kept hearing about is failed. That it would be a failed auction.
It wasn't.
It wasn't.
No.
And therefore, it was a save. Once that save was made, in part because what the president did, you overrun what was the easiest trade of the year, which was to short Mag 7, short technology, short semiconductors, and everything reversed. Now see, today, if you're short, and the shorts are more or less the motif, they're feeling good because it's down, but they're going to cover. They're going to cover because they got hurt so badly yesterday that their bosses are saying, we want your book smaller. That's historically what happens in these situations. So you may see all these down, but they're not going to go back to where they were because we're building in estimate cuts for everybody. And once they're all built in, then it's like 87. They're all built in, then you got to start figuring out who is building 2 up.
Right. All right. So, are the expectations now, what is the playing field? 10% across the board tariffs and then a trade war with China?
Right.
Now we got 90 days. So right after the July 4th weekend, we may get a lot of focus on what's going to happen, or perhaps we'll have something occur in these next 90 days, given the potential for negotiations with a lot of those trading partners.
Correct.
But what does that world look like? 10%. Let's assume it's just 10%. Right. We stick with that, nothing else, and a continued trade war with China.
Well, we don't. Look,
we don't know.
We don't know, and we don't do all that much business with the 10%ers, except for Vietnam. But that's 100. That's that 100 billion versus
it's a 10%.
India.
It's a 10% consumption tax on basically everything that's bought here that comes from somewhere else.
Okay, so
except from China, which I can't imagine we're going to get much of anything from there.
No, that's an embargo. That's a trade embargo.
Right.
And I think that we have to use that term. We should not be using high tariff.
Yeah.
That's a trade embargo. And a trade embargo means you don't buy anything from them and they don't sell anything to us.
Are there things, I don't want to take us too far afield, but are there things that are absolutely necessary that need to be bought from China? I mean, I think rare earths, but are there other components perhaps that nobody else makes that we're going to hear about that you have to buy, and therefore price of whatever they go into is going to go up a lot?
Okay, so maybe some from Micron. But the amazing thing is that while we make a lot of shoes there that didn't switch to Vietnam, and we have T-shirts, and we have low-end stuff that goes to Walmart, some of the very smart tech companies moved out. They moved out in 2018, and they moved out in 2020. And so the supply chain problem that I thought was initially going to be the case is not. And if we go look at, say, Broadcom notes, you and I think the world of Hock Tan, he shifted a lot. He made it so that they're not nearly as endangered.
Right.
The guys that are really difficult to figure out are the ones that are wrapped in. So Taiwan Semi stuff goes to NVIDIA, and then maybe NVIDIA stuff is wrapped into a rack that actually is covered by a tariff.
And that comes from that region.
Right. But I think that,
at least 10%. By the way, you mentioned Taiwan Semi.
Yes.
No let up there, 46.5% revenue increase. That we haven't gotten all the numbers. We simply got the March 2025 revenue report. You can see the shares of Taiwan.
Okay, so now let's get in the heads of people.
Down a bit.
Get in the heads of people who are short those. Okay.
Yeah.
They're short those, and the bosses come in. They say, "Why did you short ARM Holdings?" And the answer was because it's going down. why were you shorting Micron? Well, Sanjay Mehrotra said that business a little tempered by tariffs. And the boss says, are you an idiot? Is that all you have? Well, there was going to be a failed bond auction. Well, did it happen? Well, Peter Navarro said that all these are going to go down. Well, did Peter Navarro win? Howard Lutnick, it's a great day for America. I didn't know that. It's a great day for the longs, bad day for the shorts. So what I'm saying is that you look at those and you're short and you're saying, I got a chance to cover Micron at 74. I got a chance to buy Broadcom at 177 before Hawk 10 comes in with this $10 billion buyback that's going to expire by the end of the year. So, David, what I'm talking about is that it's a battle between longs and shorts.
Yep.
And the shorts are trying to keep their jobs after being victorious for so long. And the longs are reveling in what happened here because the 10%, except for, of course, what you talked about, which is the embargo. And the embargo is Andy Jassy. And Andy Jassy's saying, you know what, we're going to just go out of stock for some of this stuff.
Mm-hmm.
Now, yesterday's, I don't know if you got to listen to Walmart.
Yeah.
It was almost as if...
You mean the investor day that Walmart had?
It was so business as usual as to be soporific. It was very hard for me to get through. And midway through, my wife said, when are you going to go to bed? I said, I got to finish this thing. I'm almost on Sam's Club.
Well, it was a good way to actually prepare for the 3 hours of sleep that you typically get.
Well, last night I got up very, very early because I wanted to see the futures.
Yeah.
And, you know,
like every hedge fund
it was just the shorts banging down. And
well, they usually wake up right. It's futures or when Europe opens, you got to wake up.
Well, I used to train Japan all the time. That's where I started with the 2 o'clock stuff.
Yeah.
Remember when they told you we're taking up Tokyo Electron tonight? They gave you a heads up.
You know, Jim, I still want to come back to the broader landscape right now. I talked to a couple of CEOs of major companies this morning, and they're not seeing a pullback yet, but they're preparing for one still. And of course, the key question is, what's consumer sentiment?
Right.
What is it going to mean for people in terms of their spending patterns? What are advertisers going to do? Let's say you're an advertiser and you're starting to see some supply chain disruptions.
Right.
Do you pull back from what you're doing?
Every single note on the mat.
Certainly, I think yesterday you and I would have sat here and said what we're hearing from most of the people we speak to, and I know this because we expect a recession. Jamie Dimon saying something similar. Goldman Sachs at 105 put something out saying we see negative 1% GDP, and then of course we got the change in policy.
I felt so bad for him.
It was just
think
poor
about
timing.
That.
My question is
that Hatches was using a negative number.
Yes, negative 1%, I think.
And then boom, we got this, and then he was using a positive number.
Yes.
I mean. We now revert, and this is a note from him. We're now reverting to our previous non-recession baseline forecast growth of 0.5.
Right.
And earlier he had said that it was going to be negative. Now, what does that say? Hatzius is a seasoned practitioner. He is no joker.
No.
And he had to reverse himself. So he's a rigorous person who had to reverse himself.
Yeah.
In the face of an announcement by a man who later said that we can go back to the way we take showers. That we can have the more pressured showers.
That's a big deal, the water pressure.
Well, no, what that says is we're on to business as usual. Let's just go against Sleepy Joe Biden once again, because that's who made us change into the we need to change our shower. Now, the reason why I mention this,
why are you mentioning
other than Jolie, which is our largest advertiser,
yes,
other
we
than
love that
people who want to sell their life insurance and get whatever. I mention it because it's called a diversion. Like here, we're supposed to speak about this, but then the American people at home, particularly those who watch Fox, they're saying, you know what? Thank heavens we're getting that shower head back. They're not talking about the change from recession to no recession. There are two countries. One part of the country cares tremendously about shower heads, and the other part cares about recessions.
Right.
And you know what? The other part cares about recessions. Sometimes I feel that's the Democrat part.
I agreed. I think we are still very much uncertain about the true impact of a nasty trade war with China, which we are in the midst of right now, or whether they will begin to negotiate and whether we end up in a much better place.
You can have any gift wrap for Christmas? All gift wrap's made in China.
No kidding.
So maybe we use craft paper.
Yeah, we get back to craft paper.
It's made in America.
Maybe we make our own paper.
Yes.
Yeah, we can do that.
Well, we don't really know how, but we can learn. Ben Franklin.
We can learn so many things.
He was inventive.
All right, maybe we'll learn a little bit more right now because we are
going to actually turned out to know how to make things again.
We do make plenty of things. Manufacturing output is double what it was in the 1970s.
I lived in next to the largest softball factory. And next thing you know, people were saying, can I please clean your house? They closed the softball factory. That's America. Let's go to work.
Let's go to work. The latest read on inflation showing consumer prices coming in lower than expected. By the way, we didn't get to that. Glad we mentioned it. Easing to 2.4% in March. Obviously, none of that includes the impact of potential tariffs. The latest data does come after President Trump issued a 90-day pause on tariffs on dozens of countries, while China's tariff is now 125%. Let's bring in the Council of Economic Advisors Chairman Stephen Myron. Good to have you this morning, Mr. Myron.
Good morning. Thanks for having me.
You're welcome. You know, I'd love to get your take in terms of the likelihood at this point of sort of a slowdown, if not a recession. We speak to CEOs all day long, both on air, but more often off air when they're willing to actually share some confidences that they don't want to share publicly. And I certainly would say the last week or so, there's been a lot of concern. Do you think that the change in policy is going to mitigate the impact, perhaps, of a potential recession?
Look, you know, I never really thought that we were credibly heading for any sort of meaningful recession. And you guys yourselves, just a few minutes ago, mentioned Goldman did a pretty quick U-turn on their recession forecast. And I think lots of people have underestimated the fact that President Trump is a pro-growth president. He's a pro-healthy economy president, and he always has been. And so what's happened over the last few weeks is that financial markets are prone to excessive volatility, and that has always been the case. Nevertheless, that volatility itself can have really unfortunate economic knock-on effects, really unfortunate economic side effects. And so what the president and his team have done is to buy time to create very great trade deals that will be very intricate and do enormous things for the American economy and American workers, and to create time to make those trade deals. And we've got dozens and dozens of countries banging down the doors wanting to talk to us, wanting to create those trade deals.
Right. Don't mess with the bond market, perhaps, is one of the lessons that we learned over the last few days. Of course, many of us were aware of that previously. What are your expectations when it comes to these trade deals? You know, we sat here trying to understand what is the landscape really going to look like. Are, you know, American consumers and companies and everybody else importing say, all right, it's going to be a 10% across the board tariff. That's what we're going to live with. And basically nothing coming from China. Or do you think things are going to change dramatically over these next 90 days?
Look, the president has been pretty clear that what he wants is for other countries to remove their non-tariff barriers and their tariffs that prevent American exports from being as competitive. And so what I think we want is a situation in which American exports can go to the rest of the world, and we can trade more with the rest of the world. And it'll be great for lowering the trade deficit, it'll be great for the American economy, it'll be great for American workers, and that's what we want. But you mentioned the bond market, and I think it's also important to understand that the bond market should be further, further happy that the inflation data came in so positively today. I mean, so tepidly today. The core inflation print, which is inflation, stripping out volatile things like food and energy, that core inflation print on an annual basis was the lowest core inflation print since March of 2021. So President Trump's policies are working at keeping inflation at bay, keeping inflation down, and between that and what's going on with trade, America's back.
Well, America never really left, sir. It's Jim Cramer. I know that the CPI was good today, but we know that there is a bump in prices coming. Notice I did not call it tax, because I'm not going to get into politics with you. But there is a bump in prices. We all know that. Won't that extend to the CPI just logically, empirically, and rigorously?
Look, today's CPI report wasn't just good; it was really great. So if you look at some items,
about the future. I love this number. This number was better than you think. I want to talk about the next number.
No, that's fine. I'll get to that in 1 second. I just want to say one thing about this number, which is that it's so good that if you look at prescription drug prices, they fell 2% in March. That's the biggest decline on record. Now, so this was not just a good number; it was a fantastic number. But if you want to talk about the future, we talk about the future too. And I think that it's important to understand that the cost of the tariffs is ultimately borne by countries that we're tariffing, and that's because we can reallocate our demand across borders, whereas countries that have factories sitting there, they can't move those factories. And so that means that the cost of the tariffs are borne by countries that we're tariffing. And so in the short run, can there be bumps? Can there be volatility? We saw the volatility in financial markets. That's absolutely the case. Can there be volatility in other prices too? Sure. But in the fullness of time, American consumers have the ability to shift their demand patterns across borders, whether that means bringing demand home to home producers, or whether it means shifting demand from countries that treat us really poorly to countries that treat us really well. And the president's trade policy will accelerate that. And so the fact that we're flexible means that we'll avoid bearing the burden of the tariffs, and the countries that we're tariffing will bear that burden.
Well, let's talk about building a factory. Eli Lilly built the fastest factory I've ever seen. It's a North Carolina factory in Concord. It was supposed to take about 5 years typically. They did do it in 2.5 years, but they're a pretty well-run company. 2.5 years is record time, sir. What are we supposed to do in the interim?
What we're supposed to do is accelerate the deregulation process. And as I said before, the president has always been a pro-growth economy and the president's a pro-growth president. And he's determined to create a healthy economy and the strongest economy we've ever seen. So what we have to do is we have to get the regulations out of the way so that people can build those factories faster. It shouldn't take years to do environmental reviews before you build a factory. You should be able to break ground. And so what we need to do is to create a situation in which firms can really build those factories much faster. Coupling the deregulatory agenda with the president's approach on trade is exactly how we get to the new golden age.
All right, I got an idea. You talked about pharma being down a couple percent. That's terrific. There are people in the administration that want very much to put a big tariff on pharma. Why don't we get a commitment from you that says we're going to keep prices down and that there will not be a big tariff on pharma? What a great time for you to be able to make a little news and just accept the fact that that's what has to happen. Can you kind of assure us that we don't raise prices, a tariff on pharma?
Yeah. So look. So I'm an economic advisor, so I can't make any commitments. I certainly can't get ahead of the president. Sorry?
Probably have some insight.
Well, I have some ideas, and I'm very happy to share those ideas. As
You have some ideas.
Advisors. But I can't commit the president, and what I've said is the president is determined to create a situation in which American workers, American firms are in a fair ground vis-a-vis foreign workers. Foreign countries, and he's also determined to create improved national security and resilience in supply chains that are critical to our national security. Nobody wants to be in a situation where there's some sort of emergency and we're dependent on importing pharmaceuticals or inputs to pharma from China. That's just a bad situation that you don't want to be in.
Well, right now I think 90% of all the active ingredients in antibiotics come from China. Not quite sure what we're going to do about that. No. I mean, that's not, do you expect that there'll be any trade whatsoever between our country and China, given the 125% tariff and the 84% tariff they have on our goods?
Look, the president is just absolutely famous for his negotiating skills and for pulling deals out of a hat when nobody thought it was possible. Nobody thought the Phase 1 China deal was possible in 2019, and yet the president delivered it, and it was a great deal for Americans with protections for intellectual property, protections for market access, protection, the commitments for China to buy agricultural commodities.
Yeah, that they didn't follow through on, of course. Yeah, they didn't follow through on many of those agricultural commitments.
And the Biden administration failed to enforce any of it. China walked away from it, and the Biden administration let them walk away from it. So the president is famous for his ability to create deals, and nobody should doubt that if anyone can pull something off here, it's him.
All right, Chairman Myron, look forward to future conversations. Obviously, short on time today, but certainly appreciate your time.
Yeah, short on time.
Didn't
want to hear what you wanted to hear, did you?
We're on track for a lower open. This, of course, after that historic rally yesterday. Let's give you a look at futures. We get ready. We start trading about 11 minutes from now. A lot more Squawk in the Street straight ahead for you.
Good morning, retail traders. Mic check. Mic check. Mic check. Magnificent. Mic check.
All right, take a look at futures. Of course, we are expecting a lower open. By the way, tomorrow, don't miss it. Larry Fink from BlackRock will join us. I believe right here on set. I think I'm right in saying 9:30 a.m. Okay. Jim, you got a Mad Dash getting ready for your big Mad Dash?
Are you kidding me?
All
I'm
right.
like all over the game.
We also going to get
Chiefs
talking about the
take my shooter.
AI trade. A lot of commentary around data centers that we've gotten this morning. Want to get to? Don't go anywhere.
I'm going somewhere because I can't stand y'all.
Essentially possible.
I didn't like your negativity again this morning. I'm going somewhere. Whoa! Sounds like the mic's working real well. A day's a whole lot worse. So I'm going to go into the kitchen and I'm going to prepare myself my morning coffee. Decaffeinated, of course. I believe that the SPX will open right around 32.22.90 free. Right there. That's what I'm thinking. And the SPY support is 523.41. Like, it's going to be a day. A great day that is. Mamma mia, Papa Pia. Well, after a day like yesterday, I don't want to overdo it today. I have a tendency of getting all excited after a good day, and I just don't want to do that. So I'm going to be buying time like Trump is with the tariff deals. I'm going to go into the kitchen. I got 3 minutes to get this coffee made, and I'm going to do it right now. And I need to take off my shoes too. Ready to open here. We got 3 black crows. Prepare ye in the name of the Lord. Shoes are off. Slippers, slippers, slippers. Where are you? And we're off. We're at support right at open. The one that's already been created. Let me see here. Let me see where SPX opened up. Yep. Boy, I was close. I was very close. Well, I should have thought about that 200. I didn't think about that. That would have been perfect. Dang, I didn't think about it. No, I did not. Okay. 10th. Options are a little cheaper, but not cheap enough. Looks like some of them are buying the 550s. We'll just see if we hit my support here. Could go just a little bit lower. Now that I see that body right there. I had a real nice dinner last night. None of you saw it, I'll repost it. Expensive, but nice. Today's the 10th. Oh God. Yeah, see the strike, the calls on SPX are expensive. Would have to go all the way to 55.50 or 5500s again. Amazon. Banks are tomorrow. So we got a little bitty bounce here on the 5500s. Right now we're at support. Just give it a little bit more time. I think I can get it cheaper. Not much. think it's getting ready to squeeze. $7.40, $7.30, $8.30. I mean, these are the 5500s, ones I'm watching right now. Okay, we're getting right here, right about in here. There's $8. This is my first scout. I got $7.90. This is real risky, so the risk level is very high. If we can break the 200, we'll run it up to the 2 SMA. If not, I'm going to stop right out of it. There it is, 7. Oh shit. 7:30. Oh, it didn't take long. Bastard. Okay, I'm at my support. We'll find out for sure now. Oh, you already got out? Dumbo didn't. We'll see if we can hold here, but come on, baby. I need you to run. I need you to run. I got 1,500 in this one. Okay. $8.30. $8.70. I'm going to get out of this thing too. I don't know if we're going to break that. Oh, come on. Give me as much as I can take. 860. All right. $9. Whoa! Out. Okay, I got my first trade out of the way. Um, $55.50s. Okay, I'm debating on getting back in here at the 55.20s and the 55.50s, or the 5500s. We got a double bottom. I'll stay right where I am. If we get a doji right there. Ladies and gentlemen, $6.50. Uh-oh. Things seem a little bit bearish. $6.50 and $6.10. $6.10. I mean $6. There's $6 right there. What? What's Sky got to do with anything? Risky. Looks like baby steps today. Well, we got Fed speakers today. Fed speakers today. We got Fed speakers today. We're at 7:40. I think it's going to be that kind of day today. Their Biggs the Best is here today. $7.70. Prepare ye in the name of the Lord. $8.10. If you're in this trade, think about profit taking. Boom a check. That's what happens when you make a business decision. That's what happens when you make a business decision. $8.10. Did anybody make a business decision? Because that's how you do it. That's how you do it. Hey. Keep going, baby. $8.40. We are at the 200 EMA for an exit idea. I don't know how he does it, but his name's Washboardjim. I had a girl one time said, Jim, this is 15 years later, I had a crush on you in high school. I said, what? And you didn't tell me? I was too shy. I said, what do you mean? You were a cheerleader. I would have sucked my right nut for you, baby. I got another A plus from Richard. Magnificent. You're slacking, buddy. 2 beach trades out of the way. So when we hit the 21, Richard, the EMA, and if we'd have broke that, that would have easily gone up to the 200. So that was a double top. No, what's a double top? A double top is a exit idea that we could pull back and find some kind of support. Encyclopedia wrote by Washboardjim. How in the hell does he do it? I don't know. Hey June, where are you now? Dude. Oh, how long's that been up there? Okie dokie. So we had a double top. We hit the 21 EMA. '21 EMA. Now we're retesting the head and shoulders, and we came back to that first support. And we got Fed speakers today. After a day like yesterday, I would be a little bit careful today, Joshua. We could consolidate, and if we consolidate off these Fed speakers and not tank, I think that'll bring us a good Friday. And we need China to come to the table. And that would be another huge catalyst for this market to run. They're going to have to. The Chinese are have a lot of pride. So you got to be careful. It might take them a little bit of time to come around. But if they get a little pressure from the world, it might be a different story, unless they think they can do this on their own. And we love the Chinese pipas, especially the women. I ought to send a message to Dan and see what she thinks of us Americans right now. Say, baby, what's up? Mike, get ready. You think we're going to bounce? Let's look at the VIX. Chicks. VIX. Oh, yeah, we hit the 200. And our orb has been reached. So, as I approach the 5500s again, and think about 2 this time, or just go 1. Yeah, just go 1. If we can get this thing at 550. You got a double bottom on the IWM, triple bottom. There's 550 right here. Mike sees short pops on coin. Okay, we're at 530. We've got a double bottom. Let's do it. Let's see what happens here. Jimmy's in at 530. Today's a risky day with the Fed speakers. This is trade number free. You can do it, Jim. We have faith. We hit the VIX double top. Hickory dickory dock, the mouse ran up the clock. We need to put you over here. We're at $5. No! Damn it. Why did that spike up like that? Well, heck. What have I got myself into here? Ooh. I knew it was going to be a little tough. The first Fed speaker came out. Well, shit. That happened too fast. Okay. Well, I'm going to have to do some cost averaging down. 4.40. We need you bad. Yes, we do. Can we break the 9? Be careful. Average of 485. Whoa, look at Sue. Damn. She's hot. Fed speakers, I wonder how they're going to be talking today. Well, I'm green, so I don't know. We're now at 570. As we approach the 21, we want to make a business decision. Or we could do a 1-2 free bets and run back up here to the 200. And that would be a nice Christmas present. But I'm not counting my chickens before they hatch. These are in and out trades right now. April 10th strike, 5,500 at 550. Give it to me. Now we're respecting the 9, and we'll keep respecting the 9. We're squeezing between the 9 and the 21. Ooh, we was. How dare you? Tesla's down 17 bucks. Apple's down 650. Snake. Fallen wedge. Or we go down more. Okie dokie. Yep, today's not going to be a very good. I'm going to have to take another headline. Oh boy. Coin's just a little bitty move, ain't it? Coin's back at support at the bottom of the orb, which is a triple bottom. I'm going to stay in these for a second still. I'm back to even. And we have a wedge. But we didn't complete the bottom of it. We got a higher low. Would you stop with it beeping outside? Can't you see I'm busy? We have a 1, 2, 3 maybe right here breakout. If we can break out past the 1, 2, 3, we're going higher. I don't want to play around with this all day long. I think this guy's Timmy, I'm not sure. George.
All right, see you. Thank you for the thoughts, the setup. Appreciate it. So it's time for morning trade, and we're taking a look at J.P. Morgan Chase. It reports its
She got a
earnings tomorrow
six-
morning, along with BlackRock, Morgan
her
Stanley,
six
Wells
outfit.
Fargo. But want to take a look here at J.P. Morgan. And XLF is still having a great winning week despite the sell-off a bit today. Caroline Woods is here and taking a look at J.P. Morgan. What are people saying?
Yeah, Caroline.
Yeah, this is going to be an interesting one, and I think outlook is really going to be key. We can count on Jamie Dimon. He never minces his words. He's talked about economic hurricanes and such, so it'll be interesting to see what he says. But yes, JP Morgan really kicks off bank earnings season tomorrow. It's been holding up better than its peers so far this year. If you take a look, it's
Bank earnings tomorrow, Mike.
Giving back some of yesterday's huge gains, down about 3%, but only down about 5% year to date compared to some pretty steep losses and double-digit losses for some of its peers. In terms of the actual numbers we're looking for, EPS of $4.62 on revenue of $43.23 billion. That's up about 3% from the year-ago period. I've heard analysts weigh in. They said these numbers are probably going to look good across the board, but it's likely not the first quarter numbers that investors will really be paying close attention to. It's going to be the outlook, the economic and the business commentary, any commentary on borrowers' behavior, both in terms of businesses and consumers. CEO Jamie Dimon, of course, told Fox Business that recession is probably a likely outcome because of the tariffs. Obviously, the tariff rate has come down for most countries now, at least for 90 days. But as George just mentioned, the China tariff is still at 125%. So we'll see what they say about the economic impact there. And Jamie Dimon has also reiterated that he thinks sticky inflation isn't going to go away very fast. When they last reported, he said there are two significant risks. One is that inflation may persist
Her and I matched today.
That was before, obviously, this trade war with China really started. And two, he said, geopolitical conditions remain the most dangerous and complicated since World War II. So
Oh gosh, Jamie Dimon.
Looking for any updates there in terms of
You
his
said that during
commentary.
Biden.
For the current quarter, Wall Street looking for EPS of $4.50 on revenue of $42.91 billion. That's down about 14.5% from the year-ago period. So we'll see what sort of outlook they give. Obviously, this earnings season, so many have said it's, we've already seen, Delta, Walmart pull their guidance. We'll see what the banks have to say. As you said, J.P. Morgan is not the only
We have a falling wedge.
Morgan Stanley, BNY, Wells Fargo. So really kicking things off. But shares down about 3.3% right now, but of course still up about 8% this week because of yesterday's huge gains.
So, we'll see whether, first of all, they also got a jump yesterday on the tariff pause. But, we'll see whether or not, if there's tariffs, if there's an inflation, how does that affect the banks overall? Jamie Dimon, as you noted, had always been pretty frank in his words.
Should have grabbed a couple
And he talked
more,
about
but I did
recession
not.
risks. I think they had a 60% likelihood of recession at one point. Goldman Sachs rescinded yesterday.
Goldman Sachs is still at 45%. So it's, below 50, but
I have $970 in this trade.
Recession. So I think that, and we don't really know
But
how this is going to play out because
No, we don't.
President Trump is negotiating
scared.
with each and every country. So 10% baseline tariffs, the expectation is those are here to stay. We'll see if those increase, but 125% impact on our third, or tariff on our third largest.
Her and I matched today.
Into this, median price target has come down, but it's around 264. That's about 15% upside.
Oh God, darn Dow Jones down 1,000
Morgan is
points.
or 19% away from the highs, so not necessarily getting back there, but analysts see upside from here.
Yeah, and Jamie Dimon, I think, has a good relationship with President Trump. Good enough in that, I think.
Good
we've seen
enough.
them talking
We're best
many
buddies.
times, so I guess they have somewhat of an open door chatting policy. Okay. Great.
But it all
Good
changes
preview.
fast, so we
Doesn't
just
it?
never know.
Without a doubt, and they're both very honest, so I wonder what it's like being a fly on the wall in their conversations. Caroline Woods, thank you. Let's trade it. Joe Tegay, Portfolio Manager, Rational Equity Armor Fund. Good morning to you. I know you're watching JP Morgan. Some of your thoughts about how you would go about a trade here.
Hi, Nicole. Yes, thank you for having me. It's been a very interesting time as a fund manager and a trader as of late. We've seen historic moves up and down. Yesterday, obviously,
We need a breakout.
Up. the options market is still expecting more insane moves to come. I'm just going to fade that volatility just a little bit, especially to the upside here, given after we saw such a huge ramp yesterday in JP Morgan. Remember, the 200-day moving average is right about at 230. Had trouble staying above that. I think 240 was an area of previous resistance. I just think by next Friday, I don't see it above 240. The options market's pricing in a really high probability. So I'm going to sell that call, buy the 245 call, and just kind of cut my risk off. I'm going to collect $1.40 to do that.
You gonna do that?
I think the probability of above 240 before next Friday is.
Come on with the beeping shit.
That's all I'm playing, and I think we have to admit it. We're in a bear market here, Nicole, and I think rallies should be viewed with skepticism here until we get a major change in the dynamic.
Moving at a turtle's pace out there.
It's interesting because yes, the market is down, but maybe things aren't as bad as they seem. For example, they could be terrible. I don't know. But I'm saying, I just was reading about the jobless claims, how claims are down how they are below 226,000 for 16 of the last 17 weeks. That makes me feel pretty good. The CPI print
You make me feel
today
good.
came in less hot. In fact, it was a bit cool. That makes me feel good that we don't have inflation soaring. All of these could change on a dime, but and yesterday you had and showed
Do I
that
make
there
you
are
feel good?
buyers on the sidelines ready to jump in, and that's probably a feel-good moment. I don't know. What are your thoughts? Because there is a lot of volatility and uncertainty.
Yes, and I think taking most of the tariffs off the table took most of the risk off the table.
Exactly.
So yes, I think the bounce we saw yesterday was absolutely justified. People were oversold. People were too bearish. There was a lot of short positioning which had to be covered. So the bounce we saw off of the lows absolutely justified. Don't get me wrong there. That said, you have to remember, before we even started the tariff talk, people were worried that we're losing jobs because of the federal employees being laid off. People were worried that these valuations were way too high. So we're still in a moment where we have to just kind of wait and see, let this all play out. So for me to just race back to all-time highs, well, I wouldn't discount that possibility. I certainly do think that's possible. I think it's just going to take a little more time to kind of get through all of this noise to do so. So the options volatility still extremely hot. I think people are still betting on more upside. I think yesterday's rally, fantastic. It's very rare to see upside days like that. And they happen to happen in bear markets. So for me, just selling some of this upside volatility after this huge
it's a forklift.
snapback higher just seems prudent to me. If I'm wrong, hey, that'll be great.
It's not a forklift, it's one of them
the portfolio, of course, but I just think that
machines that you get in a
$10
in a box and it lifts you up in the air.
Higher here in just a week. I think that's doesn't happen very often. I think the options are pricing it too
A man lift.
too high a probability. So for me, that's what I'm looking at into this earnings tomorrow.
Yeah, and look, people made some quick money. If they bought on Monday, they sold yesterday in the heat of it. That's good news. But that very well, when you talk about a bear market rally and a lot
He's
of
going
short
backwards.
covering, or the other scenario where people are just waiting for a rally to sell into some strength so they can get the heck out. We're still in a very fragile time. Joe Tegay, portfolio manager.
Nicole,
Equity Armor
you
Fund.
said
Great
that
to see you.
yesterday.
Thank you.
Not to get too
Coming up,
excited.
let's
You
talk
were
about
right.
Tesla. We heard about a 190 target, and we heard about a 375 target. Which way is this thing headed? Well, our next guest is more bearish. That if the setup is still there for the bear move. We'll be right back.
Well. It's not working. AVGO down $12. Broadcom. Oxy, man. Oxy's cheap. And Nike. Ooh, Nike down another $5. Everything came back. Shut up outside, please. Jimmy called Intel yesterday. Oh. We need a Trump tweet. today I'll be eating chicken soup for lunch. And I'm gonna go make me some cheese chips to eat with it, with pepperoni, out of my little waffle maker. How dare you? VIX is elevated. Trish Regan said something the other day. She trades stocks. She used to be on Fox News, the financial thing. Trish Regan. She said the VIX was elevated to 60 something, and she said that's a strong buy. Then that next day we had that big breakout. She kind of knows what she's doing. We had the breakout of the wedge, then the retest. Was the neatest thing to go up, back up to here so I can get out of this thing for a couple bucks a piece. I'm almost back to even. So do I get out of this trade at even? Or do I just hold it out? It's a falling wedge. And we did break out. I'm going to stay in it. I mean, this is the place to get out at the 50 and get out even. Or a little less. And I didn't add on. If I'd added on to the dip, I would be looking real good now. I'd had 4 contracts. That was $4 plus $4 divided by 2. Yeah, I'd be up. Be up 120 bucks. Finally, the beeping stopped. Breakout. And then we could continue the run. VICTORY, that is my battle cry. We're out $5. It's 5.30. It's saying hold. Pardon says hold. I'm still in the meat diet, but I've kind of fell off that wagon a little bit. But everything I eat has meat in it. Joshua. Okay, this ain't going out the way I wanted it to. I did hit my resistance. I was kind of hoping I'd hit that 200 and break on out and do a double top. So I'm still going to wait. It's just one of them days, I think, with the Fed speakers. We got to be careful. Bitch. Oh. Always clean. Retail traders. You're on a recorded line.
So calling because we're offering insurance.
That's a nice bounce back. We have an ascending triangle starting. Little rising wedge. I'm debating on getting out of this, but I'm still going to hold on to it. We bounced off the 1, 2, 3 and got a little higher high right there. So it encourages me just a little bit. It's 5:30. $5.50, yay! Break it! This could be an exit idea here. We're at the 63. I'm getting ready to have chicken soup and make my chip thing. If we break out, we could run up to the 200. What should I do, Mike? I can't make a decision. Someone give me an answer, please. Orb low day is going to act like a resistance. Orb. Where is the orb? It's going to act like a support on the VIX. Oh, on the so right there, yeah, day high. Good idea, funky monkey. You little funky monkey. Let's get this thing up to 800. Uncle Zimmy could make a business decision right here. Oh, I got a song today I want to listen to. My darn phone. I don't know what I'm going to do about this. It's starting to drive me a little crazy again. It's interrupting my trading. You don't want to piss me off, telephone. I'm in them. I think it's a little bit nervous today, the market is. That's the feeling I'm getting. Yeah. Let's get it up to the top of the orb. She's the devil woman. She's got evil on her mind. May the circle be unbroken by Lord by and by. Hang 'em high. I once was fine. Okay, I'm here. That was very unprofessional, James. Yeah. Well, they didn't want it to go, did they? Oh, darn it. It's hard for me to stay in stock when I'm up a couple $100. Now I'm back down to my even. Well, let's stick it in. Let's stick it out. Now we're at orb support. Not sure it's going to hold. I'm going to take a risk. See if I can add to this. $3.70. I should have sold it when I was up there. Let's do it. I love them. A little spicy. That's for lunch today. Salad with cheese, pepperoni, chips, and chicken soup with barley. And I need 428. Well, this could be a losing trade for me. I'm gonna still stick it out a little longer, but I got a double bottom tinned with, and that doesn't hold. I'll get out and buy the dip. Usually after a day like yesterday, though, it's not as good as the next day. And these chips, these things are killer. I never made anything like this. That's cheese and pepperoni. You can see the pepperonis in there, kinda. Okay, here we are at support. market corrected that big old run pretty fast. Anybody had a stock they liked yesterday? Nvidia. Think about adding 4 more to this. Look at the video. Yep, that's what to do. I'm giving it a shot here. $2.50. While I'm doing that, I'm going to look at the video. Microsoft. Banks. Banks had a good run yesterday too. Everything ran off that. Cat. And I said Home Depot. I liked it too. That's one I should have jumped in yesterday. Yesterday morning when I talked about it. I added one ingredient to my soup that I've never added before, and that was cinnamon. When I used cumin, and that tastes great. Come on, SBX. I'm hoping on you. IWM. New low with a 1, 2, 3, 4 head and shoulders. A double bottom on the QQQ. Double bottom with a lower low on SPX and the SPY. Not quite. Jenny.
Session as We know some of these chips have been, yes, exempt from the Trump administration's tariffs. However, Trump has suggested imposing tariffs on chips produced outside the U.S. It won't be clear, though, what that means for Taiwan Semi on an exact measure. But what we do know is
this
they've
guy's a
already been
jackass.
investing heavily here in the U.S. So I think it's been surprising to some to see Trump really going after that company in particular. Many say if chips are targeted, the TSMC might benefit from the tariff rule that says if at least 20% of an imported item's value is produced or transformed in the U.S. Of course, Taiwan is the main supplier of chips for NVIDIA. We also know that they make the core processors inside of Apple's iPhones, as well as Qualcomm chipsets and processors made by AMD. I actually saw a great stat from an analyst that was highlighting that this name dominates, the overall market as far as its foundry business. Also, now taking on a joint venture with Intel to help boost their foundry business. So I'll be surprised if somehow this right now trade and tariff discussion doesn't work out favorably for Taiwan, because they've already for years been investing, we're talking $100 billion in the U.S. economy and the U.S. chip making.
Yeah.
I think you're right about how much investment that they've been making in the U.S., but I think obviously the issue seems to be the tariff overhang with regard to chips and if there will be carve-outs for chips. And I think the expectation was there, but we don't know yet.
Yeah, and the commentary from President Trump yesterday definitely not helping when he was basically saying, look at how flawed the CHIPS Act is, and look at these companies that don't even need the cash that are receiving billions in government aid. I see
That's
his
true.
point. I know his stance is pulling back this government spending, and I know that the rest of the administration has said they're not going to ditch the CHIPS Act, they're just going to reform
We blew a lot of money we didn't need to blow.
Definitely not helping of maybe we could see an impact, yes, but to what extent? Because it doesn't seem like the president is willing to shell out the same degree of cash that we knew from a former administration.
Okay, all right, Jenny. That's Jenny Horn, markets correspondent. Jenny, thanks a ton for the breakdown on Taiwan Semi. All right, let's widen out, get some insights on news that's shaping the markets. For that, I want to welcome in Todd Rosenbluth, head of research, Verify. Todd, thank you so much for joining us today. All right, I want to start out big picture with you, get your broad-based perspective on not just so much just today's market action, because obviously we are seeing a pullback. But in the context of that historic rally that we had yesterday, it felt like there was this, not just a sigh of relief across the market, but just a little bit of optimism. Maybe there has been too much pessimism baked in, but also that came on the strength initially of a tweet and then a post on Truth Social. So how do you take that all into context of today's market action compared to historic moves that you've seen?
Yeah, we're a very risk-off environment a few days ago.
Well, we were.
Yesterday afternoon, and the traffic that we're seeing at our platform, ETF database, certainly reflected that. We saw a spike in the interest in gold-related ETFs. We saw a spike in the interest in real estate ETFs. We saw a spike again in those inverse ETFs, those that are betting against the market. You were just talking about semiconductors. The Direxion lineup of inverse ETFs was very popular on our platform at ETF database because of that. So yesterday we saw that relief rally, as it now feels like there's a pause, and feels like is it perhaps the key phrase there. The market's giving back some of those gains. Yeah. Hopefully we return to a more normal economic environment. We'll see if that's the case, and thus quality stocks tend to do relatively well in the kind of environment that we expect we're going to be in.
So it's so interesting that you say to a more normal environment. We're seeing that in terms of the price action in bonds. Equities is still a little unclear if we're returning to a more normal environment. Obviously it's not as a big move today. We're not seeing the volatility according to the VIX that we saw yesterday, for instance. But talk to me a little bit more about the gold move. Makes sense to me, and we're even seeing that play out in terms of the gold price action today. But the real estate, how do we interpret the interest there?
Yeah, so real estate ETFs or that own companies that are REITs that are domestically focused, so they're not necessarily impacted by the tariffs. ETFs like Vanguard's VNQ is an example of that. XLRE is the State Street product. Those are the two larger of those products. But also, if interest rates come down, then we could see folks refinance. And that could be a stability opportunity for the real estate market. So real estate tends to be one of those more defensive sectors in the U.S. economy, less exposed to trade. People own houses and apartments in the United States. Most of that is based there. And then we're seeing that's a form of quality. And so we are seeing stronger interest in quality-related ETFs. So an ETF like VFlow, which is the Victory Shares Free Cash Flow ETF, stable financials, companies that have stability but also a growth tilt to it. And VFlow has been one of the more popular products the last couple of years.
Not much of a day today.
ETF to focus on.
Okay, so let me ask you in terms of how sentiment has been
flat.
shifting. Have you noticed an increase in,
SPY
not
keeps
just,
hitting the
demand,
VWAP,
but
breaking a
traffic
little bit.
towards these ETFs in particular?
Yeah, so the volume in ETFs has been quite high.
I think I'll come out
We
winner
had
on
record
this.
volumes.
It's
I
going to
think
take
SPY
time.
hit a record volume SPY, which is the
Right now we're at $3 and $3.10. I don't know if I can handle that guy right there, right now. Who is he? Well, we're below the orb on AMD. What's another one, Jimmy? Once you had Amazon. Amazon pulled back to support. Where's my message? I don't see my message thing. There it is. CCL getting cheap again. Oh, I missed that one. They're power washing out there, and my car is going to get filthy, bastards. Oh man, dogs. Well, I think I need a song. So I got to figure out what to play here. It's definitely a bearish day. Fat cats are at lunch now. Job numbers were in line. Yeah, that's a good number to read, Parge. U.S. inflation fell to 2.4%. That should be bullish. I will be right back. You can hear that washing? They're cleaning my building.
Here to take us through a look at the trades, we've got Kenny Polcari, senior market strategist, Slate Stone of Wealth. All right, Kenny, it is great to have you on. Hey, Rick. Sorry, Rick I talked to you earlier. I didn't mean this. Kenny and I have known each other for a long time, so it's like old friends catching up. All right. So let's go through the first one on your list. You've got L3 Harris on your list. Tell us about, your thesis here. What's behind this?
So this is rather simple, right? The market has been clearly under pressure. You still want to be in it. You want quality names. You want names that the largest names in the sectors that they represent. So really, honestly, it was like easy to pick three names because of where we've been. Now, LHX is a defense contractor. It's a great story. Their last earnings report, they beat on all the metrics and all that stuff. They're a dividend payer. They increase that dividend every year. They got a $38 billion backlog worth of orders, and it's on sale. It's was down about 25% at one point. Certainly rallied yesterday with the rest of the market, pulling back a little bit today. But it's at a place now where it's just testing around the trend lines, and it should. And my guess is, as long as we get more stability in the market, this will be a name that you want as a long-term investor in your portfolio in that space.
And look, to be fair, it is outperforming the S&P 500.
It is.
All right. So, Rick, tell us what you notice when it comes to the chart for this one.
So definitely a decline off of those 52-week highs that we saw near 265. However, the downtrend seems like it's been broken. We had that downward sloping blue trend line there. Price has moved beyond it. We didn't have a huge breakout. We kind of got stuck at our red dashed line there near 222. That represents a series of low points from previously in the year, and then two subsequent high points. So it was kind of almost a double bottom and then a double top after the breakthrough to the downside. Now that's the resistance area that many traders might have their eye on there, 222 or so. But today, though, we are stalling out temporarily, perhaps near the purple 252-day exponential moving average, near about 218. So our moving averages, notice that they are clustered fairly closely together. They have more of a sideways trend than a strong directional trend, suggesting that we're in more of a low volatility type environment, which often can be the precursor to higher volatility and impending potential breakout situations. So an interesting setup here. Notice as well that RSI has crossed above its downward sloping red trend line and above the 50 midline, making a more bullish shift. So 222, that's the mark to beat to the upside, Diane. To the downside, 193, that's our 52-week low.
222, the mark to the. Do you want to leave the final thought on that?
Yeah, and there is, consensus estimate on the street is a $255 price target by the end of the year. So that does represent some upside from where we are.
Yeah. Okay. All right. So let's take a look at your next pick. You got MasterCard on your list, and you're not the first one today to pick that.
Oh well, there you go. So Master, look, it's not a sexy hot name. It's not Nvidia. It's not a tech name, but it's a solid performer, right? And it's in that digital payment space, and they've got really a robust story. Their last earnings report, they beat on all the metrics, which shows kind of a resiliency even when there is some tough economic times. They have 31% of the market share in that name, and so again, I think it's just a solid name in that space. Gives you exposure to tech because it is right. There's a lot of tech in there, but it also gives you exposure to that digital payment space. So, and it's a solid name.
Yeah, so it's so funny. So Kenny's not the first person today to have that on their shopping list, especially in the current climate. But Rick, tell us what the chart looks like, because obviously some technical patterns have to be taken into consideration.
Yes, and for a while, this one was showing more of a triangular type shape, where we had two competing trend lines, one starting with those 52-week highs near 582, and one beginning with a relative low point that we saw from mid-January or so. You can see that we had that blue trend line traveling upwards there that has been moving. And now that gives us a gap level to consider. That was kind of our last stand before we had our gap downward on a lot of this big headline grabbing news about trade policy and everything. But so now 527, that's the red line there. That is our low point that we had before the gap down. It also lines up pretty closely with our yellow 21-day exponential moving average and our trend line still.
MA,
so
bank.
530, that's a key area to the upside to beat. Notice as well that today we are, once again, like our last chart, near our purple 252-day exponential moving average. So this longer-term moving average near about 502 could be an important point to watch going forward. Now, you see I have these shaded areas.
Spy new low.
Advance to the next chart, we can see that they line up with some key volume areas. The top one is our volume profile point of control, so even more emphasis on that same area that we've been highlighting, 527 to 530 or so to the upside, and to the downside, around 493 or so is where there's more heavy trading activity. So that could be a place for another potential foothold.
Okay, all right. So there's some levels he said to watch to the upside and to the downside. Any final thought on MasterCard?
No, I think that's all fair. I also think that investors have to kind of take into account the tone of the overall market, how volatile it is. So don't get spooked. But look, I think it's a great name. It is a name that we own in one of our portfolios. So
okay, your last pick is a member of Max 7, Amazon.
Right, but listen, this is clearly because it's on sale. This is down 30%. Everybody knows the story. Amazon Web Services is growing, a double-digit growth. It's a great story. It's just because this one is down 30%, or was down 30%.
So it's a sale.
I think it's just you got to buy it because it's on sale. 100%.
Okay, so it's on sale. But Rick, what are you paying attention to when it comes to the chart for Amazon?
Yeah, so once again, pretty much it's a similar picture for so many stocks that we talk about. We had highs recently within the past couple months or so. We've had a significant decline. But like a lot of other things that we're seeing shape up, we're kind of solidifying near some old low points. So you see that green line, 168, that represented an old low. Then we had our anomalous August 5th, kind of sell-off that quickly reversed. And then we held on to that low once again just a few weeks later in August. And then more recently, within the past couple weeks. So 168 seems like an important level. And we also could draw a channel. Starting with those highs, you could duplicate it, put it across the lows. It matches up pretty well, our two white dashed lines. Kind of oddly enough, though, if you were to duplicate it again and put it to the upside, that matches up fairly well with our recent highs there. So these are some ideas for potential boundaries to keep an eye on going forward. But ultimately, though, probably a lot of traders would have their eye on that red line near 206. That represents our recent high point after we did break out to the upside from that downward sloping channel. So around 206
Market's
to the upside
just not too excited.
A key point to overtake.
Kenny, final thought on Amazon, and I want to get a broad market thought.
Yeah, okay, which is up, that 206 is up about, what, $15 from where we are now, right? Where's it trading, 100?
It's 183 right now.
183, great. So I think there's some opportunity. If you're a trader, I think you're right. That's going to be a level that you kind of want to look at. But look,
this guy here looks like that.
It's on sale, you want to own it.
Younger guy, might be his daddy.
Right now.
They act a lot the same.
When I came in today, ran into Ian on the floor, and you know, he had a thought similar to what you guys do, where you trade in. Dan said this reminds me of 2008.
Right.
So, and we look by the numbers, we do have that historic frame of reference. What's similar to you about now to that, and what's different about this time?
So I'm not in the camp that this feels 2008-ish. 2008, I think there was a definite different feel in the market, right? Just because so much other stuff had gone on between the Bear collapse, the Lehman Brothers collapse, the whole financial collapse. This didn't feel like that at all, or it doesn't feel like that at all to me. Now, do I think that, you know, we needed a pullback? We did. Do I think stocks had gotten stretched and the story had gotten a little bit exaggerated? For sure. Had we had a pullback in a while? We had not. And look, over the last 95 years, there have been 50 corrections in the market. 15% of them have been 25% or more. That's like every 6 years you're going to get that deep of a drawdown.
Well.
So if this is it, we haven't had one of those now in a while. So if this is it, I'm okay with it, because I think, again, as a long term, it sets people up for opportunities that, you know, they're going to wish that they took advantage of.
This is great perspective. Thank you.
I think it. Well, you're very welcome. Thank you for having me.
All right, that's Kenny Fukari, Slate Stone, a Walther. Thanks to Kenny, and of course also Rick Ducat, our lead market technician. Thank you both. Coming up next, we're going to spotlight crude oil as crude continues to hover near the $60 level. It's been under some pressure today after gaining some ground yesterday. We'll be back on the other side of this break.
Doo-doo-doo-doo. Hot stocks. Well, let me look at winners.
Morning movers
Losers.
brings traders the biggest headlines to start the day, from volatile overnight swings to the earliest analyst calls. Get your watch list ready.
ICCT's pulled back.
Morning movers only on Schwab Network.
This is the one I've been wanting to trade.
Trading at Schwab is now powered by
I missed it yesterday.
unlocking the power of Thinkorswim, the award-winning trading
Off the
platforms.
200.
Bring your trades into focus on Thinkorswim desktop with robust charting and analysis tools.
Tall's
including
China.
over 400 technical studies. Tailor the platforms to your unique needs with nearly endless customization. And track market trends with up-to-the-minute news and
JD's up today.
Trade brilliantly with Schwab.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. The Platforms and Tools webcasts are designed to help you broaden your knowledge of platform features and resources available from Schwab. You'll learn tips and tricks to help navigate Schwab.com, Thinkorswim, and mobile-based platforms. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to schwab.com/coaching and start learning today.
Trading the trending names every day. I'm Tom White, host of Fast Market, ready for you, ready to go at 12 p.m. Eastern on the Schwab Network.
Welcome back to Stream 360. I'm Diane King Hall, live from the floor of the New York Stock Exchange. Time now to spotlight the energy market. Joining us for insight, we've got Carly Garner, Senior Commodity Strategist and Broker DeCarly Trading. Carly, thank you so much for joining us today. All right, we've got crude oil back under pressure today, trading below $60 a barrel for West Texas Intermediate. So we're giving back those gains that we had yesterday. We ultimately finished, I think it was around 4% higher yesterday, or more than 4%. We're losing that same amount today. What is happening? And put this all into context. How do you read through this?
Sure. So there's a couple things going on. First and foremost, the market had been holding the 63 to 65 area for years. So traders had kind of been trained almost to buy the dip into 65, and they just expected it to always hold, and it did for two years. But that trend's probably ended, and now I think we're kind of in a new paradigm. The last time Trump was in office, oil traded mostly between $40 and $60 a barrel. So I think we've kind of stepped down into the range. 65 is now probably going to be some pretty good resistance. There's going to be a ceiling there. That was a previous floor. Now it's going to be a ceiling, I believe.
You think so?
And I think we'll probably work our way down into the $50 range before all is said and done. I will say that even before this week, we've been talking about the market had kind of been giving us 2014, 2020 vibes. And what I mean by that is we've kind of gone through 2 or 3 years of rallies that were failed, lower highs, and all rallies were sold into. And in 2014 and 2020, when we broke support, it wasn't like a $5 or $10 break. It was something much bigger. In 2014, we broke from roughly $100 a barrel down to 30. In 2020, I think we all remember we broke from basically the 40s, 50s into the negatives. So even though we've had a kind of a rough day in crude oil rough week, I should say, there is some significant risk on the downside. So if we do get down to $50 and you want to play the upside, do so, but do it with limited risk, because there is some risk of a repeat of the chaos that we saw in 2014, 2020. I wouldn't be aggressively bullish anytime soon.
So the old floor becomes the new ceiling now when it comes to crude oil patterns.
Well, she laid that out.
What about the impact of the tariffs? Overall, yes, we have this 90-day pause, but we do still have the China tariffs going forward, and now they're 125%. And then you had the China retaliatory 84%. Well, we raised ours to then 125%. So how do you see the impact to crude oil trends?
Well, the market's giving it all back today.
It's impossible to quantify how. I mean, we're still kind of in the inner workings of the deal making. But what it does do is 2 things. It creates uncertainty, and uncertainty breeds volatility. And number 2, as soon as we started talking about tariffs, a lot of risk assets started selling up. Crude oil, one of them, but also equities. And generally, when you see risk assets sell off like that, it creates a negative.
NVIDIA's knifing. Oh, Meta.
It's going to happen tomorrow or even 3 months from now. So they stop spending, and I think that's probably a big part of what we're seeing in crude oil. And until we get some more certainty, I wouldn't expect crude oil to find a whole lot of footing. I will also add, crude oil tends to make really big trend changes with extremely high volatility. What we've seen in the last week feels like high volatility because we've been in a low volatility environment. But the reality is a $10 or $15 move in oil isn't that much. In fact, previous bottoms and tops in crude oil, we've seen $10 to $15 in a couple of minutes, not a couple of days. So put on your seatbelts and be prepared for anything.
Okay, buckle up, whether we're talking about crude oil or equities. Let's talk a little bit about the impact of OPEC Plus and its decisions. Basically, they've said they're going to increase supply. That comes in May. With regard to that, how do you expect that to impact pricing? Has that already, kind of been factored into the pricing action?
Slow, nasty day.
It's been my view that the reason crude oil didn't break below 65 prior to this particular move is because OPEC had been doing a lot of the heavy lifting. They were kind of artificially keeping prices high. It's a very well-supplied market. I know we've had some scares with Middle East violence and that sort of thing, but the reality is it's a well-supplied market, and I think we have room for production increases even here in the U.S. So I think OPEC kind of opened the door for the market to step lower. And as I mentioned before, I think with this administration, which is a little more, quite a bit more oil friendly, I think that there's definitely some room for lower oil prices, not just temporary, but in the longer run.
Let me ask you about this. Yesterday, we hit $55.
God.
I don't remember if it was on the nose. $55 a barrel. The read-through was that was signaling recession, essentially rocky road ahead. Is that the correct read-through? And where should we get concerned about levels of crude oil to the downside?
I think that's, I
Sky
think
dropping
the jury's
more.
still out, but I think that's probably a correct
Didn't hold
take.
support.
Like I had mentioned just a few minutes ago, I think OPEC was artificially holding crude oil prices up, just like I think the Federal Reserve and governments were holding stocks higher. And now we've kind of pulled the Kool-Aid away, and now we see what these markets are really made of. I did see a couple of big banks and analysts call for $40 oil. Usually when the bigger guys are starting to call for trend extensions, we're usually closer to a bottom than anything, but we'll just have to see. I've got pretty good support at 50. gonna have to see how it behaves there. So again, resistance 65, support 50. If we do break below 50, the last few times we've done that, it's been pretty ugly. So again, keep your risk low and manageable.
When you say support at 50, what's your timeline for that? Is that like the 90-day kind of period, or is that a longer timeline?
You know, the oil market's really tough to.
Yeah, I know. I understand.
I've been calling for 50 for months, and I was kind of doubting myself for a little while, but now it's one of those things that it happens very, very slow and then it happens all at once. So I would say if I'm right about $50 oil, it would probably be, now that we've started this little cascade lower, I think we're probably looking at weeks, not months. So that's how we're trying to play it.
Okay, and let's talk a little bit about the potential impact of negotiations between the U.S. and Iran with regard to its nuclear plans. What impact are you expecting in terms of market volatility and just overall global oil supply implications?
Well, it's hard to gauge that sort of thing until we get all the details, and after we get the details, it's too late, right? The market's already reacted. But my best guess is it's probably going to pull oil prices lower. So at least to $50, which isn't too far away, maybe even a little bit lower as we work through these things. I think peace in general in the Middle East is a good thing for oil. And also, we haven't talked a lot about it in the industry, but the attack on the U.S. attack on the Houthis a few weeks ago, or whatever that was, it is something that also kind of mitigates the upside potential in crude oil, at least for the short run. So I think we're going in the right direction, and it's good for consumers, right? I think we all need a little relief at the moment.
Yep, we do.
And we saw that in terms of today's CPI numbers for the latest month, where a big part of the reason that we saw a decline and better than expected numbers were energy prices. Right now, oil down more than 4%, trading below $60 a barrel. Brent also lower.
Debate no trading anymore.
Thanks so much for your perspective. That's Carly Garner, DeCarly Trading. You got it, Carly. Coming up next, the disruptors. We're looking at Tesla after multiple analysts cut their price targets on the U.S. automaker. Trading 360. We'll be right back.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Are you an active trader? Our active trading webcasts are designed to help you develop a deeper understanding of technical analysis, options, futures, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to schwab.com/coaching and start learning today.
You might just go out and walk on the treadmill, come back after lunch. AMD new low, Tesla
Trading 360. I'm Diane
250.
King Hall, live from the New York Stock Exchange for a look at developing stories. This morning, I want to bring in Caroline Woods, senior markets correspondent. All right, we're taking a look
Caroline,
at Constellation
give us some
Brands.
news.
Stock has been fluctuating today. It briefly started out lower, but what's going on here behind the earnings?
Yeah, and it was higher for a little bit, modestly higher. It's back at the flat line right now. It was a beat on both the top and bottom line for the trailing numbers, but the outlook did fall short of what analysts were looking for by quite a sizable amount. So right now we're seeing shares up about 0.2%. So bouncing back and forth across that unchanged line. I do think it's important to note, if you take a look, year to date shares are down 17%. They've been under pressure over the past 1 year, down more than 30%. About 33% away from the highs. So, it has been under pretty notable pressure. Keep in mind, it imports all of its beer from Mexico. Modelo, Corona, Pacifico. The temporary reprieve on those tariffs, actually a good thing for the company, but it doesn't apply to sector specific tariffs.
Yeah.
So aluminum cans impacted there with that 25% tariff. Corona comes in glass bottles. Don't have to worry about that usually. But Modelo, the top selling beer here in the U.S., usually comes in cans. So it does impact that. And tariffs really the reason why they offer disappointing guidance. Going through the trailing numbers, adjusted EPS of $2.63 easily topped the $2.28 analysts were looking for. Revenue rose about 1.2% to $2.16 billion. Also beat out what analysts were looking for, $2.12 billion. In terms of the fiscal 2026 guidance, adjusted EPS of $12.60. Basically, at the lower end, Wall Street was looking for $13.97 a share, so really fell short of what analysts were looking for.
Well, bounce back up.
Net sales will range from declining 2% to rising 1%. Beer sales, which is upwards of 80% of their business, I believe it was 78% of their sales in Q4, will range from flat to up 3%. Constellation also cut its medium-term outlook for fiscal 27 and 28. Now projects enterprise sales will rise between 2 and 4%. Previously, they were looking for 6 to 8% growth there. And then also plans to lower CapEx in 2027 and 2028. Now, wine and spirits has been the weaker link of the business for really the past few years. They did say that they're going to divest their mainstream wines and focus on brands that have bottles that are $15 or more a bottle. The higher growth, higher margin brands that they say aligns to the consumer-led premiumization trends that we've been seeing. So not necessarily the trend. If I'm
Woodbridge, I know the one that they're coming up with. Like that one's a little familiar.
But this isn't a huge surprise. Kind of repositioning their portfolio. They sold off the Svedka vodka brand back in December. Kind of focusing on the higher end wines, and then of course the beer business, which has been the bright spot there. So, shares up about 0.2% on this report. I guess it's a pretty mixed report given the disappointing outlook, but maybe a lot of that was already priced in with the sell-off that we had seen in Constellation Brands so far in 2025.
That's certainly possible. And then what are you seeing in terms of any analyst reaction to their latest numbers, especially when you think in the context of their forecasts?
Sure. We have seen some price target cuts. I saw Bernstein cut to 225 from 260, but kept an outperform rating. Deutsche Bank did cut to 191 from 193. They're in the more neutral camp with a hold rating. If you take a look, the median price target has come down to 210. Constellation's currently trading at around 184, so still upside. And it's about 60-40 in terms of buys and holds. No sells on the street, no all-out bears. And the majority, around 60%, still rate Constellation as a buy.
Okay, they like their spirits on Wall Street. All right. All right, great coverage there on Constellation and Brands. Shares have been fluctuating in today's session. Time now for the disruptors. George Sillis, senior markets correspondent, joins us with today's company in focus. Tesla under some pressure. It's on the receiving end of more price target cuts. What's the latest here, George?
Well, I'm looking at Tesla, Diane. This has been sort of a remarkable market, and Tesla's been a remarkable story with the huge run-up post-election to close to 490 in late December, all the way down to about $217. This is just a few days ago, so it's obviously moving back to the upside as of late, but down today with sympathy with the market, but. Look, there's a lot going on with Tesla, the story around Elon Musk, the political narrative, some of the aspects behind Doge, which haven't been favorable. Then you have tariffs, which certainly have impacted, automakers and particularly all consumer-based products in the United States, still going on with China. But Tesla does manufacture all of their automobiles in the United States, and in fact, they do manufacture all of their electric motors in the United States. So they're going to be less impacted by tariffs from the Trump administration on China. But nonetheless, you have to consider that total vehicle deliveries last quarter were down, lower than the estimates, down year over year by about 13%. And the earnings estimates are expected to come down because of some softness, especially in Q1 of this year when they're going to be reporting next coming up. So with that said, some of the analysts are still kind of adjusting their price targets, but they're wide in terms of the variance. UBS has sort of always been a bear on this name, but they've now got a 190 price target down from 225. And some of the things they noted is, and I think they make some good sense here, is the automotive margins might compress because of supply chain constraints. Intermediate parts that are sourced from overseas and places like China and Southeast Asia might constrain their margins. But their solar business too, and their energy storage business might be compromised a bit because of the Chinese tariffs. But if you look across the board as well, Mizuho, for instance,
thinking about going long again. Try it.
375 from 430, so that's still quite a bit higher than the current price. But they do maintain an outperform rating on the name because they are also seeing some adjustments lower coming up this quarter. Because again, from the standpoint of vehicle sales being challenged, consumers being challenged, and interest rates are still relatively high, and that's again on top of the narrative around Elon Musk and his tie-in with Trump.
Okay, so George, how about an example trade for Tesla? How would you proceed in the context of not just these analyst notes, but just some of the price action recently?
So I'll tell you what, if you just look at the price action, irrespective of today's move, the stock is holding up well. It's already come down 50%, if not more than that, from its all-time highs going back to last December. So with that said, any positive catalyst coming up in the next, let's say, 4 weeks or so, or in the next month or so, could really cause Tesla to move higher. So I want to put on a constructively bullish trade here, but I'm going to capitalize right now on the implied volatility that's still high in all the option chains. So I'm going to put on a long call diagonal spread. And what I'm going to do is I'm going to sell the out-of-the-money 270 calls that expire next week. And then I'm going to use the proceeds from that sold option to help finance an in-the-money May $250 call, which is at the money right now. So altogether, this would cost you about $22 a share or $2,200 a contract. So in essence, we just don't get to participate past the 270 if it goes beyond that by the end of next week. But if the stock does pull back, that'll help insulate some of the drawdown, to which time we can let the May contract in 36 days manifest. So it's bullish. So if you're bullish into May, this is certainly a strategy you can consider, but you also have to consider too the risks and the volatility involved, as well as the max outlay of $22,
take a little bitty break.
Which is the most you can lose.
Oh, we got NVIDIA at a double bottom.
Okay. All right, George. And then does that take into account, or how much does that take into account kind of overall market sentiment?
Well, the reason I'm doing this is I think this market will play out positively going into the end of this month and in May. But it doesn't mean we can't go down in the short term. Obviously, we're going down today. We could certainly go down lower, but I think there will be some reconciliation and tariffs, and the market, like I said, may pull back, probably closer to the 4,700 area. But that's why I structured this trade so that short call insulates us from that down.
Hello.
We're still going to participate if Tesla rebounds into May.
Okay, so some insulation there with that example trade on Tesla. Right now, shares down 8.5%. George, thanks a ton for that example trade. That's George Sillis, Senior Markets Correspondent. Coming up next, time for our 360 round. We'll dive into today's cooler than expected CPI report. Trading
Shit.
We'll be right back.
I'll be back in a few minutes. Taking a small break.
Trading at Schwab is now powered by Ameritrade, giving you even more specialized trading support. Connect with the Schwab Trade Desk, our team of passionate traders ready to tackle your trading questions, no matter how complex. Plus, get 24/7 live help and access support by phone, email, and in-platform chat. Trade brilliantly with Schwab.
Maybe when it comes to investing, you'll love Carl's Way.
Carl's Way is the best way.
Carl's Way is the best way.
Is it? At Schwab, how I choose to invest is up to me.
Exactly. I can invest and trade on my own.
Yes, and I let them manage some investments for me too.
Let's move on, shall we?
No can do.
I'll get out here.
Where are you going?
Schwab.
Schwab, a modern approach to wealth management.
It's time to look forward
Find the next trend.
from every click to every tick.
There's no fear of missing out on Next Gen Investing.
Available anytime, anywhere, on any device for free. Empower your portfolio with the Schwab Network. He's Alex Coffey. I'm Jenny Horn. Join us for Next Gen Investing.
1 p.m. Eastern, only on the Schwab Network.
Welcome back to Trading 360. Time now for the 360 round. We're diving into today's cooler than expected CPI report. For that, I want to bring in our panel. We've got Tim Davis, Executive Managing Director, Wealth Manager, Davis Executive Wealth Management Group at Stewart Partners, and Mark Bittner, Chief Economist, Piedmont Crescent Capital. Thank you both for joining us today. All right, we had these cooler than expected numbers, whether we're talking about year over year, month over month, or core. Month over month, we fell 0.1% in March. That's the first time we saw a decline, a month over month decline since May of 2020. We had the year over year inflation cooling to an increase of 2.4%. If we look at core, that was 2.8%. All those numbers were better than expected. Mark, I want to start with you. What's your takeaway from this reading today?
Well, a lot of folks were very quick to dismiss it, say, well, you've got all these tariffs coming, and so there's more trouble ahead. I look at it a couple of ways here, a couple of key takeaways here. One, if you look at some of the core services prices that we've been focusing on for some time, they show a substantial cooling through all the noise that we've had this year. Where we've seen a lot of volatility is we had some surprises early in the year when folks tried to pass along price hikes. Demand was weak, and as a result, they've had to roll those back a little bit. The other thing is that Easter comes very late this year. And because of that, we saw a lot of travel-related categories, lodging, gasoline, airfares, all came off by a surprising amount. That's probably going to reverse in the next couple of months.
Tim, what's your thought? I want to know your takeaways from today's reading. I mean, obviously, it isn't really baked into the market. The market seems to be more focused on, the headlines as it relates to tariff. But what's your takeaway overall on the patterns that you saw?
Thanks very much. Overall, this is in line with our expectations. Coming into the report, my fear was that the data was already stale. With everything taking place, especially in the last few weeks, I think that the forward-looking projections are getting pretty tough, even with yesterday's announcement of the 90-day reprieve on some of the more extreme tariffs. But the fact is that the energy prices are substantially declining, and housing is cooling. And those housing especially and insurance has been the two biggest inputs that have affected inflation. And I see both of those either hitting a wall or declining. So this should be good news for the Federal Reserve to get the green light to start lowering rates probably sometime in June.
Mark, do you share a similar view in terms of how the Federal Reserve will read through this?
Yes, I think they are well positioned to cut rates in June. I think by that time, we're likely to see some weakness in the employment numbers by then. I think the next couple of months we'll see that the payroll numbers will slow a little bit. My own read on the payroll numbers is that we're adding about 50,000 fewer jobs than is being reported. And so that'll eventually come through in either the April or the May numbers. We'll see that play out. But in terms of the inflation numbers, the markets are really on edge because of the increase in tariffs. When you look at the consumer price index, you can see how small goods prices figure in the equation. Services prices have been the problem. 2/3 of what we spend our money on is services. And so, yeah, goods prices are flat. They're actually slightly negative on a year-to-year basis. They were flat this past month. So we will see a little bit higher prices because of tariffs, but tariffs are put in place on the dutiable value of an import. So for a $1,600 iPhone, the part of the iPhone that's tariffed is only around $400. So now that's going to be a big tariff, because if it's 145%, that would add like $400 to the cost. But it's not the retail price. The tariff doesn't go on the $1,600.
Not necessarily, because they do, often you expect to see some pass through to the consumer. At the same time, there is this hope that you'll see carve-outs in some respect to the tariff. So for, say, Apple, like we saw in the first administration, or even on some of the chips. Tim, I'm going to give the floor back to you in terms of your expectations, since I think you're right that the way that the market is looking at this is it doesn't matter as much as the next reading that we'll get on inflation. But one of my takeaways I noticed with regards to used vehicle prices, a decline there. Do you expect to see more of that in the next print, especially given that the tariffs that we'll see on autos and auto parts?
Well, I think that the biggest component we need to look out for is energy. Yeah, and I think it's very underreported. Yeah, the extreme pullback that we've seen in oil prices, especially in the last month. Yeah, when you look at what sparked inflation to begin with in 2021, I think it was a combination of higher energy prices coming at us so quickly, along with the deluge in government spending. So now you're seeing the other side of that. I don't think you're going to see government spending come down nearly as fast as it ramped up, as much as talk as you hear surrounding the budget deal and DOGE and everything. That they're kind of playing around with the edges. It's energy prices that really affect the input of everything. And if you're looking at sub $50 barrel in oil, I think inflation just takes care of itself, and it's not the concern that it once was. And that gives the Fed the green light.
Okay, all right. We'll have to leave our conversation there. We are certainly seeing pressure on crude oil again today after a rally back yesterday. Thank you so much. We got Tim Davis, Stewart Partners, and Mark Bittner, Piedmont Crescent Capital. Thank you both. Thank you for joining us on Trading 360. I'm Diane King Hall. Download the free Schwab Network app. It's available in the Apple App Store. And tune in 24/7 on schwabnetwork.com. Stay with us. Fast Market is up next.
Schwab Bank Investor Checking, the checking account built for investors, named highest in client satisfaction by J.D. Power for 6 years in a row. With Investor Checking, you get the award-winning features of our checking account, plus cash management solutions, all designed for investors like you, with unlimited ATM fee rebates for cash withdrawals worldwide, no overdraft fees, and enhanced security features to keep your money safe. Also, because your investor checking account is linked to your Schwab One brokerage account, you can manage your checking and investing in one convenient location. Moving funds between your accounts is easy. Cash moved to your brokerage account is available in seconds. That means you can stop waiting and start investing in stocks, bonds, money market funds, and more. Get more with Schwab Bank Investor Checking, the checking account built for investors.
I have a question for you.
Sure.
When did Granddad first start investing?
Granddad had an account with Schwab before there were branches in the area. He really started with nothing. He worked hard, and after he passed away, the torch has been passed to me, and my advisor, Jennifer, she was with me with the journey. helping with the estate distribution. The 2 grandchildren planning for their college educations. Someday it'll be their turn.
Opportunities don't stop when the market day ends. So neither do we. Schwab gives you round-the-clock access to over 800 of the most popular stocks and ETFs, plus a wide variety of futures markets. All with 24-hour support from trading specialists who understand the ins and outs of 24-hour trading. No matter the hour, you can trade brilliantly with Schwab.
Whether you're a bull or a bear, you'll want to catch the latest market action on Morning Movers with me, Diane King Hall, live from the floor of the New York Stock Exchange, only on Schwab Network.
Accelerate your market knowledge
and shift your perspective into full gear. Real-time example trades, a full hour of trading insights.
I'm Tom White.
I'm Kevin Hinks. Catch me on Fast Market, weekdays at noon on the Schwab Network.
Fast Market, ready for you, ready to go at 12 p.m. Eastern on the Schwab Network. Traders, and welcome to Fast Market here on the Schwab Network. I'm Tom White. We've got a great lineup for you today. We're going to discuss markets, which are back deep in the red, and then we'll have some option strategies. We're going to cover JP Morgan Chase, which is down nearly 20% from its recent all-time highs into earnings tomorrow morning, and Meta Platforms, which continues to get price target cuts amid a potential fall in advertising spend. And like Folio has consumer sentiment data in Walmart, the retailer stock is down slightly this year and gave a company update yesterday at its investor event. Now let's take a look at the major indices, which are near session lows as we speak. The benchmark S&P 500 down 4.6%. The Dow off 1,570 points or 3.87%. NASDAQ 100 and the Russell 2000 both leading to the downside, off 5.2% in today's session. To help me break down all this red across the board, let's bring in my co-host, and that's Kevin Hinks. Kevin, give me your take here. You know, everybody was cheering yesterday and turned into tears today, and I'm not sure if it's just a little bit of a reprieve. Maybe that rally yesterday was a little bit too much, but at the same time, the tariff battle with China continues to ramp up after a pretty good inflation number.
Yeah. Well, here's what we know for sure, Tom. It is not the hard economic data that we're looking at, because last Friday's non-farm payrolls, today's CPI data, not good numbers, great numbers, Goldilocks numbers in terms of inflation and the strength of the U.S. economy, but no one cares. This is a market dominated by the headlines of yesterday. I think, I'm going to try and hold my tongue with how the media is treating this whole scenario. I just think it's extremely poor and biased, but I think you've got to still look for bright spots here in a market that, rallied 8% yesterday, is down almost 5% today, Tom. I think, the economic data is as strong as it can possibly be. It's amazing to me how good the economic data is. And Friday we were down, today we're down with really good economic data. So, headlines are driving the market, Tom. That can switch at any moment, but it's just a very frustrating market to trade, because the economic data, if you're a purist that wants to trade off economic data and earnings, pretty solid numbers here, Tom.
9.5% gain in the S&P 500. That was the biggest jump since 2008, the financial crisis. Not extending those, reversing. The VIX back above the 45 level after falling 35% yesterday on that massive broad-based rally. But let's expand this conversation. Bring in Nathan Peterson, Director of Derivatives at the Schwab Center for Financial Research. Nate, when you look at this market, we got good news today. CPI was, lower than expected. EU pausing their tariffs for 90 days in conjunction with what we're doing. But then you see a headline like, hey, the total tariffs on China are now 145%. Is that the reason we're down, or is it just that, hey, a pause doesn't mean a resolution?
Yeah, it is still because of the, continued uncertainty, and China is at the forefront of that right now. And, look, like you mentioned, if you're up 10% in a day like yesterday, the give back today, that would be expected to get some mean reversion. It also tells me there was likely a lot of short covering yesterday, meaning it's not like authentic buying. The other thing that kind of sticks out, we got taxes coming up. So if you just got a 10% bounce yesterday and you hadn't sold to help cover any taxes you might have, maybe it's a good opportunity to do so. So that's in play a little bit. And then look, CPI data is great. Kevin's right. Non-farm payroll is beautiful. I was looking at, the S&P EPS forecast from FactSet, looking at Atlanta Fed GDP, looking at the CPI. And then, part of me is just thinking, it's great. All of these numbers, though, given what has gone on over the past, it's been 8 days since Liberation Day, those numbers, you just can't put too much weight into them right now. And then also I'll say technically, yesterday we almost closed around 5,500. That was the March 13th low that we retested, and then we gapped down below. So there's some technicals in play there as well. But let's assume that you believe that the S&P is going to earn 260 to 270. On your dashboard, you should have, okay, what's our forward PE? Let's call it 19-ish, around there. I'll say this about the China tariffs. I think that, let me read a quote from the Ministry of Commerce there in China, because this is not good news. He says, if the U.S. insists on further escalating its economic trade restrictions, China has the firm will and abundant means to take necessary countermeasures and fight to the end. That's what he announced yesterday. So that's not very good news. I would say, though, the good news is that these tariff rates are so ridiculous that this is a better period in these negotiations to have these ridiculous extreme rates, because this is a better scenario than the U.S. goes 10% and then China counters and then they go 20% and then China, over just drawing out this tit for tat over time. And I think that was the whole intention behind coming up with those rates last week, that they would start at that quote unquote cap and go really hard, because they're saying, let's make a deal, let's make it quick. The market does have the opportunity to move higher on whatever that schedule is for those negotiations with the countries. You can imagine that's going to be well received if and when we do get some of those confirmation that those deals are in place. But in the meantime, we're still living in this uncertain world.
Yeah, Kev, when you look at this, the pullback, we're giving up half of yesterday's gains here at this point. The tit for tat, the schoolyard brawl that we're having, it doesn't feel like either side's going to back down at this point. Is this what, traders and investors should focus on? If you're optimistic that, hey, we're going to get deals done over the next 90 days with the majority of these countries, and we can still rally if China's not involved in it and they don't bow, to the administration at this point with the tariffs. What's your point? What's your take on this? Because it just doesn't feel like it's going to end. But at the same time, just like yesterday, all it takes is one headline to reverse everything, right?
We are in the if, could, and possibly economy is where we find ourselves right now. If this happens, it could do things like that and possibly cause these problems. Did you see the news report yesterday or this morning? China is going to restrict American movies released in China. That shows you when you have a 5-to-1 trade imbalance it shows you that China doesn't have a lot to play with here. If that's what they're doing to try to hurt America is restrict movie releases. You think that there's other things going to be coming, but I'm not sure China has the hand to play. And I think Nate made a great point. The severe tariffs now reaching 145%, that should bring China to the negotiating table, right?
Yeah.
The rest, the people that haven't escalated, now it's up to 75 countries already at the negotiating table. So the market is dealing with uncertainty. Market doesn't like uncertainty, it never does. The bet is, or the thing you have to look at is, what happens if all this gets less uncertain? Because we keep piling up really strong economic data points. And by the way, the rhetoric that you hear on financial news all over the place is tariffs are going to raise prices, it's going to bring inflation, Fed won't be able to cut. What about today? What about the CPI today?
Yeah.
What no one talks about is crude oil getting destroyed and dominating CPI. So yes, did some things go up? They still have eggs up 5.9% in the last month. But crude oil and energy in general are dominating the CPI in lower numbers, Tom. No one mentions it, right?
Yeah.
It's not mentioned. All it is other things that are higher. Owner's equivalent rent. Rent in general, very modest gains. How about this? Airfares, down 4% a month ago, down 5.3% this month. So that's almost 9.5% airfares have come down. Gasoline prices, where's my exact number? 6.3% in a month they've come down. So many things that touch the U.S. consumer are getting better, but no one talks about it. No one talks about how on the way up in inflation, it was energy that dominated. There's still some things out there that are inflationary, but energy coming down negates all the others, Tom. So
Yeah.
I think the inflation picture is much better than everyone thinks.
Yeah, and they said that in 2018 in his first term that tariffs were going to cause inflation, and they didn't. Inflation actually held and went down, and pretty good numbers here today. Nate, you mentioned valuations on the S&P 500. Can earnings rescue us? We're kicking off earnings season tomorrow. We're going to talk JP Morgan here in a bit, but can earnings rescue us? Because I just don't see that being a catalyst that might be positive just because of all the uncertainty out there. How do you give guidance in this type of environment? I think that's going to be maybe, what traders are looking at moving forward.
Yeah, it's not, earnings cannot, and guidance is not going to be enough to override the tariff and the China situation. I mean, that's really what the market is just focused on. It's like a TV right in front of the market. And so that's going to be primary. I was looking at CarMax's numbers this morning. I didn't think they were that bad. They missed a little bit on the top and the bottom. And then their guidance called for, we're looking for we're going to build new facilities, and we're looking for double-digit EPS growth. And then the stock, they're killing the stock down to a 52-week low. That's not a great indicator, but maybe they're just doing that because, they're putting, used car retailers in that cyclical, gonna get hurt if growth goes down type of category. So we'll hear from the financials tomorrow. There are some green shoots that potentially could be in place for financials. On the one hand, on the bullish hand, on the bearish hand, you could say, yeah, but they tend to be cyclical and tied to economic growth. They're one of those economic barometers, like an oil. And so, I just feel like the sooner that we can have this bringing China to the table, and look, the tact, the approach in going after China in such a manner that the U.S. has, it's a little bit concerning to me because, you want to give President Xi an opportunity to save face. I mean, if you haven't worked out in 20 years, don't go start doing, squatting 300 pounds without a back brace. Work into it gradually, give them a chance, give them a little bit of slack, give them some room, give them some opportunity. I thought that President Trump might have been doing that yesterday when he announced that NVIDIA could sell its H100 chips over to China. I thought that might have been a little bit of a give towards China, saying, hey, we're willing to begin to inch towards each other. So if we can see more of that, that to me is the most important thing here over the next couple of weeks.
Yeah, definitely. Earnings going to be in the spotlight along with those tariff headlines. Kevin, you look at moves, and you mentioned crude oil down nearly 5% today, back below $60 a barrel. The dollar just getting whipped down near the 101 level. I mean, what's your take on that? I mean, is it causing a little bit of consternation that we don't have a strong dollar? Is that lending a little bit of headwinds to equities at this point? Because sometimes, you know, the dollar down is not a bad thing.
No, historically, I know it's counterintuitive to people for people to listen to, but a lower U.S. dollar favors U.S. multinationals. So a lower U.S. dollar, though it doesn't sound like pleasing to the ears, is actually what you want. Now, I look at several macro indicators. Crude oil, we already talked about. 10-year yields down significantly this morning. Remember, Scott Besson talked about lower energy, lower 10-year yields. Lower 10-year yields, look what mortgage apps did from last week. Big jump in mortgage apps. That's stimulating housing. What about crude oil? That's energy. That's what everyone uses. Those are the tips of the spear for the Trump administration in terms of bringing down overall inflation. I think the U.S. dollar. It's like I said, it's hard to understand, but a lower U.S. dollar is better for U.S. multinationals. So all those things. I think the gold rally is significant, but it's a gold rally buying gold, selling Bitcoin, it appears.
Yeah.
So that's kind of a mix there. But Tom, these are still uncertain, headline-driven markets. It's very tricky to trade, and you got to just keep trading, keep moving positions around, and that's where we are. Earnings season starts tomorrow. I think the banks. I'm sure we'll talk about that in the next segment. Going to have a real tough comps from the last couple of years in these banks.
Yeah, with tough comps and tough guidance, perhaps. There also maybe gold moving up on that lower dollar, also providing some strength with maybe some central bank buying at this point during the uncertainty. All right, guys, let's take a quick break. When we come back, we're going to kick off earnings season. We're going to talk J.P. Morgan Chase, the banking giant stock, down about 7-8% so far just this month. We're going to cover the banks, and maybe they're going to have better guidance than expected. I don't expect that. Talking banks when we come back.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Are you an active trader? Our active trading webcasts are designed to help you develop a deeper understanding of technical analysis, options, futures, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to schwab.com/coaching and start learning today.
No politics, no noise, from bell to bell and beyond. Available anytime, anywhere, on any device for free. Schwab Network.
Welcome back to Fast Market here on the Schwab Network. We're talking earnings. JP Morgan Chase reports in the morning. The stock is now in bear market territory on this slide that we're seeing of 5% today. Kevin, when you look at this one, it's the biggest bank. They've got the rock solid balance sheet. But you have to start taking a look at the consumer. And, the banks have all the data, right, Kevin? And we're going to hear some more clarity on it. Is this going to be one of those reports? Jamie Dimon's talking about recessionary risks at this point. Is this going to be one of those reports that sets the tone for earnings because they've got such a clear picture of the consumer and the economy in general?
Well, I think that one of the biggest stories going into these banks' earnings tomorrow, especially JP Morgan, is the comps. They're looking for $4.61 a share in earnings per share. That's flat year over year. $44.1 billion in revenue. That's down 0.1%. The comps from the last 2 years are big and massive, Tom. That being said, some of their numbers like loan growth and things are all going to be better. But Jamie Dimon, who I think yesterday we proved has the ear of the administration. When he speaks, people listen. And he was one of the leaders that came out yesterday and said, and Trump admitted that he listened to Jamie Dimon, and that's one of the reasons he gave that 90-day pause. Now, they're in everything. And you're right, Tom. Them and Bank of America, they have a keen insight into the U.S. consumer and how they're doing. So I think JP Morgan, a great name to start off earnings season because we'll get so much information on the health of the economy from them, Tom.
Yeah, and Nate, bring it back in here. Jamie Dimon yesterday, before Trump came out and paused tariffs, said a U.S. recession is a likely outcome. Probably flip-flopped. Goldman Sachs already took their recession expectations down to nearly zero after the pause. But, there's still a lot of uncertainty out there. As I mentioned before, a pause does not mean a resolution at this point. But, I think the financials are a good leader to lead off earnings season just due to the fact that they've got such a grip on what the economy is doing, right?
Yes, and they're, they were one of the best performing sectors post the election. There was a lot of talk about deregulation and, capital markets opening back up in order for those to be some of the, factors working in financials' favor. Yeah, Jamie Dimon, I know he said it's still likely there's a recession with the sweeping tariffs, maybe some, we'll get some defaults, etc. I will say, though, Jamie Dimon also has been pretty bearish over the past couple of years. You remember he said the storm was coming and that. So I would expect, him to have some cautious commentary. I expect, guidance is probably going to be limited in terms of visibility. I would expect, probably their Q1 earnings reports is going to look pretty good just because they are the king. I mean, Jamie Dimon is the godfather in finance. I mean, that's who the White House turned to back in 2008 when we were going through the GFC. So it is the best run bank out of the bunch. They've got, 2.4% dividend yield. Forward PE is 12.8. Yes, financials are one of those economic barometers. So should we go into a recession? Yeah, financials are probably going lower. On the flip side, if we go into a slower growth type of a period, financials are one of those sectors that can see some money flow because they have that dividend yield plus, historically low PE valuation.
And if you take a look at the option market, they're pricing in about a plus or minus 5% move. And, Nate, we typically don't see big, massive moves in a lot of the banks. That's maybe why their volatility's a little bit less than maybe some of the other sectors going into earnings, but they're still expected about $11.30 move either way at this point. How do you want to look at this one from an example trade?
Yeah, so, if you're feeling like, that like I mentioned on Monday, we hit that 50% retracement level on the S&P 500 from the October 22 low up to the February high. if you believe that that's, probably the line in the sand, our PE was around 18 down there, that, provided we're not in a recession, the market feels fairly comfortable with that 18-ish type of a PE. JP Morgan did get down to 202 on that day, but then they closed, well above 210. So there has been some bid support down there. So if you were bullish on JP Morgan heading into the report, let's keep in mind the stock was 280 back in February. Then one way you could approach it, because that implied volatility, which really stuck out to me, is you could sell a cash secured put. At the time of the trade, I was looking at the 215 strike. I was basically trying to go outside of that applied move of roughly $11, like you mentioned, Tom. And at the time, it was about $2.50. It's about $3. Let's see what it is.
$4.50.
$4.50. Thank you. so yeah, this is the markets we're in, right?
Yes.
So if you were asking me right now for the same example trade, I'd probably go to the 210 strike. It has 115% implied volatility for one day for tomorrow's expiration. It's about $3 that you can get there. And what I think about is that potential bid support and, seller's exhaustion, let's call it this week, perhaps, that we saw. If you believe that was the case, yes, if you sell a put at 215, you're going to have to set aside $21,500 for the potential that you get assigned that 100 shares of JP Morgan. But what sticks out to me is that that's a big move on a stock like JP Morgan. You can get 2.5% return in one day, which, it's up to the individual trader whether or not you feel that fairly compensates you. But this is one of those opportunities where you have the VIX at 45, the stock's been beaten up, and you might question, has the near-term worst been priced in?
Yep, let's break this one down. And it's about the strategy. That's what we're going to focus on here because this is a cash secured put, April 11th option. So as Nathan mentioned, just over 24 hours till expiration. This is a really short-term example trade here. Selling the 215 strike put. We've got 250 credit on there. You can probably collect 450 right now at that point. But if you collect 250, as Nathan mentioned, that's what you can make on $250 per spread. He mentioned the risk on that if the stock were to somehow go to zero. But it's almost like taking a stand here where, hey, you have to be comfortable owning the shares if the stock does fall below that 215 level over the next 24 to 26 hours or so. Kevin, when you look at this, you got a lot of risk on this. As Nathan mentioned, markets are moving. You could pivot this down to the 210 strike. You could pivot it down to the 205 strike if you want. It's based on probabilities of finishing out of the money. But what's your take here on the cash secured put? You've got to have a firm idea that maybe the stock's going to at least stay here, or you're comfortable owning it if it does fall, right?
First thing, the probabilities. 215 puts 61% chance of finishing out of the money. 210 puts 71%. 205 put 79%. 205 put still trading slightly over $2, but almost an 80% chance of finishing out of the money. Now let's get to this trade. Remember something. If you sell the 215 put, you don't buy the stock at 215. You buy it at 215 minus whatever premium you take in. So if you take in, like you said, 450, your break even is 204.50 and change, way down there.
210.50 on the 215.
210.50. Sorry, yeah, that's right. 210.50. Sorry. So 210.50. So your entry level is going to be way lower, and that's where you break even on this trade, Tom. So anything above there, you're profitable. I mean, this stock can sell off $10, and you're still right at the break-even point. So I think
we dropped more, didn't we?
That if maybe you were going to buy JP Morgan stock anyway down here after the earnings, this would be one way to do it. It's not void of risk, Tom, though, as you know.
Yeah, and Nathan, this is actually a good lesson, because, the market was only down 3% when you looked at this earlier. Now it's down 6%. And those puts are now worth $5 at this point. So it gives you a little bit of semblance of, hey, you know what? You got to make sure that you're comfortable with the risk in this trade. But you can always close it in tomorrow's session after the earnings if the stock does fall, if you don't want to be assigned the shares if the market's open. And that could be one of the ways to manage this trade, right, Nate?
Yeah, I mean, this is the environment we're in, guys, and it's risk reward, as you know. VIX at 45 to 50. I haven't checked it. Maybe it's up towards 50 now because it looks like we're at the lows of the day for the market. But yeah, to Kevin's point, yes, it's a way to, if you were going to buy it right here, well, maybe you sell a put. It's just for one day. You get 1 point whatever percent, depending on the strike. That's pretty good compensation, in my view, for one day. Or you're going to buy the stock at a lower price. And yeah, that's the market we're in. It's almost like you to bring up your 10-minute bar chart. You have to move from the daily to the 10-minute charts because it's just that type of environment that we're in. So yes, Tom, to your point, you've got to manage. Gosh, everything's on steroids a little bit if you're a trader. If you're a long-term investor and you want to own the stock, maybe you're comfortable with saying, okay, this might be the first leg of my 500 share position, and then I'm going to see what happens with the developments around China. If you're a trader, yeah, maybe you want to be a little bit more nimble in terms of being willing to take that profit rather than trying to get an extra 50 cents, 75 cents by holding till the close.
Yep. Markets are volatile. VIX is
yes, they are.
54 level at this point, but we just jumped 30 points in SPOOs in literally 1 minute. So watch out, say risk defined. This trade is risk defined, but you've got a lot of capital they have to keep in case you have to buy the shares on that one. All right, let's take a quick break here. When we come back, thanks to Nathan Peterson, Director of Derivatives at the Schwab Center for Financial Research, for joining us. But when we come back, Landon Swan from Likefolio, he's going to join us to take a look at sentiment data in Walmart. I can't even speak right now. It's like the markets are getting in my head. Retail stocks falling about 15% from all-time highs that we saw just in February, but they gave some positive comments yesterday. Stick around.
Trading at Schwab is now powered by America.
Kind of wanted to reverse.
The power of Thinkorswim, the award-winning trading platforms. Bring your trades into focus on Thinkorswim desktop with robust charting and analysis tools, including over 400 technical studies. Tailor the platforms to your unique needs with nearly endless customization, and track market trends with up-to-the-minute news and insights. Trade brilliantly with Schwab.
What's up, Carl Nation? It's your #1 broker with the best full-service wealth management skills in the biz.
Actually, I'm seeing something from
In
Schwab.
the biz.
Uh-oh.
Yeah, Schwab lets you invest and trade on your own.
And if you want, they can even manage it for you.
Not to mention, Schwab has a team of specialists for taxes, insurance, and estate planning, all with low fees.
We're experiencing technical difficulties. Carl.
Schwab, a modern approach to wealth management.
Whether you're
Well, that
an
kinda hurts.
experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Do you like using charts when analyzing your stocks? Our technical analysis webcast series breaks down different charting techniques like trend analysis, price patterns, moving averages, oscillators, and much more. Best of all, you can ask questions directly to an education coach. It's interactive learning at its finest. Tune in live or on demand. Head over to schwab.com/coaching and start learning today.
Welcome back to Fast Market here on the Schwab Network. It's time for our cash tag segment. For that, let's bring in our next guest. That's Landon Swan, co-founder of Likefolio. Landon, welcome back to the show.
Thank you. It's great to be here.
All right, so we're talking Walmart. This stock's actually up 1% so far this month, basically flat on the year. It's come off its all-time highs, but are people using this as a safety play? Do you have the data that kind of backs up that, hey, maybe Walmart's going to be a beneficiary, because even if we go into recession, people are still going to go to Walmart and maybe trade down. And
they'll go to Walmart more. It's the recession stock.
People will still be spending money, and they're spending it at Walmart, right?
Yeah, I like the win-win scenario for investors there. There's some truth to it. I mean, when you look at Walmart and maybe compare them to like a Target, there's a pretty big difference when it comes to exposure to both tariffs and just economy strength in general. Obviously, Walmart has the necessities.
We're reversing some here.
Focus for consumers, which if times get tough, inflation or just a tough economy, then they're going to benefit obviously as more customers are going to go for that as a higher percentage of sales. But they do have a lot more international business. I think about a third of their sales come from orders from other countries, whereas Target is, it's all U.S. or a lot more U.S. and it doesn't have any, it doesn't have.
Oh, that makes sense. I never thought about that.
Walmart does. So, I think that's a big factor in weighing those. And you can kind of see how the stocks have behaved over the last month or so. Both of them obviously are down since their last earnings report and since all this tariff talk. Yesterday was fun too. But if you look at Walmart overall, last quarter they did great. They beat revenue, they beat earnings. They sold off from I think 104 down to 96. Now we're down to about 88, 89, somewhere in there. Their U.S. sales were up 5%, international down about 0.7%. But what's interesting to us is that their e-commerce, so if you look at their web visits, it was up about 14% on a year-over-year basis, and that fell right in line with what they reported at 16%, plus 16% year-over-year on their e-commerce business. So we're tracking that really well, and you can see that Walmart and Target are both positioning themselves to start to take little bites out of Amazon. Now, look, Amazon is still flat. It's not a negative number. But the fact that they're growing just shows that more and more people are getting comfortable shopping other places other than Amazon, and that that basic monopoly is starting to fade just a little bit. One of those, I think, reasons is that they over the next year or so, they expect to get to the point. Walmart expects to get to the point where anyone who places an order in the U.S., or 95% of households, I should say, can expect delivery within 3 hours. That's incredible. We can remember when Amazon was 2-week guaranteed, then they got the 2-day guarantee with Prime, and that was unbelievable. 3 hours is just nuts. So I think Walmart, because of its locations, and we've talked about this before, just consider each one of its stores a distribution center. And you can really see how they can dominate delivery and dominate web business. So they're well positioned, I think, to weather this. And, depending on where their stock goes, they could start to be kind of an attractive buy, and maybe they're a little bit oversold. They did talk about how they think that, the consumers who are becoming price sensitive, if tariffs do, continue to go up and pinch people at the register, they're going to go to Walmart because that's where people know that the low prices are. Walmart focuses on necessities, whereas Target is more discretionary spending. So they're positioned, I think, like you said, in a kind of in a win-win scenario. And I guess we're just going to have to see what happens over the next, I'd say a week or two, but it might be today. You never know what tweets are coming out and what might move the market. I like where Walmart's positioned here. I do think it's a bit of a win-win. Either way, because they have both options available to them, and the stock is starting to get to that point where you're like, all right, we're in a good buy situation here.
Landon, last quarter was pretty significant in terms of earnings because that's the first time that Amazon overtook Walmart in terms of revenue for the month of 187 billion. Beat Walmart. I think Walmart came in around 180, but Walmart has the grocery moat, right? They are now the leader in grocery, and that brings in cash flow, and that brings in, all the other things that make them, that really Amazon can't compete. Amazon competes very well just about everywhere else, but it's that, you mentioned it.
SPY reversing 525s.
That keeps them competing, because people that can shop at Walmart without going to Walmart are the new customers that are helping them grow, and they just keep doing it right. It's amazing the size of this company, how they still act like a lean, agile smaller company and move around and change things. But I think we're down to 2 players. You mentioned Target. Boy, I don't know. Target keeps disappointing. I know you guys have been positive on Target in the past. They just don't show up. The numbers aren't there, Landon. But Target with grocery, Amazon with everything else in e-commerce, these are the 2 major players going forward.
Yeah, Walmart with grocery, I agree. And you know, I tell you what, Target for the longest time for Likefolio data was strong, very strong, always rallying. And then, you know, 2 or 3 years ago, I can't remember when the year was, but they got themselves into a little bit of a trouble, you know, getting politically involved. And it's just a no-no with customers. Customers will always assume that you as a business agree with them as long as you don't say anything. So just don't say anything. And Target kind of, you know, put their foot in their mouths with politics, and then from then on, it was just kind of, you know, an open door for that argument of, well, yeah, Target's nicer and everything, but maybe I will go to Walmart. And now, just
I don't know if it's nicer or not.
You can buy from Walmart without going to Walmart. What a win! So you got either you know, that kind of customer, you can buy from Walmart without going there and get it within 3 hours, and it's probably cheaper than at Target, and it's delivered to you. Or if you need something and you want groceries as well, there you go. I mean, and they're all over the place. Everyone lives close to a Walmart, so their footprint is their biggest advantage. And as we're seeing, their web is growing, and yes, Amazon is dominant. You know, they're passing them in revenue. They're huge, but Walmart has a lot of defensible moats here. I mean, I think the grocery, like you pointed out, is enormous, and then just the footprint, the amount of stores that they have close to the population. Everyone is near Walmart. Those are all either quick stops for people, or you need groceries, or you got the quick delivery. And, you know, Amazon, for all the, you know, we can rewind time, 10 years or so, and Whole Foods was going to take over the world because of that acquisition. You know, it really comes down to number of stores, and it just, you know, they're not even in the conversation anymore. So, you know, it's interesting to see what happens when a huge company like Amazon tries to compete in these other areas. You always assume they're going to beat the competition, but in the end, it's really who executes better and who's got the size. And in this situation with grocery, yeah, there's no contest. And again, I liked Walmart yesterday at 82 better than I do now at 89. But you know, it's going to move around a lot. And I like investing in it here. I like trading in it here. But of course, if you trade it, you got to be risk defined with what's going on now. So I'm sure you got a cool trade loaded up for us, Kevin. I'm looking forward to seeing it.
All right, great stuff. Great data as always, Landon. Pretty positive on Walmart, and I think a lot of people are. Citi named it their top pick today, this morning. All right, great stuff. Thanks, Landon.
Thanks, guys.
All right, that's Landon Swan, co-founder of Likefolio, breaking it down for us. Kevin, they had their investor day yesterday, Q1. They said in line for their outlook, 3 to 4% growth, but they lowered their fiscal year 26 EPS view just a little bit. But they said that Sam's Club's picking up some slack, consumers still spending. Tariffs, you know what? They got scale, Kevin, and they said immediately when Trump started talking about tariffs, hey, China or our suppliers, you better start lowering your prices because we're not taking on the tariffs. You are, and that's what scale does, right, Kev?
Yeah, they have the ultimate amount of leverage because they are such a massive buyer of goods. And you're right, they made headlines coming out and saying, they made a lot of headlines lately. The first one was, remember the last earnings report when they guided very conservatively.
Yeah.
So let's see when they have earnings. They have earnings coming up May 15th. Let's see how they guide again then. But this is a company that is, remember, Tom, we talk about a lot in this show about companies with low float. Well, this is the opposite end of the spectrum. They have 8 billion outstanding shares. So this is a massive company.
They're screaming and yelling again.
So, but they dominate grocery, Tom. I think the game is over in terms of grocery, and they've won.
Yeah, break down your example trade. We got it up here on the screen. It's a complex trade here, 4 legs.
Exactly right, Tom. You know, they don't have a big amount of premium in their options. So what I did, I looked at a complex trade where I went out to the May 2nd expiration, not this week. I went out a couple of weeks, and I sold the 88 83 put vertical. Now, the stock has sold off a little bit since then.
I might try these
88 is a
spies.
little closer at the money, so that's a bit aggressive. Sold the 88, 83 put vertical in the May 2nd, and against that, I bought the May 2nd, and then next week, April 17, 95 call calendar. So I put that in, it was like 25 cents. It's even higher now, Tom. I think it's around 50 cents now credit. But, you know, what that means is you have no upside risk if it even goes up and through the strike, but you do have downside risk. That 88, 83 put vertical that is only $1 and change away from the money has got, you know, if you do it.
These spies right here, I just saw them go from like 258 to 332. I just sat there and watched them. Got some pretty good little spread on them. We're back to 281 now. Inverse head and shoulders. Here we go. We're back to 250. Touch the right shoulder again. Spy calls. Shit. Oh, I'm doing the 10th. Oh! They're 274. There we go. 308. $348. Bingo, baby. Oh man, I needed that. See that, punk? We got a full room today. Everybody say hi in the room. Bye, Spank.
They call them dumps, big massive dumps.
Okay, I just had a successful scalp, and I'm getting ready to get right back in it again. If we can hold this, we're going to be very bullish. If not, these 525s got some good move to them. So I called a head and shoulders here before, and then it came back down and touched that right shoulder. Might do a little video on this. In fact, I'm going to. The wind's picking up outside. I can hear it. Damn. This weather's been something else this year. Good afternoon, retail traders. This is a sneaky snake trading strategy where I talk about chart patterns, moving averages, and being in the now. The market felt a little boring to me, so I went back and took me a little nap. And when I got up, I started looking at the SPX and the SPY, and this is what I found. So I'm sitting here. We were doing a double bottom, and we started to break out of this here resistance level. Then we came back and we respected, which would I call it, head and shoulders. So when I'm looking at a head and shoulders, inverse head and shoulders that is, I tell the room, I say, hey, I think we could pull back to this right shoulder one more time. Usually when you pull back to that right shoulder, that's a good entry idea to get into the trade instead of jumping in early. So we started to break out a little bit, and then it pulled back. I've seen a lot of movement in this stock, in the price, just in that little bitty move, the 525 strikes. So when we came back down, this is called an inverse head and shoulders. And when we hit that shoulder the right time, I jumped in the trade, and I run it on up, and we were at 240, and I got out, and it ran all the way up to 248 within 6 minutes. And on the way back down, I sold this thing at around 233. So that's just kind of an idea when you want to take it's kind of an idea when you want to take the head and shoulders, wait for that second pullback, and then jump in it right there and scalp it real fast. That's the sneaky snake trading strategy where I talk about chart patterns, moving averages, and being in the now, and how to play an inverse head and shoulders at the right time. Boom. Okay, who wants to reprimand? Who was that? Was that you, Punk? I mean, Funky? I got to get out of that calling you punk. Let me see here. I needed that trade for that loss I had earlier. Boom. Damn, 461 now. You idiot. I think I just keep telling myself that these patterns are bullish and I need to stay in them. They went to 4 something. Jeez.
Wild move in itself. We'll close things out with GM, which lost a bull from the sell side, and shares now falling into negative territory for the week. So, Kevin, as always with upvote, downvote, these are not endorsements or recommendations, but we'll start off with the behemoth that is all things Tesla, as Tesla is now pulling back almost 9%. I'm curious if
And what are you going to do? You're going to badmouth it again?
With the overall markets, where maybe this is overdone, but also Tesla made a huge move yesterday.
Yeah, well, we also see, obviously, a little bit of tariff risk when it comes to Tesla. They might not be getting hit as much as, say, a GM or a Ford, but there is still some risk that is out there. A lot of those electronic parts, they are sourcing from China. If we continue to see these tariffs getting ratcheted up, which it did appear that the White House did actually confirm that the rate on China is actually a little bit higher than what the market initially expected here. We might see some pressure when it comes to Tesla, but a lot of this is political risk, maybe stretched valuations, uncertainty when it comes to sales, maybe the lack of the EV credit also could kind of dampen demand. So there's a lot of pressure here. We do have UBS actually reducing their price target on the stock to $190. That's down from $225, and they did have a sell rating on the shares here. Once again, worried about the trajectory of 2025. Maybe the earnings projections right now for the market are a little bit too high given the environment that is out there. And that's just something that we're probably going to see across the board when it comes to a lot of these analysts. So stock's been getting hit, but it has been trying to at least trade in a wide range, but it's maintaining right now. It hasn't fully broken down yet.
I think it's so interesting because this has been so much read as the name that's the most resilient to tariffs. I mean, that's been a months-long now narrative, and I totally agree with you, and I think good point that just keep in mind that it's not entirely a U.S. company. Actually, its Model X as well as its Model S have roughly 65, and the Cybertruck, 65% of their parts derived from.
Okay, here we go again.
Model Y is about 70%, and 3 Performance is 70%.
And these things are.
As well as the 8 WD and RWD is around 75%. So
this is really too late in the day for me to be playing the same day. But the 225s are back down to 256. I don't have that much experience on, this time of the day, start playing these late. And the SPY in a way. I can't believe the run it just had just a second ago. This is about where I got in the trade at it, at the price wise, and you can see it's depreciating. We're at 223 now. I'm gonna wait. But the exit idea was that we hit that 200, so if you were in it, that would definitely have been a place to get out of the trade. That's on the 1 minute 200 SMA. And we respected the 63 here. I could have jumped back in it, maybe. But I was doing that video. Okay, we're back down to the right shoulder again. Let me see if I go into the next day. Where are you? So let's get rid of that one. Go into April 11th. Oh God, they're expensive. The 530s. Well, oh, there we go. The 535s. So 535s at 246. No, no. Might have to put a stop on this one. We got Amazon earnings coming up or something because they keep talking about it. Breakout. This one seemed a little more riskier. I'm down 30 cents. Good idea to stop out of it. breakout. Well, thank you, Johnny. Johnny Jack. That's a nice thing to say. Send them my way, that's for sure. You don't mind if I share that quote in the room, do you? Because that's what we had right there. I went ahead and shared it. Well, I need this one here to break out. I'm almost back to even. I didn't feel like adding on, but here we got a pullback. So we need to break this shoulder line. Here's the inverse head and shoulders. We got to break that. I'm back to even. What's that? It's now 12:20, 1:20 Eastern Time. Jeez. Sounds like they're getting my place now. Clean my windows. Well, this one ain't working too well. Jesus. Y'all hear that? Oh, your new glasses are in? Oh, they're here! I need my glasses bad. I might go get them after this trade. See more, be more. Your new glasses are ready at Lens Crafters. Stop in anytime soon. See you soon. And I just bought these at $2 with all that frickin' noise outside. That was powerful. Come on, Jimmy. I really want to get my glasses bad. It's been a nightmare wearing these things. So I might just run and get them. If I can get out of this trade even. My new glasses are in. No, you didn't miss much. My new glasses are in. That just made me so happy. $228. Go, baby, go. My new glasses are in. $243. Should I sell it here? So this here is a snake, breakout, pull back, double bottom to the 63. I'm up 40 bucks, well, I'm up 20 bucks a contract. I'm up a couple hundred. If we break it and come up here to the top, I might have a nice little treat. $251. Now this is where I have a hard time wanting to sell it. Should I sell it, Randy? Mike, should I sell it? Francesca, should I sell it? Or are we going to break and hit the 200? No spamming. Who's spamming? Francisca? That ain't right. I gotta see what problem is with this thing. You didn't have any dirty talk, huh? Question is, should I sell it? I think I will, because I want to go get my glasses. $262. No, man, hold on to it, Jimmy. Take it to the 200 and exit, or get close to it. Oh, I got a song. They're now at 271, 275. You gotta watch this tape. They've been cutting me short here all day long, so I'm going to take profit. My exit idea is the 200 EMA, and as I start to get close, I want to go ahead and sell it because I got something else on my mind. Out at 276. You were always on my mind. Leave a runner till 55 what? What the hell are you saying there, Funky? EMA cloud? Oh, your cloud chart. Your Ichumucho cloud. Am I correct? Are you wouldn't have to be Asian, are you? Funky? Are you Asian? I love Asians. He is. Asians don't stink. They smell real good. I've tasted many of them. I got out at 276. Okay, I'm going to go get my glasses. I've never been so happy in my entire life. Hello, my name's James Howard. I'm here to pick up my glasses. And I'll leave this thing on until I get back.
Learn more when TSMC actually reports earnings next week on Thursday, the 17th. So we know the sales number, won't be any surprises there. And then in terms of what Wall Street's looking for on an earnings per share front, $2.02 is really the number to look for. And then, of course, outlook is going to be key, as it always is in earnings season. But it seems like especially this coming earnings season here. TSMC has said it expects revenue from AI to double in 2025. We talked about the 42% growth rate that they saw in the first quarter. They are forecasting mid-40s annual growth rate for the next 5 years. So they're really looking for that growth, the double-digit growth to continue. Tariffs, of course, add a layer of uncertainty. Semiconductors haven't been included in the tariffs, and we know that TSMC has been investing heavily or promised to invest heavily in.
It'll break out, of course, and I'll come back and I'll say it's at $7. We hit the 200 and we're out. This is the happiest day of my life. Would you be my wife? Well. Okay, I'm gonna go get my glasses.
Even just been specific to some of the tariff news.
If I can get out, this guy might not let me get out.
AI also, for some reason, strangely continuously lagged, even though I don't really know how necessarily everything has to do with one another. I guess it's just the overall beaten up sentiment of this market, unfortunately. We so appreciate it, though. Great breakdown on TSMC. Caroline Woods, the senior markets correspondent for the network. And now, KG, when we look at trading this name, just for example purposes, again, of course, the thinking here, we have earnings.
My new glasses are in.
And we also do have a lot of volatility we can continuously expect. So you have the very difficult task of walking us through your brain here.
These are nice glasses I got.
Yeah, just given the fact that we do have
that transition kind
the numbers that we have today, if you kind of look at the monthly numbers,
might pick me up a shirt too when I'm there.
The market has been selling on that news as of late, and I think it's because of the lack of enthusiasm when it comes to smartphones, which is actually a really big margin driver for them. The GPU side is really not. So kind of giving that kind of context here, looking at primarily a bearish trade, but also having a little bit of an upside kicker just in the event that we do see a broader market rally here. So looking at buying the May 2nd 150 put, selling the May 2nd 120 put, so a 30 points put spread to the downside, but then also buying one of the May 2nd 180 calls. Doing this for a debit of $8. Now the max loss is going to be $800. The debit paid for this particular combo, but the max gain is technically unlimited because the call side provides you a lot of upside potential. The stock can go up to infinity with 2 break-even points to the downside, 142.
Says $500 right there on that trade.
This is a trade where you want to see a move for this stock, and just given once again the heightened volatility that we're seeing in the semiconductor space, this name in particular, as well as the broader equity market, it seems like we will have some form of a move here, but you would like to have a very significant move either to the downside, getting below 120 at the time of expiration, or to the upside, getting above that 188 at the time of expiration here in order for this trade to really try to be profitable, Jenny. So you're going to need to have a move, and unfortunately, if you actually have the stock kind of staying where it's at right now, you will have some time decay, some theta decay, especially on the call side, that will eat in to the profits here. So you're looking for a rapid move fairly quickly.
Yeah, and also, like we said, we have earnings on April 17th, so this would include that premium from earnings, but also that movement we could see potentially as a result of earnings, and I'm sure this name will move on the back of some of the other major tech earnings. So a lot still to look forward to in the coming weeks ahead, though. We'll leave it there. But coming up next,
breaking out
the latest with the U.S. and tariff tensions regarding some of these Chinese restrictions now curbing actually U.S. film imports. We'll also look at the outlook for airlines as the 3 major U.S. carriers today are all down over double-digit percentages.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Are you a long-term investor? Our investing webcast series breaks down different investing styles, including growth, value, income, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or on demand. Head over to schwab.com/coaching and start learning today.
I'll be back.
I'm Nicole Petalides, live from the New York Stock Exchange. Catch me on Schwab Network, available anytime, anywhere, any device, for free. Schwab Network.
I'll look something up here before I leave.
Welcome back to Next Gen Investing. It's now time to talk the latest with the ongoing drama that I'm sure is far from over with the U.S. and China, as China is now curbing some U.S. imports actually on various films. So this is wild. This is a weird approach to take, but that's, I think, the nature of a trade war right now. So joining us is Diane King Hall, the host of Morning Movers, and of course Kevin Green, my co-host today. So Diane, the news just continues to excite and also unfaze me at this point. I have a very mutual reaction to the fact that Trump tariffs we're getting a response overseas, of course, and some of the targets are so funny, like the EU imposing all of these restrictions and saying bourbon is safe. Now the China coming in with these U.S. film imports. I mean, it's just, walk us through the latest and greatest.
It's no surprise to see this, especially when you put it in the perspective of Trump 1.0, President Trump's first regime, when his approach was to tariff. And we know that behind this is basically the view that China is viewed as having unfair trade practices. And it's not just coming from the presidential administration. Neutral parties see it that way as well. But the tariffs that, as they are being applied to China, are seen as more dramatic, more extensive than many expected. So essentially get ready for even your Shein packages to cost even more. So we were expecting a certain level of imports, but now it's this jaw-dropping 145%. This is far above the level that many economists had warned could cripple U.S.-China trade relations or U.S.-China trade in general. So this is now inclusive of this new 125% tariff. And so I think what the question was, that 125% that was announced, did that include that previous 20%? So now that we know that the White House has confirmed that in total it's 145%, including that previous 20% that was meant to fight what the Trump administration was going after with regard to fentanyl. So now this is a new rule that intensifies the trade war with China. China has been hitting back, as you know, as you just mentioned, Jenny. And this move has essentially just intensified this trade war, throwing kind of cold water on the market again. You can see that playing out not just in equities, but in crude oil as well, rattling just overall investor sentiment, despite that big move higher that we had yesterday that included, or that was triggered by that 90-day pause on many of the tariffs except for China. The president has accused China of being a bad actor. You know, the view is that, China has these unfair trade practices, that we don't have the same access there to markets like they do have here, right? They have free market access here, so that's one of the issues. And then, so the magnitude, again, though, is more dramatic. So in terms of the Shein and Temu impact, they're targeting these small value packages, so items priced up to $800 will now face 120% tax. That's up from the original 90%. Where you'll start seeing these fees increase beginning May 2nd to June 1st. June 1st, it increases even more. So May 2nd, the fees rise from $75 to $100. After June 1st, that jumps to $200 per item. That's up from the originally proposed $150. Does that mean that is what the consumer pays? Not necessarily. We will see how much is passed off to the consumer.
Diane, this seems like a little bit more of a soft embargo rather than tariffs at this point in time here. What do you think is going to be next? Do you think we will see a little bit more of an aggressive retaliation from China? Because we haven't heard anything as far as a new rate on the U.S. when it comes to tariffs from China. Do you think China's kind of over with? Do you think people are going to actually come to the table, or could this actually get even worse?
I do think it could potentially get even worse between the U.S. and China, and I think that is what the president is trying to do. It's kind of this who will blink first, right? So as it stands, we know that China's tariffs go into effect essentially April 10th. So, given that the president is enacting more draconian, I could see them trying to wait and see what happens, how much buckles. And if that does, or if there's not a lot of movement, they could fight back fire with fire. We've seen this before, and where this was this back and forth before. I do envision that some of these tariffs will stay, maybe not at the same level that we are now, but with regard to China, I think some of them will certainly stay.
I completely agree. And not to say I wasn't excited about yesterday, but I think that we all maybe got a little bit too ahead of ourselves. Our markets definitely did, and it's like, wait a second, nothing has really changed. There's still this massive overhang of concern regarding U.S. and China specifically trade, but we'll leave it there. I think we can talk about that conversation all day long. We so appreciate it. Diane King Hall, of course, the host of Morning Movers. Now coming up next, last but not least, it's time to look at GM for under 30. We are seeing one analyst actually turn more neutral after being bullish on the name, and seeing right now some news of temporary layoffs at some of its factories in Detroit. We'll discuss more coming up next.
Trading at Schwab is now powered by Ameritrade, giving traders even more ways to sharpen their skills with tailored education. Get an expanding library filled with new online videos, webcasts, articles, courses, and more. All crafted just for traders. And with guided learning paths, stacked with content curated to fit your unique goals. You can spend less time searching and more time learning. Trade brilliantly with Schwab.
Whether you're a bull or a bear, you'll want to catch the latest market action on Morning Movers with me, Diane King Hall, live from the floor of the New York Stock Exchange, only on Schwab Network.
Welcome back to Next Gen Investing. It's time for an update on the overall aviation space as well as the airlines, which now are expecting more earnings after Delta reported yesterday. Joining us now is Robbie Silk, the senior editor for Aviation and Travel Weekly. So thank you so much for being here today with us. I mean, let's initially get your thoughts here on Delta, because what a move yesterday on withdrawn guidance.
Yeah, Delta, I was a little surprised, frankly, that it wasn't a little worse what they reported yesterday. They reported that bookings remained strong and their revenues remained strong for international. They hadn't really seen a blip, but also for their premium domestic travel. So that was a little surprise, but a lot of weakness in the main cabin economy domestic fares.
Robbie, what are you excited about when it comes to the aviation industry in general? Is it going to be the travel side, maybe Boeing and their kind of situation when it comes to building out airlines? What do you find an area of value and opportunity over the next couple of months or quarters here?
Value and opportunity for the airlines? Well, I think that the airlines, I mean, frankly, I think they're in for a bit of a hard spell. I do think that some of the higher end airlines, so Delta, the premium carriers, have some opportunity if indeed there is a travel recession. Those airlines that just have better balance sheets and have more opportunity to, so if premium remains stronger than main cabin, that'll be good for Delta, for United, maybe for American. If everything slumps, those airlines have so many different products, they can just open up more seat inventory for basic economy or domestic. And I think the real challenge is going to be for airlines like Southwest, and then the bigger discounters like Frontier and others that aren't doing as well and don't have as many products to offer.
Okay, that's exactly what I was going to ask you about, because you mentioned the premium offerings that were one of the brightest spots of Delta's earnings, if that. But then when you look at some of these companies that just operate with much lower costs, also trying to now, I know Southwest is trying to charge for bags, which is like a sin for that company. I mean, how do some of these low cost carriers fare right now, given everything that's weighing on even the largest names in airlines?
Yeah, so first of all, they come into this not particularly well positioned. Now, in the past, when there have been travel slumps or people are looking to spend less money, that could be a real benefit for an airline like Southwest, or particularly an airline like Frontier or Spirit. But we'll see if that's the case this time around. I think, when the Delta's results were really telling. When they look forward into the next quarter, or into this quarter, results for this quarter, they're looking at maybe a 10% revenue decline in main cabin. That's according to, so they didn't put that number in there, but that's what JP Morgan analysts derive from their numbers. And they're making up for it because they're projecting about flat year over year. They're making up for it with premium and international. So if you look at, say, Southwest, already just kind of barely breaking even, barely having positive margins, they don't have that. They don't have that place to turn. They don't have first class service. They have short distance international, but they don't fly overseas. And so I think it could be a real problem for them. And again, the same for for JetBlue or certainly for Frontier, Spirit, which is already having a lot of problems ahead of well before this. It's going to be tough.
Yeah, especially, I mean, these names, a lot of them gave already downbeat guidance prior to even the real full extent of the tariffs. So I can't imagine what then this looks like. But hey, the consumer continues to amaze and sometimes I think surprise. So maybe we'll see travel fare better than feared, which doesn't mean strong, but better than feared is always enough to move the needle. We so appreciate those thoughts, though, especially on the back of Delta. We still have American and United to look forward to. Appreciate it, Robbie Silk, the senior editor for Aviation and Travel Weekly. And now to stay within our travel theme here, I'd like to welcome in George Tillis, senior markets correspondent for the network, to talk about GM and a very different story than what we're seeing in airlines, George. But it's just frankly amazing when GM is an American company and half of it's all of its manufacturing is so exposed internationally. That's been the most eye-opening thing to me about GM recently.
Well, yeah, obviously, I mean, if you just look at where they source their manufacturing, half their cars are made overseas. They've got a lot of exposure to Mexico and Canada. Parts for all automakers are sourced out of places like China and Southeast Asia, even places like Eastern Europe. So this is a very complex situation. And so the blanket tariffs now, 25%. On imported segments are really hurting companies like General Motors, Ford. Tesla, not as much because they do manufacture their vehicles in the domestic markets in which they sell into. But with that said, unless there's some sort of reprieve or allocations that are considered for these names in terms of tariff relief, General Motors is probably going to be impacted quite significantly. And with that said, you've got some analysts like UBS, which are basically downgrading their estimates for both sales and earnings, and this is really just a function of the tariffs. They moved their price target down for the next 12 months from $64 to $51, and they basically look at the costs that this essentially could cost the business itself as a whole, about $5 billion, all else equal, assuming that 25% tariffs are in place. And then, of course, they can't pass on those additional costs to the customers. And if they can, the customer may not necessarily buy as many vehicles. And so if you just look at that $5 billion estimate takedown, that's quite a bit of their net income last year as a business for General Motors, which is around $7.2 billion.
George, real simple question. Do they stall this out and wait for a new administration and hope for tariffs to go away, or do they actually put the investment in and pull these out? I mean, there's some companies that are probably thinking about that right now.
Yeah.
What do you think?
That's a good question. I can't tell you. I mean, these supply chains are deeply integrated. You can't just move factories overnight. I mean, you can move digital assets quickly, but that's not the business that General Motors is in, unfortunately. So unless there's some sort of concessions, perhaps, to these tariffs, it's certainly going to impact the bottom line metrics for General Motors. And even if you look at going into 2026, the top line sales, irrespective of the changes from tariffs, were already expected to be flat. So the business itself was expecting sequentially from 2025 to 2026 revenues at around $180 billion flat, no growth. Profit margins already very thin, 3% in the trailing 12 months, 5% historical averages. They are already facing high cost of goods sold. And now that cost is going to continue to increase. And then the challenge is, can they pass it on to the customer in this environment where the price is already high, interest rates still high. And so therefore, irrespective of the fact that you just look at the earnings estimates for this year and the price multiple 4 times earnings, it looks cheap. but it doesn't mean it can't get cheaper because of the fact that earnings are being revised down, and therefore the multiple expands on that function.
Yeah, and that's a good point, and I think that a good place to leave it here. Unfortunately, GM lower today, down about 3 3/4%. Kevin, I have to say that, and thank you so much to George. I got excited because you made such a good point that I hadn't thought about yet, and that's the fact that companies could just wait this out. I mean, not ideal, but that may be the best case scenario I've heard yet. So we appreciate you so much for joining us today, of course, on Next Gen Investing. We have the watch list coming up next.
Schwab Bank Investor Checking, the checking account built for investors. Named highest in client satisfaction by J.D. Power for 6 years in a row. With Investor Checking, you get the award-winning features of our checking account, plus cash management solutions, all designed for investors like you. With unlimited ATM fee rebates for cash withdrawals worldwide, no overdraft fees, and enhanced security features to keep your money safe. Also, because your investor checking account is linked to your Schwab One brokerage account, you can manage your checking and investing in one convenient location. Moving funds between your accounts is easy. Cash moved to your brokerage account is available in seconds. That means you can stop waiting and start investing in stocks, bonds, money market funds, and more. Get more with Schwab Bank Investor Checking, the checking account built for investors.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. The Platforms and Tools webcasts are designed to help you broaden your knowledge of platform features and resources available from Schwab. You'll learn tips and tricks to help navigate Schwab.com, Thinkorswim, and mobile-based platforms. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to schwab.com/coaching and start learning today.
Opportunities don't stop when the market day ends. So neither do we. Schwab gives you round-the-clock access to over 800 of the most popular stocks and ETFs, plus a wide variety of futures markets. All with 24-hour support from trading specialists who understand the ins and outs of 24-hour trading. No matter the hour, you can trade brilliantly with Schwab.
Morning movers, be the first to find out what's shaping early market action. Tech Check, Options Corner, Futures Focus, Technical Analysis. Morning movers covers it all. Grab your coffee and tune in every trading day at 8 a.m. Eastern, only on Schwab Network. Welcome to the watch list. I'm Nicole Petalidi. So glad you're with us this Thursday afternoon. You know, it's been quite the roller coaster week, even within one day, crossing over unchanged lines today, just trying to stay off the bottom on the selling that we're seeing after yesterday's historic gains that we saw. It's about 2 p.m. Eastern time. We're live on the floor of the New York Stock Exchange. Glad you're with us. Here's what's coming up on today's show. George Schultze, founder of Schultze Asset Management, will join us and talk about the recent market volatility, the uncertainties, the impact of the new tariff policies on investors. This as the president is having a cabinet meeting right now as we speak. Mies Schneider from MarketGauge.com will share her insights on navigating a sell the rally kind of market. move. And she'll explain her thoughts there and also what she thinks the Fed may do. And our panel is ready to recap those CarMax numbers. And really, CarMax has been down double digits in percentage terms. What happens next? Here's a look at the markets right now. The S&P is down about almost 3.5%. Oh, there it is, 3.7%. So it's down 200 points at 5,256. The NASDAQ down over 4%. 18,309. So tech getting hit very hard this after yesterday where people were seeing everyone jumping in, but today's selling off. The Dow is down about 3% and the Russell's down 4%. I will say we didn't completely eliminate yesterday's gains. We're still trying to see if we can have a winning week on Wall Street. The 10-year bond yield 4.36, the dollar 101.61. And you have gold at 3,179. The record high is just above 3,200. We've been approaching that. It's up 3.5% today. Crude oil 60.10. Oil is down 3.6%. Energy stocks, that sector is down 6% right now. So that is the biggest lagging sector. Materials, industrials also among the losers. Bitcoin below 80,000, that's down 3.7%. Kevin Hanks is here, host of Fast Market here on Schwab Network. Good to see you again, Kevin. So we're making it through the day, navigating. We're off the lows on the Dow. The S&P not too far off the lows. Tech getting hit hard. Energy is a sector down 6%. What are you watching here after yesterday, which was historic, the biggest point gain in history for the Dow? It's chip stocks, the best performance in 24 years. And the S&P had its best run since 2008. But we're not saying any of that now because we know that probably that may have been a bear market rally, short covering, whatever you want to call it, but it was a good day.
Well, this is a headline-driven market right now, and you mentioned President Trump's going through a cabinet meeting right now, and he's making headlines as we speak. He just said they expect the first tariff deal to come out very soon, and he just made another headline where he said he thinks the trade talks between the U.S. and China will eventually work out. So he's giving some very positive comments after the incredible headline today, this morning, that China tariffs will top 145% on China. So there's headlines coming out all the time, a lot coming out from his cabinet meetings that he's just having. The markets were down, the S&P was down almost 6%, now down 3.4%, Nicole. So the markets have come way back from where they were, but this is still a volatile day. The VIX was over 50, now it's back to 43. So we're dealing with volatile markets. Normally, on a day like this, Nicole, we'd be raving about the inflation data that we got this morning with CPI and all the different aspects of this lower inflation outlook. That said, we're not. We're piling up good data, but we're focused on the headlines. And the headlines right now, Nicole, are all about tariffs and announcements coming from the White House.
Yeah, understood. I'm still watching the bond market very closely right now, 4.37. We had the 30-year auction yesterday, the 10-year auction. The 10-year was received very well, so we'll continue to watch that story because that can drive this whole thing. Also, those Mag 7 stocks are in focus again. Some thoughts there. I mean, as I look at the heat map, the green here was really UNH and Walmart, and I don't even know if Walmart turned now. Walmart turned red. But UNH is still holding, and Eli Lilly, but I believe, and Cigna, those were some of the names. Cigna is a winner, but mostly losers today.
Here's what we're going to see, Nicole. Tomorrow morning, we get bank stocks, JP Morgan, Citigroup, a couple other banks. We're going to get details from Jamie Dimon on how he sees not only their quarter, which is frankly going to have difficulty because of the comps from past quarters a year ago. I mean, their earnings per share is supposed to be flat from a year ago. The revenue is supposed to be down 0.1% from the year ago. Really good numbers, but the stock is also $54 off its high. So tomorrow, I think the banks, as they do oftentimes, will set the tone for earnings season coming out. We've already had a couple names come out. Delta had a pretty good earnings. Remember, A lot of these stocks are already beaten up. So what it was a cautious outlook in fourth quarter earnings guidance. Let's see how they guide for the future now. They're going to talk about uncertainty, but hopefully they'll talk about the second half of the year and post all these tariff talks. It's going to be interesting. Tomorrow starts earnings season, Nicole.
You know, we were talking about that rally yesterday, and in fact that the short position was about twice of what we saw in the first quarter of 2020 during COVID. The short position was so huge that you had folks running to cover yesterday, which continued to push everything higher. I can't wait to ask George Schultz more about that. I wonder how many people are still trying to stick their necks out for this big short positions. Yesterday had a whopping, I'm reading here, 30 billion shares traded in U.S. exchanges. That was the most in the history over 18 years that FactSet was actually watching that. All right, I gotta let you go, Kevin. I mean, I gotta talk to George Schultz next. Good to see you. Thanks, Kevin, for a great week. George Schultz is here, founder of Schultz Asset Management. I'm glad you're here because we were just talking about the heavy volume and the big swings, the volatility. Do you expect that to continue? And a lot of folks were caught short yesterday and had to cover. How do you think that short position plays out now?
Yeah, glad to be back, Nicole, of course. And yeah, it's been an incredibly volatile market. You know, and on the 8th, you had, some slight gains, and then you had a big reversal. And then yesterday, of course, with this news that Trump would pause tariffs for most countries other than China, you had a huge rally. And I think that's right. I think there's a lot of short covering. We were covering some shorts, although just a couple. You've also had massive volatility in the bond market, a lot of uncertainty there, and that may have been the driver for the change in policy. We'll see. But it looks like the Trump administration is really trying to focus in now on the main culprit, or the main culprit in his view, really China, and trying to figure out a deal, whether a deal can be had there with raising tariffs even more. So lots of volatility, short covering for sure, followed by massive selling along the way up until we got there. And then today, of course, another sell-off. And you're seeing it, it's not just in stocks, but it's also in the fixed income market and commodity markets as well.
Are we still worried about recession risk, and are folks still as short as they were days ago? Are they still going to bet the farm on the short play after what they saw, how quickly the markets can get turned? Meantime, recession risk is still alive, is it not?
It sure is, but lots of people really don't know. I mean, you had Goldman Sachs calling for a recession in the morning, and then later on at the end of the day changing their mind. You have JP Morgan initially saying it's a 60% likelihood, now raising it. I think people really don't know for sure. Looking backwards, the economy in the U.S. looks pretty good. You've had growth up until the last reading, and we'll see how that all evolves when the prices of goods from China start to really increase, and when steel prices and automobile prices for imports only start to really increase. I think what you'll have is a market where you have winners and losers. Some companies will do really well, some companies will do very poorly, and I think the ones that are over leveraged will do the worst. It really sets up for an amazing distressed securities cycle, if you think about it, because companies with too much leverage have no way to make it through this. There's higher import costs. You have a changing, regulatory environment here, which is expensive to monitor and track. And then, of course, you have all these DOGE cutbacks, which people aren't talking about today. But that'll have a significant impact for lots of industries as well.
As the president was talking, he was saying that the tariffs would be used to pay down debt. And, I think most Americans would love for U.S. debt to come down. I don't know how they expect that will come down, but that was what he was saying, that the tariffs and that money would be used to pay down debt. Another reason that a lot of folks think that he wants to bring down rates, the yields, so that this way when they have to refinance trillions of dollars in debt, they can do it at a lower rate. Do these things sound on point to you? I mean, sound good?
To me, they do. They sound great. But the problem is, this has never been tried before. We're in a period of a lot of uncertainty. We have a massive amount of borrowing in the U.S. And in fact, our main counterparty that we're negotiating with owns about $800 billion of U.S. Treasury. What if they start dumping them? There's just a lot of uncertainty. It's just really not clear exactly how it will all play out. And that's why you're seeing extreme market volatility right now. I hope Trump is able to pull it off. I hope, it works exactly like he's designed. I think yesterday's move by canceling reciprocal tariffs for so many different countries is an indication that, it wasn't working perfectly. And so I think that's an important take back for investors. Tread carefully because there's lots of volatility that's likely to continue. But going forward, it's really a new dynamic for the U.S. economy and for certain companies and industries as well.
So do you have stock picks or advice to investors? What should they be doing now?
So we've been saying here at Schultz Asset Management that several themes, inflation, secular change, mostly technology, higher interest rates, higher for longer interest rates, and now also this tariff, these tariff geopolitical trade wars will cause dislocations. And with that, we're increasing our portfolio of short sold companies. Some of those companies are doing very well on the short side. We're focused on companies with excessive debt or with faltering business plans due to secular changes. And now, of course, also those companies that are exposed to higher costs due to tariffs. Also, a number of companies have the U.S. government as their primary customer. With Doge cutbacks, those companies are facing a much worse environment right now. So it's another opportunity for short selling. On the long side, we have a number of value-oriented stocks that we like. And after the last few weeks, some of these companies that are just being given away. They've literally thrown out the baby with the bathwater. They're just so cheap as a multiple of their cash flow that we think they're extremely interesting.
How are you finding those cheap stocks? I mean, if it's baby out with the bathwater, how are you finding the names that are good names, good companies, and you think they should be bought now?
So we screen for companies that have previously restructured and reduced their debt. A company with a clean balance sheet is a great starting point. Those companies that have that kind of financial wherewithal and financial flexibility have more ability to deal with macroeconomic shocks like this. So that's a good starting point. But then also we like really, companies that are extremely cheap, low multiples of cash flow, that previously went through a distressed situation like that, and that now, have more opportunity to grow their business.
Yeah, and what do you think the Fed should or shouldn't do right now?
That's a tough one. I think the Fed has a really difficult job. There's a lot of pressure from the Trump administration and from all this tariff volatility and uncertainty, also with all this uncertainty in the fixed income market. On the other hand, the Fed has a dual mandate. So they're looking at inflation. They're seeing persistent inflation, and with tariffs, that's likely to continue. But I think they have to balance that with economic growth, and it's a really difficult assignment for Fed Chair Powell. We think going forward, the market's probably right. We'll probably get 2, maybe 3 interest rate cuts this year still. And I think that will help the market, rally somewhat.
You did note the oil prices drop. I mean, it wasn't that long ago we were above $65, and then in this past week we were below 60, right?
Yep.
So you definitely have seen some big moves here. The gas print in the CPI came down, and so that was good for folks when they pay less for gas. I guess that's a break. Where do you see oil headed now, or more importantly for folks who are paying for gasoline in the next 6 months? What do you think happens there?
I think for gasoline prices, the lower oil prices should come through and ultimately, reduce your price at the pump. Thankfully, I think consumers will be, happy to see that. Unfortunately, with the oil market, it's harder to predict. It's really driven though on the global economy. How much demand is there? Is it likely to, substantially decrease due to fears of recession or an actual recession? Right now, I think it's early to predict if there's going to be a recession, and certainly if we do have a trade deal negotiated, principally with China, all bets are off. I think you could have a beautiful recovery from here, and the price of oil, along with everything else that's cyclical and dependent on a robust economy, can do much better.
All right, George Schulte, great to see you, founder of Schulte Asset Management. Thanks for being
Good
with
to see
us,
you.
George. Coming up, Options Corner, Tom White is standing by. He joins us, highlights unusual options activity from the day and how investors are looking to trade Barrick Gold, Electronic Arts, and JP Morgan Chase ahead of those earnings tomorrow. All right, the Dow's down 1,357 points. We'll be right back.
experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Do you like using charts when analyzing your stocks? Our technical analysis webcast series breaks down different charting techniques like trend analysis, price patterns, moving averages, oscillators, and much more. Best of all, you can ask questions directly to an education coach. It's interactive learning at its finest. Tune in live or on demand. Head over to schwab.com/coaching and start learning today.
Trading the trending names every day. I'm Tom White, host of Fast Market, ready for you, ready to go at 12 p.m. Eastern on the Schwab Network.
Welcome back to the watch list. It's time for Options Corner, where we analyze unusual options trades that we're seeing throughout the day. Tom White, host of Fast Market, here to go through what we are watching in this market. You have some names that we're watching, but people certainly have been watching this volatility in particular. And tell me a little bit of market thought before we get to Barrick Gold.
Yeah, Nicole, just in the last 10 minutes since I walked into the studio, futures were down a full % from when I left my desk. So that tells you what type of volatility that we've seen. The VIX got down to the 40 level 15 minutes ago. Now it's back above 45. So I think investors should expect this type of movement in this uncertain environment until we get some clarity on the deals and negotiations that are going on as far as tariffs. If you looked at, the markets, at the beginning of the day, relatively flat, fell. They were down 6% at one point for the S&P 500. We've rallied back some, but I think you're going to expect this moving forward. And I think one of the next keys moving forward also, Nicole, is going to be the start of earnings season. We're going to talk about one of those stocks today on Options Corner. But at the same time, what type of guidance are these companies going to give? Yeah, most of their results are going to be before, the tariff meltdown that we've seen. But I can't imagine any of these companies giving any certain guidance or above average guidance moving forward. Now, we've seen analysts come out and everybody kind of lower their estimates for earnings moving forward. But at the same time, we'll hear from some of the banks tomorrow morning. What kind of guidance are they going to give us? And I think the banks are perfect segue into earnings season because they're going to give us a good read on the consumer and the health of the overall economy as a whole.
Yeah, I was surprised to hear when CarMax was saying, we're still on track to do our plans and progress for growth and new centers. And though the timeline may have changed, they were still on. I couldn't believe it. And CarMax is down 17%. We're going to be talking about all these. Let's talk about Barrick Gold.
Yeah, you take a look at what gold's done, just below all-time highs. In today's session, up over 3%, about $25 off those all-time highs that we reached a few weeks ago. And I think there's two reasons for this. It's a safety play for a lot of investors at this point as they try to diversify central bank buying. And then you've got the dollar just getting killed today, which is also lending support to the precious metal. So we've had nice runs in gold over the last year and a half or so. Barrick Gold, on the other hand, it's doing well, up 24% so far this year. But if you overlay a chart of gold and gold futures and Barrick Gold, it doesn't really match up. And this has been missteps by some of these companies, mismanagement maybe, that they haven't followed the price of gold to the upside over the last year and a half or so. But that being said, Raymond James just raised their price target on it the other day, up to $26.50 from $23.50. They keep an outperform rating, and if gold stays at these levels, that should help their margins. If they start to manage their expenses a little bit better, that might also help. But we did see some bullish activity in here, and this was out in the May monthly cycle, so 36 days to expiration. Traded about 12,000 of the 19 strike calls. They paid an average debit of about $1.17. So that break even of $20.17 to the upside over the next basically 5 weeks. That's about 4% above the current share price in there, with calls doubling the normal daily average volume that we've seen over the last week of trading. So yeah, somebody taking a shot here with the expectations that, hey, maybe Barrick Gold can catch up to the moves that we've seen in the commodity that they mine.
Look, people are looking for safe havens, and gold has certainly been there for that. How about Electronic Arts? Those shares are down about 20% from the all-time highs. You found a trade, a bearish trade for this name. Today, I see Electronic Arts higher. Tell us a little bit about the story and what we're watching here.
Yeah, one of the few major stocks that are higher. This is almost like an overlooked stock because we typically don't see a lot of unusual option activity in a name like EA. They just did a partnership with Amazon's Luna cloud streaming service for their games. Their Battlefield, their new version of the Battlefield game, which is one of their top sellers, is coming out. So yeah, I think people are optimistic on the gaming side of it. Now, the tariff impact is definitely going to negatively affect this company. We've already seen it on Nintendo. They've already canceled orders for their new Switch 2, which is a really popular gaming system. And so the tariffs are going to have an impact on this sector as a whole. But we did see some bearish activity in here. They report earnings on the 6th of May. So this unusual option activity is going to actually capture that event. This was out in the June monthly cycle. So 71 days to expiration. A trader bought 4,600 of the 125 strike puts to the downside. Paid an average debit of about $4.15, so pretty hefty option premium. So the break even for this trader where they start to profit is below $120.85. That's about 13% below the current share price in there, with put volume about 4 times normal daily average volume. Most of the volume is in this one trade to the downside. So yeah, somebody maybe fading this upside move here over the next couple months.
Okay, last but not least, we'll get to JP Morgan Chase. I mean, earnings season will be underway tomorrow. We'll hear from BlackRock and Morgan Stanley, Wells Fargo, and JP Morgan. I can't wait to hear what they're going to say. And Jamie Dimon's been very frank with his thoughts and spewing it out. Whatever, he certainly hasn't held back, which I think people enjoy, his authenticity. That being said, and a lot of folks pick JP Morgan as their favorite bank when they're investing. What do you think here? What kind of trade did you find?
Yeah, this is all about scale. I mean, JP Morgan's pulled back about 20% from those all-time highs that we saw just a couple months ago in February of $280 a share. Jamie Dimon, he said in the middle of last year that there was going to be a hurricane coming, and he was pretty dour on the outlook for the equity market, and then we rallied into the end of the year. Maybe he's a little bit early on his call. He's been calling for recessionary risks. I think going into this earnings event, I think it's going to be really key to see what type of commentary we hear from Dimon about how the tariff impact, the drawdown in the equity market has impacted their clients, which segments of their business, through their four sources of revenue are getting hurt the most, and then the impact of net interest income. Last quarter they gave an estimate of over $90 billion net interest income. Does that change with the volatility that we've seen? So it's going to be a big report, and I think the commentary and guidance is going to be what moves that stock, and does it kind of leak into the rest of the earnings season? We'll have to wait and see, but they'll have a good basis for how the economy is doing in the consumer. But we did see some neutral to bearish activity in here. Maybe somebody trying to take advantage of these high volatility levels going into the report and high volatility in the overall market. So traders sell about 7,000 June monthly 250 strike calls. They collected an average credit of about $6.10. So for these far out of the money calls that are over $25 out of the money of the upside, they collected a credit of $6.10. So that takes a break even for this trader where they can be profitable all the way up to $256.10 over the next 71 days. That's about 12% above the current share price. Now, this might be somebody that owns a big chunk of JP Morgan stock and they just want to offset some of the risks to the downside while still giving themselves a pretty major 12% cushion to the upside on these calls. Or it could be somebody speculating that, hey, I'm going to take advantage of this high volatility. I don't think JP Morgan's going to go up that much, and I'll sell some calls to the upside there to take in a lot of option premium. So yeah, somebody kind of fading JP Morgan going into those earnings in the morning.
Yeah, I couldn't believe the volume and how many short sellers, in fact, there were that were exposed on Wednesday's rally. They were saying how much more there was in short sellers compared to COVID, right? And they all had to rush and cover. So, and this could be just people who hedge on both sides. This is a different type of thing. But you know, are you betting to the upside or the downside or both?
Yeah, I think.
Yeah, go ahead.
Yeah, real quick, Nicole. I think that was part of the 9.5% move that we saw in the S&P 500 to the upside yesterday. Maybe half of that, and we've given up about half of that today, was short covering. Remember, everybody was kind of levered up to the downside with the expectations that, you know, no headlines would come out, or, you know, people just getting out of stuff. So maybe this is kind of even keeled for the rally by giving up about half of those gains.
Yeah, so normalizing yesterday's move. So if half of it, right? I get what you're saying.
Yeah.
So now I'm starting to wonder how much, again, are there in shorts?
Yeah.
Right? And if we were to rally tomorrow, are we going to have the same picture? Is it going to be the same number of shorts? Fewer, probably, because they didn't have time to lever up. Okay, Tom White, thank you.
Thanks.
Good to see you, always. Thank you. And tomorrow you'll get the JP Morgan numbers here on Schwab Network. Axel Merck will join us next, talking all about commodities. Oil down, gold jumping. The watch list. We'll be right back.
Trading at Schwab is now powered by Ameritrade, unlocking the power of Thinkorswim, the award-winning trading platforms. Bring your trades into focus on Thinkorswim Desktop with robust charting and analysis tools, including over 400 technical studies. Tailor the platforms to your unique needs with nearly endless customization, and track market trends with up-to-the-minute news and insights. Trade brilliantly with Schwab.
Trading the trending names every day. I'm Tom White, host of Fast Market, ready for you, ready to go at 12 p.m. Eastern on the Schwab Network.
Trading at Schwab is now powered by Ameritrade, giving traders even more ways to sharpen their skills with tailored education. Get an expanding library filled with new online videos, webcasts, articles, courses, and more. All crafted just for traders. And with guided learning paths, stacked with content curated to fit your unique goals, you can spend less time searching and more time learning. Trade brilliantly with Schwab.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. The Platforms and Tools webcasts are designed to help you broaden your knowledge of platform features and resources available from Schwab. You'll learn tips and tricks to help navigate Schwab.com, Thinkorswim, and mobile-based platforms. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to schwab.com/coaching and start learning today.
Welcoming in our next guest, Axel Merck, President, CIO of Merck Investments. Thank you for being with us. We're taking a look at the commodity space, and you're looking, let's first start off with oil. That was a bright spot in the CPI as gasoline came down. Folks are paying less at the pump. There's some relief when it comes to inflation on fuel. What do you think happens next? Does that stay around?
Well, great to be with you. I mean, low oil prices clearly signal that the economy is weakening, and you can blame uncertainty, you can blame whatever you might want to do. The other side of that, though, is that lower oil prices are also an economic stimulus. The Federal Reserve is kind of caught in a bind here. You can't really cut rates in response to tariffs because that's a supply shock, and that would just stimulate demand and induce inflation. But the price of oil might be doing part of that job. Now, the U.S. economy is not as dependent as other economies is on energy prices, except other mining industries in the commodity space, of course, are very energy intensive, and so they very much appreciate lower oil prices.
Yeah, without a doubt. And OPEC, by the way, has committed to producing more. Where does that fit into the story?
Well, I sometimes call the Federal Reserve a debating club, and I suppose OPEC is all the same. It's just very difficult for these big organizations to pivot on a dime. And yes, they said they would produce more, but we'll have to see how that's going to play out. I think everybody is awaiting of how things are going to work out in the U.S. And because if things move okay, yes, that will be the case. But if indeed we have a more serious economic slowdown, I very much doubt that that will persist.
Okay, and at this point now, shall I throw in nat gas before I get to some other topics here, because there's so much more?
Well, yes, it's the same thing, right? All the commodities are subject to industrial use, to just talk about it very abstractly. And when you have the risk of an economic slowdown, most of the commodities are negatively affected. And to just pivot to gold just a little bit, part of the reason why the gold to silver ratio is over 100 is because silver has a much more industrial use than gold has. And so gold is reacting to other drivers than most of the commodities are.
Okay, at this point now, tell me about some other commodities that you're watching closely. Are you most interested in gold or rare earth?
Well, rare earths are interesting watching. We don't trade in them, but of course that's where China has the control. In our shop, we manage over $2 billion in gold and gold mining. So yes, that is our core focus. You earlier just had Barrick on there. The one thing that many people are not aware, Barrick Gold is just announcing a name change to Barrick Mining. These big producers have a very difficult time replacing the gold. The earth just hasn't provided enough gold for these big producers to keep up the production. And so they have gotten involved in these big copper projects. And the real action on the gold space is more in the junior producers, but in the big producers, about 20% of the input cost is energy, and so to them it helps them on the margin. The price of gold in general is up substantially this year, was caught in the initial downdraft, but has since, even before the quote-unquote pause was announced, started to rally again. And then obviously today, the futures are over $100 as we're talking, and the spot price as we're talking is up $87. So very different from the gloom in just about every other market. The precious metals, and notably gold, has been doing very, very nicely.
And how about the fact that you have so many central banks buying gold? I mean, you talked about the commodity itself and being harder to mine at this moment. And does that push the gold price up? I mean, the highs are around 3,200. Do you see it? I saw, what was it, Goldman Sachs, so 3,300 as the target, I think. Where do you think gold really could trade?
On the central bank buying, it's when you weaponize the dollar, and that happened with sanctions regarding Russia, you quote-unquote disincentivize other central banks not friendly to the U.S. to hold their reserves in U.S. dollars. That doesn't mean they put everything in gold, but gold is a beneficiary. And of course, what's happening of late with the tariffs, that's a further
We had a yin-yang with it too. So Jimmy's sitting up there at the doctor's office, getting his glasses filled, and he saw it break out past the 200. And he knocked on the door and said, "Brandon, are you home? We're pulling back to the 200 here. You might want to jump in this trade." "What do you mean, Jim?" I said, "Yeah. Boom, baby, right off that 200. Come up to a double top, an exit idea. Now this here is the orb channel. I'm new to this, so kind of, you understand what I'm saying, Funk? Brother? With another mother. And that bottom support line become a resistance. Oh, that's a good one. He understands. Woo! That's a good one. You got me on that one, brother. I don't know if you told me or not. If you would have, if you did, you know how much I'd have made on that trade? $2,500. A 100% gainer. I had to go get my glasses, man. And it did pull back. What would you have done? What would you have said if it pulled back on me? Like it did. What would you have said? That's what I thought. So I got back in where I got out at, plus a little less. So I should get an A+. I got my glasses. Okay, YouTube, you'll be the first ones to get to see my glasses on, besides all the pretty women at the mall. So prepare yourself. Here it comes. Boom! Let's take the big picture here. Whoa! Ah, darn, don't you, what the heck? Woo-wee! Woo! Yeah. I need to take a snapshot of this and show my women. See if Francisca likes it. You ready, Francisca? I don't want to steal you away from your man, but this just might do it. Whoa. Give me a 1 to 10. Perfect. I got a perfect score. Don't you wish you was that handsome, Funk? You wouldn't know what to do with all the women I get. Mike's jealous. We want some funk. Gotta have some funk, yeah.
China.
These were not made in China. These were made in America. Man, I don't know what to say. I don't think I've ever looked so handsome. What am I going to do? I can see a lot better now. My accuracy should be a 100% increase. Hey, do we have the no soup for you sound, Mike? Hey, can I pull that up myself? Magnificent. Mike, do we have no soup for you sound? Do we have a... Okay, we're double topping now. I'm gonna go make my coffee and I'll be right back. I can see. Kind of wish I'd have got the matte finish, but that's okay.
Consolidate and then move up from there. I'm looking at things that have not made a new low, that have just been consolidated.
Correct.
At a good price. Corn, wheat,
Porn?
soybeans.
Oh, she said corn. How dare you? I'll have to cut you off, honey. You can't be talking like that on this channel. Titellini, do something about that. We have a double top. 3 black cores. Get ready. Oh boy, I'm so excited. I don't know what to do with myself. I think these last 2 weeks have been the most miserable weeks of my life. If I was stuck on a desert island, I would starve to death if I didn't have my glasses. If all I had was what I could take with me would be a pair of glasses, I'd find food. So as we trade next week's calls, we could pull back to the 200. That's what we respected last time. That's your pivot point. So I could wait until then. So I'm going to go into the kitchen and grab some gin. Nancy, prepare my coffee for me, please. Yes. I think I'm going to go in there real fast and do that, and then come back and make a marvelous trade. I love you.
And then Brad Lemonsturf is with us, and we welcome you.
I kind of like her little blouse today.
For being with us. So, Brad, I'll start with you. Your thoughts, because when I was reading through and some of the guests I've spoken to, they felt comfortable with the sales and the revenue, but the concerns were about some of the costs and profit margins.
Yeah. Well, I mean, what you've got to realize with the CarMax especially, we've been
CarMax
the group on and off. We actually were short CarMax last month. We covered it below 70, and this was the quarter, and the things that you're looking into the quarter definitely were showing modest margin pressures and things like that you're looking at, but this is a company that finances a lot of their own cars and keeps their own paper. And, I think that with ABS debt continuing to go up and the amount of credit spread widening that's just occurred, it's going to really make a lot of these people, a lot of their volume very unpredictable over the next few quarters until that type of spread comes back down, I think.
Yeah. Some of your thoughts on the quarter here, Jeff, and also the outlook of what tariffs could do to car prices and car.
Hey, Nicole, good to see you. Listen, the stock, it was very interesting. The price action is really what I was looking for with the earnings report. We had a implied volatility at 12% post earnings. The stock moved down 20%. They're one of the first big companies in
in the earnings season to get that whole pass on the tariffs, and tariffs for autos, as we know, are stickier than other sectors, and the market's just not hearing it. So it's cloudy, it's murky. They don't want to give guidance. They don't know what's going to happen. A lot of people don't know what's going to happen. So
I know what's going to happen.
That we can glean from the past is the last time we had.
We're going to come down and hit this 200.
Happened in CarMax was COVID 5 years ago, and from peak to trough, the stock was down 60%. We're not even halfway of that move yet. So I'd be a little cautious.
You would be.
Understood. So
Understood.
You would be at this point in a wait and see mode here, Jeff. Is that what you want to do with this stock?
Yeah, I mean, if they're not giving guidance, why should I have guidance for what they're going to do? I'm going to stick my neck out on the line for a company that doesn't know what their own business is going to look like. Last time we had this kind of downdraft, this kind of hate in the stock.
Good point.
60% downside. Today we were down 20% at the most. We're 30% off of recent highs. Just not beaten up enough.
See, he made a good point. There's only one other reason I'd get into it, and that is if it did have a good pullback. And it was one that I always watched. But if they're not going to give a guidance and they don't know their future, why would you invest in a company like that? You know what I'm saying? So I'm going to look at it personally, and I'm going to give my professional opinion on it.
Environment right now. I mean, you had that huge move up from COVID, where prices. I mean, our group really thinks that a lot of these used car loans from COVID are underwater from where people bought. So you're talking about a similar situation like 2008. When people were just handing back their homes, when they were underwater. I think you've got a lot of that going on, and I think, and people also aren't realizing, the economy doesn't feel bad.
I don't know.
But ABS credit, which is auto credit.
I would say I'd like to take this at a triple quad bottom at 56.15.
Which is in that same caliber. So this kind of move, when I say the spreads are
start
widening, this is
nipping
going
at
to
it
cost them even more
at 60.
to buy a car, which is going to make
and maybe
a car purchase unobtainable to some people where maybe
60
a year or two ago.
So at this point, they're saying that the tariffs could raise new car prices, and that might benefit used cars, but maybe all the prices will be so high nobody will buy a car at all.
That's a low blow.
Too, right, Jeff?
See, this gets me.
My daughter just got a driver's license.
It's like cars haven't gone up in the last 4 years. I went car shopping. I couldn't believe the prices of cars from the last time I went shopping. If they had any reason to complain, it would have been during the last administration when they were going to outlaw the gas engine. So these people are full of shit. I mean, I wanted to buy a new car, and there was no way I was going to pay 60 grand, 50 grand for a new car. Unless I was, because I plan on, living on an island, and I might not even need a car. Or I might live on a boat. So I went to look at used cars, and them things were 30% up. And they're worried now about the prices of cars going up? Are they nuts? It pisses me off sometimes. People are like that.
Zananiri, thank you both so very much. Good to see you. That's going to do it, folks, for us here on the watch list. The Dow right now is down about 1,100 points, have been down over 2,000. So we have come up off the lows, but this last hour of trading is certainly setting up to be quite volatile. Keep it here on Schwab Network 24/7. We have you covered. You can get the Apple App Store app as well. That's free. I'm Nicole Petalides. Thanks for being with me. Market on close, Caroline Woods next.
Schwab Bank Investor Checking. the checking account built for investors. Named highest in client satisfaction by J.D. Power for 6 years in a row. With Investor Checking, you get the award-winning features of our checking account, plus cash management solutions, all designed for investors like you. With unlimited ATM fee rebates for cash withdrawals worldwide, no overdraft fees, and enhanced security features to keep your money safe. Also, because your investor checking account is linked to your Schwab One brokerage account, you can manage your checking and investing in one convenient location. Moving funds between your accounts is easy. Cash moved to your brokerage account is available in seconds. That means you can stop waiting and start investing in stocks, bonds, money market funds, and more. Get more with Schwab Bank Investor Checking, the checking account built for investors.
Oh, I forgot about my SPX SPY.
From every click to every tick.
There's no fear of missing out on Next Gen Investing.
Available anytime, anywhere, on any device for free. Empower your portfolio with the Schwab Network.
Well, there it is.
With Alex Coffee, I'm Jenny Horn. Join us for Next Gen Investing.
1 p.m. Eastern, only on the Schwab Network.
Trading at Schwab is now powered by Ameritrade, giving you even more specialized trading support. Connect with the Schwab Trade Desk, our team of passionate traders ready to tackle your trading questions, no matter how complex. Plus, get 24/7 live help and access support by phone, email, and in-platform chat. Trade brilliantly with Schwab. Trading at Schwab is now powered by Ameritrade, unlocking the power of Thinkorswim, the award-winning trading platforms. Bring your trades into focus on Thinkorswim desktop with robust charting and analysis tools, including over 400 technical studies. Tailor the platforms to your unique needs with nearly endless customization, and track market trends with up-to-the-minute news and insights. Trade brilliantly with Schwab.
Morning Movers brings traders the biggest headlines to start the day, from volatile overnight swings to the earliest analyst calls. Get your watch list ready. 8 a.m. Eastern, Morning Movers, only on Schwab Network. Here in New York, I'm Caroline Woods, live from the floor of the New York Stock Exchange, and this is Market on Close. We have an hour left in the trading day. Let's take a look at where markets stand. All I have to say is what a difference a day makes. Stocks are off the lows, but still deep in negative territory, reversing a good chunk of yesterday's historic rally. As you can see here, the NASDAQ, the worst performer today, down on, or actually no, the Russell, the worst performer, down about 4.2%, actually inching closer to the flat line for the week. The other majors are still positive for the week. The NASDAQ off about 4%. Every Mag 7 name is lower. S&P 500 off about 3.25%. Aside from utilities and staples, every sector in the red. Meanwhile, the Dow also down sharply, off about, call it 1,000 points right now, 1,032. Nike, Chevron, Disney weighing on that. Taking a look at some of the futures products now. The dollar getting hammered near the lows of the session. Gold is seeing a pop though, trading very close to the highs. Meanwhile, crude oil is giving up some of yesterday's gains, trading around $60 a barrel, and Bitcoin is back below 80,000, trading around 79,700. Let's kick things off with a look at the broader market with Kevin Hings, senior equities contributor here on Schwab Network. Kevin, thanks so much for kicking off the show with me.
How you doing, Caroline?
Well, I was doing better yesterday. Let's just say that. You know, after the wild ride, the big question was what comes next? And I guess this is it, and it's not nearly as fun, Kev.
Well, I think what comes next is more volatility and a headline-driven market. Caroline, it's amazing to me on a day like this. Normally, we would be gushing over the CPI data that we got this morning, but the market just flowed over it like it was nothing, even though it was. We wouldn't call it lukewarm. We wouldn't call it mild. It was downright chilly. Headline month-over-month CPI was down 1/10, but the markets didn't care. Why? Just like on Friday's payroll data, it is focused on headlines. And the only headline they were focused on this morning was 145% Chinese tariffs. And that's what the market latched onto. And frankly, that's what all the headlines on every show and every media outlet was talking about, 145% on China. They didn't talk about the fact that they lowered them on everyone else and the market is under pressure. Now, headlines keep coming. There was a cabinet meeting today. Headlines came out of that. I think I speak for everyone in the trading community. We really like how Jerome Powell and Scott Bessent give information to the markets. Howard Lutnick and President Trump, not as much. So we'd like to see, I think I speak for everyone when I say more Scott Bessent, Caroline, is what we'd like to see.
Yeah, I was just checking President Trump's Truth Social to see if there were any other headlines. I do think it's important to note that 145% tariff on China, it wasn't like it was another escalation. It was just clarifying that it's 125 on top of the already existing 20%. And that 125% number was, announced yesterday, and the market rallied regardless. So do you think that maybe it just got a little too much ahead of itself and this is just some right-sizing the ship today?
I think there was a lot of, well, this is a rally for selling, this isn't really over, what has really changed? I think a lot has changed, but the market is still worried. And I think Scott Bessent, who just put out a headline that said 90 days from now, the tariff situation will be much more certain. Now, that is pressing the exact button that the market wants to hear. In a world and a day where all we hear is uncertain, 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 Scott Bessent just came out, used those words to say they will be more certain in the next 90 days. They also mentioned during the cabinet meeting that they're close to announcing the first trade deal with the first country. So I think there are good things coming out, but that being said, the market is still worried about everything that it's worried about. It continues in volatile markets. Remember, we were down 6% right around midday. Now we're only down 2.8%. So the markets are all over the board, working its way to find that equilibrium, that price where, bids and offers come in on both sides. It's volatile though, but like I said, normally we'd be gushing over the CPI data, not so much today, Caroline.
But Kev, if this is a headline-driven market and there is the potential for some of these deals to be announced, do any of them matter, or is it just the China deal? Because we did hear that the EU has paused the reciprocal tariffs for 90 days as well, so that's technically a good thing, right? But not enough to give a boost to this market. So what is the headline that this market wants to see green arrows again?
You want to start seeing that flow. I'm a big fan of news flow. And you want to start seeing the news flow being, we made a deal with this country. We made a deal with this country. Now we can take those tariffs off and they're done. That's what you want to see. These 70, now 75 countries that are here negotiating over the phone with President Trump, that's what you want to start seeing finished product on. And then you do want to remember, the 145% is so outlandish that it has to be negotiated away from. Does that bring Xi Jinping to the United States to negotiate? Does that open up some type of negotiation? It should. But that's what I think you want to see. I think you want to see tomorrow, when we start earnings season, you want to see guidance for the second half of the year. Jamie Dimon, you're up. Your table's ready. How are you going to guide for JP Morgan's financial for the rest of the year? into the second half of the year. Because remember, one great thing we get with JP Morgan and Bank of America is a real good look at the U.S. consumer and what they're doing, Caroline. So I think that'll be important tomorrow, how they map out the rest of the year.
Yeah, and Jamie Dimon hasn't been known to mince words. In fact, he's sometimes overstated the risk, you know, the economic hurricane. I was thinking about him saying. But to your point about the market largely shrugging off CPI, I mean, I have to say, I was looking at Mortgage Daily News earlier, and they had a headline, CPI finally drops big just in time to be irrelevant. But, you know, this is a market that's very focused on these tariffs right now. Do you think that earnings have the potential to move the market, or could those also be shrugged off as well, unless maybe they're bad news?
Well, here's the good news. If the headlines and the tariff news start to dissipate and start to move in the right direction, you've got a stockpile of good data saved up to energize the market higher. Non-farm payrolls, Friday. CPI today. We'll get PPI tomorrow morning. You've got good data, but you know what we're also getting tomorrow morning? Consumer sentiment. That soft data that's been affecting the market so much when the hard data has been so positive. So you're going to get PPI. If this one's good, today's PPI will also probably show some good progress on inflation, but then you'll get consumer sentiment, right? And that's probably going to be another number that doesn't look great, even though I've been very skeptical of the University of Michigan and their sample size and how it skews political. But you have to trade off the data that's in front of you, and tomorrow we're going to get PPI and we're going to get consumer sentiment.
Yeah, soft will have two meanings. The qualitative part of it and the fact that it probably won't look so hot in terms of how the consumer is feeling.
Right.
All right, we'll leave it there. Kevin Hinks, thanks so much.
Yes, ma'am.
All right, now I'm joined by Brian Allen, Senior Vice President, Chief Investment Officer at CS McKee. Brian, thanks so much for joining the show.
Thank you.
So I was taking a look at your notes. It doesn't seem like you're going to shed any positive light on this market right now, seeing as you don't even think it's reached the lows yet.
No, I don't think so. Obviously, playing off of Kevin's comments recently, or
Kevin.
2 days ago, yes, there's some good data built up we can rely on if we get positive news, any developments that are positive on the trade front. I think the 90 days was a breath of relief, if anything, sparked a short covering rally yesterday, but it also promises at least 3 more months of headlines that may go one direction or another. Some indecision. The biggest concern is that by drawing out the process, corporations are going to hold at bay any capital expenditure plans that might be on the margin. International producers, shippers may be on pause about making commitments to building capacity in the U.S. 3 months is a necessary step. The market was very oversold, very ready for anything that was a bit of relief, but we're still sort of lost in limbo until we get some better information. Frankly, we thought, and maybe a little too optimistically, we'd have much more clear progress by the end of June, which I think we still will, but has everything been put to bed at that point?
Is everything put to bed? I don't know.
Okay, so I understand why that would mean volatility in the months ahead.
3 back homos.
90 days is just a pause, so I guess in one sense we might be kind of kicking the can down
God,
the
these
road.
things are so expensive.
But why haven't we reached the lows? Because I'm looking at an S&P 500 that's still down about 10% year
So
to date.
who cares?
So why does it have to go lower, and what do you need to see to
Let me tell you something,
show that
honey.
maybe a bottom
Who's doing this?
Well,
Caroline.
from historic comparisons.
Let me show you something about the S&P here. Shh. You say it's down to what? We're only into the 4th month. I hate it when they do this. The S&P is at 525. We're at 348. Okay? We might be down a little bit, but we're up almost 80%. This thing's still overbought, you dingbat. But the only thing okay at is because, whoa, did I call her a dingbat?
We have to be cognizant of the fact we don't want to do too much damage to the economy, and for better or for worse.
Oh, these people are nuts.
It both supports the idea for bringing more productive capacity to the U.S. I think, in a selective sense, certain industries that are important, where there's really value add and may have some security concerns. Some of the more basic productions, we can't give up the idea that international is probably the best price-adjusted source for some of that. But going forward, we don't want to damage consumer psyche and the market so much so that we push ourselves into a deeper recession. I say, unfortunately, the top 10% of earners now, 50% of consumer spending, and whereas inflation wasn't
I just can't listen to their forecasts.
2022, 23, the stock market takes a hit and money market rates drop. You'll see that
stocks just don't continuously rise. It's like they've never been in a recession before, and they probably haven't. He might have been in one. But they used to come around every 4 years, like it was just butter on bread. I mean, just something that's just natural. But they pumped so much liquidity in this market, and we're so far in debt because of it. We didn't, and it was all wasted. It all went to most of it went to the politicians. I got to keep this kind of attitude because I've been there before. We have a 10% pullback in the market, and they're just going nuts. We had a 30% under Biden. We had a 50% under Obama. And they weren't tripping out at all, man. They were flabbergasted. The market was cheap, is what they said. They have just weird, they're just... She upset me today. I thought you would never do that. Now let's see what these lame brains are talking about. I probably won't last a minute on here.
Risks within this market. And if we in fact do have one, which remains clearly uncertain, the market's going to try and get ahead of that, as it always does for everything. And if we do, and it looks like we are...
You said we were going to have 6 rate cuts, and we only had 3, and it didn't happen until the end of the year.
Is already changing, so you could anticipate a recession.
Oh,
you don't
God.
change your behavior when it's finally confirmed. You change your behavior ahead of the...
Now, see, these people, they have the same lines.
I agree with you. But I've heard so many people today say and acknowledge it's a bear market. I didn't hear that in the last several days. The last several days, people were kind of wondering, is this a bear market or not? So, Josh Brown on halftime.
Well, here's Brownstein.
Josh Brown in Miami a month ago said it was a bear market. I'm just saying, there are a lot of stocks, many, hundreds of stocks within the S&P 500 that have been down more than 20%. Okay, significantly more than that. So while at the...
And they were overbought hundreds of percentage points in 3 years, in 1 year. Just because a stock, just because a stock is down, look at the previous run it just had. I don't think like these people do.
I think consumer behavior is changing. We know corporate behavior is changing. We heard that from Ed Bastian at Delta the other day. And now you're going to hear that. It's going to be a parade of conversation about how behavior is going to change. And we're going to hear that.
My behavior is about to kick your ass.
How do you guys think about, I'll hear from both of you, Cammie first. the elevated recession risk that's just going to play out day by day as we see how the developments with China go. And how you...
Okay. He says the market tries to play ahead 6 months. So shouldn't they be ahead right now? Are they... Don't they see what's going to happen? They can't read the future as far as I could read the stars.
Big down days, not to chase these bear market rallies that we saw like yesterday, having the
Not
courage
to chase
step
it?
in when it
Honey, I made a lot of money yesterday. You probably sat there and watched it.
those are all signs that you can have a tactical rebound, but then being very disciplined when you have the bear market rallies not to chase.
I asked this at halftime too, and I hear it from people on the floor that I go around and talk to. It's kind of hard to get all short now and get all negative now, because you are literally a statement from the president of just talk to President Xi. We had a good, productive call. We're going to continue to talk. They want to make a deal.
Yeah, I mean,
he says that. What does this do?
Yesterday was a great example of that. You also saw that on Monday when there was that false tweet that came out that said there was a 90-day reprieve. Market shot up on that also. I think this is a good reminder. You don't want to get out of the markets here. I know this can be a very nerve-wracking thing. We're getting a lot of calls from clients of what should they do. And Cameron, you bring up a really good point. You tend to get these really big up days. Even if this is a bear market, you don't want to be out when those happen. And some of your biggest days in the market typically happen within a month of your down days. And this is a time as an investor, and especially as a long-term investor, that you want to look at your investment strategy and see, okay, where am I off balance? Where can I take profits? Where can I reallocate back into the markets? Because it's a question of how long this is going to take to recover, not if it's...
Honey, you see the 200 SMA and EMA on the weekly? Can I show you something? As long as you won't get mad. History has a way of repeating itself. Oh. Do you see what I'm saying? Oh. Let's change this to 5 years. And let me show you what a pullback really is about. Let's go 10 years. Let's go. 200 SMA, 200 SMA, 200 SMA, 200 SMA, 200 SMA. 10 years. Why are you all worried? We had a bigger correction here than we have here, and this is short-lived. This went all year long. We had a big correction right here. I didn't hear you whining back then. So we bounced off the 200 right now. I'm feeling worried real good where we are right now. I don't even think they've seen it. I think she's too young. She's not ever seen a bottom before. And this guy's a dork. He's the only smart one on the table. Maybe her. Okay, I'm done. Yabba dabba do. See, look at these candles right here. They're all telling you something. Well, wind outside. I could be wrong, but I'm not wrong. I can see, Randy, I can see. I can see real good now.
They're going there for an experience, and we intend to give them.
I gotta see what Amazon's earnings are.
We have a great bar scene, a great food and beverage scene. Sometimes they may not even bowl. They might just eat and drink. They might go to the arcade. They might come because we have a DJ playing that night, which we do it often at a number of our locations on the weekends. So it's just the next evolution of the experience, where bowling is not the sole activity. It's at the heart of it, but it's an elevated entertainment experience that includes bowling, but so much more. And you mentioned water parks, and you know, again, we are Lucky Strike Entertainment diversifying.
Looks like they come out on the 29th.
Have a family of verticals in the location-based entertainment space. I think we do them quite well, so we've expanded into water parks. We now have a number of water parks. We also have a number of FECs, family entertainment centers, one of which is called Boomers, and we have 7 Boomers locations across the country featuring mini golf, go-karts, arcades, and so again, the evolution of Lucky Strike Entertainment is all things location-based entertainment.
Okay, so all of those things certainly fall in a discretionary category of the budget. So I'm curious about what you're seeing in terms of the strength of the consumer. Are you seeing any signs of a pullback? Because so often we talk about a consumer that's under pressure from higher prices and that is starting to get more choiceful or choosier, if you will.
They are very choosy right now, and
okay, we got 3 more crows
out there. There's a lot of other brands and concepts that launch every day. What we're seeing is a flight to value, and we want to improve the value proposition of the experience. So you're going to see the consumer expect more when they come into our venues. They expect better quality food, better quality arcades, just an overall better experience. We've improved our hospitality, we've improved our food and beverage program, our arcades are superior. The entire guest experience is intended to offer better value to the consumer. And there's a flight right now to value. We think we deliver a better experience than anybody else.
What about in terms of corporate events? Consumers are fleeing to value. What are companies doing? Are they still hosting as many events as they once were? Or are you seeing businesses pull back that line item in the budget?
I think they're being choosy as well, and maybe they're trimming their budgets and being a little bit more conservative in some cases. Again, we want to offer a better value proposition, so we've recently introduced all new event menus. We're doing a lot more walkthroughs for our event clients. We're doing a lot more food and beverage tastings, and I think when they come into our spaces, they see these renovations, they see the rebrands, they see the refined menus. It's converting to a lot more bookings. It just means that we have to work that much harder for those bookings than we ever have.
I'm curious, we talk a lot more about recession over the past few weeks based on tariff impacts, based on where, you know, economists or CEOs think the economy is going.
I don't know.
Do you think
right
that
there,
we're heading toward a recession right
$3
now?
to $4 on that
Lucky Strike?
5350s.
Look, I'll be honest, I'm in the entertainment space. I'm not an economist. I don't know if it's going to be a recession, if it's transitory or not. What I can say is this wasn't a surprise to us. We have a very talented team in our procurement department. They've been preparing for this. They've been stockpiling. They've been looking for alternative sources and different vendors. So
far it's been holding the 200 EMA.
We're operating and monitoring this very closely.
These are scalps, whatever you do.
As far as our business goes,
Fast
okay,
ones.
We've prepared for this, but what the future holds is really unforeseen to me.
Do you think the consumer is acting in a way that seems like a recession is coming?
Look, again,
there's a flight to value. So discretionary spend.
Flight to value.
There's probably a big focus on it. The consumer wants to know
What's
that
he
they're
saying?
going to get a good value for their money. Now, that doesn't mean that we have to offer a cheaper product at a lower price. We just have to give them a value. So when they spend their money, they walk away saying, wow, that was an incredible experience. The environment, the immersive environment that Lucky Strike offered, the food and beverage was a great quality.
The hospitality by the staff was phenomenal. That's what we want to do. We want to make sure that they walk away and they felt like they got their money's worth. And that's really our focus right now.
And how are you making sure that doesn't impact your bottom line then?
Elevated guest experience comes from better training of our staff. We're also introducing a lot of technology.
So, Carolyn, we're now piloting
The
tablets.
tape's about a
in our
50-50.
centers, right? So that server,
They're
can
buying
take those
into it.
orders and send them into our kitchen faster, get the food to the lanes faster, avoid any sort of mistakes when taking our orders. We've added string pin machines to our bowling center, so there's less downtime versus free fall machines. So technology can really improve the guest experience as well.
All right. Well, it makes me want to go to Lucky Strike. Not necessarily to bowl, but I did like the food last time I was there. Lev Exter, President, Lucky Strike Entertainment. Thanks so much.
Thank you. Take care.
Coming up, Options Corner, Kevin Green will join us for the levels he's watching into the close. More Market on Close coming up next.
Oh, that's the 10th. Wow, they're expensive. Oh, that's the SPX. Okay, I'm doing something wrong here. I think we might hit the 200. Yeah, we can hit the 200. I'm going to bring them up. Look at the 5300s. You ready, Randy? You might want to sit this one out and let the big boys play it. $5 at 5,300. $5.20.
Trading at Schwab is now powered by Ameritrade, giving traders even more ways to sharpen their skills with tailored education. Get an expanding library filled with new online videos, webcasts, articles, courses, and more, all crafted just for traders. And with guided learning paths, stacked with content curated to fit your unique goals, you can spend less time searching and more time
810.
Trade brilliantly with Schwab.
Exit idea.
Welcome back to Market on Close. It's time for Options Corner. Kevin Green is here to talk about the levels he's watching.
You hit the 9.
Close. So Kevin, good news is S&P 500 is off earlier lows. Bad news is it's off about 4%. Heading into the close. I'm not sure if you heard one of my first guests, but he's actually looking at the 4,600 level. I know that was to the downside that you were watching, or potentially 4,300 level to know that, you know, the washout has occurred and to feel more comfortable getting in. What levels are on your radar right now, and how realistic could that be?
Yeah, actually, Caroline, what's actually very interesting about that is the 4650 puts pretty much going out till June have been printing, and there's been a lot of activity on them for the last month, almost month and a half right now. So somebody has been loading up on those. Now, obviously, they're getting more and more expensive, but that actually has been crossing the wire, and I actually did just see that on the scan just 5 minutes ago. So that is not outside of the realm of possibility. There is some positioning or some hedging that is taking place around that level here, but we still have a long way to go. For the close today, what are we really kind of looking at as far as the setup? Obviously, we started seeing a lot of pressure to the downside, got very close from actually having a halt in the market. We were only about 45, maybe 50 points away from actually having a halt in the market here, but we did see some buyers stepping in at around that 51.15-ish area. We have made higher lows ever since then. Now, we are kind of breaking this channel. It does look like we're trying to move back to the downside here, but it has been a battle between the bulls and the bears. I mean, this was actually a pretty decent recovery coming down from 6% and probably 40 minutes ago, we were only down about 2.6% to go in the session here today. So to the upside, I'm looking at 5,300 as your area of resistance. That obviously has been an area that not only did we fail earlier this morning, but also just pretty much midday, about an hour ago or so. And if we do see some downside move, you want to be able to defend 5,200 here. Anything below that, it gets a little bit concerning. And if you get below actually that 5,160 level, you're going to make basically a lower low compared to the stair step type of advance that we've seen on an intraday basis.
Okay, so we'll keep our eyes on 5,200, currently around 5,267 right now.
So exit idea was up here at the 9, and I let it just ride a little bit more above it, and I got out. This tweezer bottom for the idea, and I had to wait. I got lucky to get 520. Here we had 3 black crows, and we bounced up. We had 3 more here, and a long leg doji, and then that candle's very bearish because the wick's above it. Now this one here is an inverted hammer, which means it's kind of iffy. Oh boy. I'd say I'm about done. A lot of recession talk today. It's like they're scaring you not to get into the market when I know we're at a good spot. I mean, we can go below the 200, but it won't be long.
Now, we'll put the current market swings into perspective with Kevin Davitt from the NASDAQ. Market on close. We'll be right back.
Forgive me, Caroline. Dow Jones down 1,100 points.
Believe me, when it comes to investing, you'll love Carl's way. Take a left here, please. But there's a...
Okay, now we got a double bottom.
Best way.
Is it?
Yes,
At
it
Schwab,
is.
how I choose to invest is up to me.
Exactly.
Carl's way is the best way.
Investments for me too.
Let's move on, shall we?
No can do.
I'll get out here.
Where are you going?
Schwab. Schwab.
I'm getting ready to take this again. $2.85, $2.90.
Binge watch the market with the Schwab Network. Tune in 24 hours a day, 7 days a week on schwabnetwork.com and on
Gets a
all
little
of your favorite streaming
more
services.
riskier here.
Schwab Network, available anytime, anywhere, on any device for free. Binge watch the market with the Schwab Network.
Trading at Schwab is now powered by Ameritrade, giving you even more specialized trading support. Connect with the Schwab Trade Desk, our team of passionate traders ready to tackle your trading questions, no matter how complex. Plus, get 24/7 live help and access support by phone, email, and in-platform chat. Trade brilliantly with Schwab.
Accelerate your market knowledge
and shift your perspective into full gear. Real-time example trades, a full hour of trading insights.
I'm Tom White.
I'm Kevin Hicks. Catch me on Fast Market, weekdays at noon on the Schwab Network.
Fast Market, ready for you, ready to go at 12 p.m. Eastern on the Schwab Network.
Opportunities don't stop when the market day ends. So neither do
Well, it's chopping around.
Schwab gives you round-the-clock access to over 800 of the most popular stocks and ETFs, plus a wide variety of futures markets.
Uh-oh.
All with 24-hour support from trading specialists who understand the ins and outs of
Yeah,
24
come
hour
on.
trading. No matter the hour, you can trade brilliantly.
I don't know.
With Schwab.
I'm Nicole Petalides, host of Trading 360 and The Watch List, live on the floor of the New York Stock Exchange, where we bring you breaking news, experts, CEOs, influencers, and analysts. It's all available on Schwab Network.
Welcome back to Market on Close. I'm Caroline Woods. It's time to put the current market volatility into perspective. Joining us now is Kevin Davitt, head of index options content at NASDAQ. Kevin, thanks for joining us.
Thanks for having me.
So it's great to have you. Yesterday was obviously an unusual day. We talked about it being historic. Obviously, it seems like a long time ago now based on the NASDAQ's performance today. But just want to get your thought on the action that we saw, because it was, what, the second best day in NASDAQ's history?
So you're right that today, yesterday, and the past few weeks have certainly been unusual, but not unprecedented. And that's kind of the bigger picture point I would like to make. And you
Might have
asked
to get out
about
of these.
context. So I went back through historical data for
Yeah.
the largest close over close changes in the NASDAQ 100 index. And yesterday actually gets the bronze medal. I believe it was the second largest move for the composite. So it's on the podium, but the problem is it's keeping some kind of questionable company. So third largest single day move in history that goes back to 85. And I don't want to be a wet blanket, but when you look
A wet
at the
blanket.
list of other really significant jumps, a couple of things stand out to me. This visual that you're looking at is littered with dates from
This ain't looking too good.
2001 and 2008. And I'm old enough to have been working in the markets for all of those moves. For the younger demographic in the audience, I would point out that the early 2000s and 2008 were not exactly a halcyon era for equity performance. I'd call attention in that situation to the third column, which shows how far the NASDAQ 100 was from all-time highs following those giant rallies. So I think in some ways the past month has some echoes of the early pandemic era, in the sense that there's so much uncertainty about the kind of future path for the global economy when you contextualize the trade war potential currently and the shelter in place from 5 years ago. Perhaps
Jimmy
yesterday will be an inflection
doesn't want to sell yet,
back, similar to the one that we saw in
but he might have to.
2020. But I'd be a little bit skeptical of the V-shaped rebound this year. In general, I think swings of this magnitude are not typically associated with favorable backdrops. And the list that you were showing could be kind of considered relief rallies during otherwise really difficult bear markets, because markets don't move somewhere between 9 and 19% unless there's a great deal of uncertainty. And maybe in that vein, it's not surprising that we're coming off record-breaking weeks for option volumes.
Yeah, and based on, we don't have the chart up anymore, or the graph up anymore, but based
I
on
might
those
take a
dates,
loss on
they
this one.
happened before some pretty big downturns in the market, right? If I remember correctly, I'm looking March 13th, 2020. Was that the bottom? I thought the bottom was a little bit later. Even April 18, 2021, obviously we know what happened later in 2021, and even 2008.
You are very much on the nail there. They were in the midst of really volatile backdrops. In the case of March 5 years ago, the eventual bottom was days later, but in the other situations, they were much more significant downside.
Yeah, I think I got screwed on this one.
Okay, so what do we draw from this then? Does this actually imply further downside is in store? What, that's the context, but what's the takeaway then, I guess?
From my perspective, I think what we construe is that volatility will remain elevated in the near term. I doubt that changes. Sometimes people use fancy words like heteroscedastic. That just means that volatility tends to cluster whether it is relatively high or relatively low. So I'm not in the business of making forecasts in terms of price or what have you, but I would imagine that day-to-day, week-to-week swings of larger than typical continue.
Okay. What about on the index options side of the business? What are you seeing there?
So let's maybe first talk about the whole option market. So Schwab clients and people that we deal with across the landscape. And last Friday, where broad markets were down about 6%, more than 100 million options traded. A lot of them coming from Schwab.
I think
clients,
I'm
that was
stuck.
an industry record. Yesterday, we were right around 85
I'll give it 6
million.
more minutes.
So for a little bit of context there,
Better call this a total loss.
Q1 was around 53 million, and that too was record breaking. So in high vol markets, volumes, activity tends to gravitate toward the most liquid products, and those certainly include index options. So just by way of example, there are 6.5 million QQQ options traded on Friday alone. I think, or I would argue, that NASDAQ continues to be a market leader when you look at parent exchanges for share of overall volume. Our systems are processing
400 down right now.
Messages, and I think that's a testament to the team and technology that sits at the backbone. And the same thing goes for Schwab platform. They've been seamless throughout. Now, on the index options side, bigger picture, as we continue to build out this product, the NASDAQ 100 index options, we're super excited to be working with some of the biggest insurance firms in the world and our market making community to help grow out a liquid market for longer dated maturities that allow product to be created based on what we see in client demand. So specifically the annuity market and the registered index linked annuities, RILAs, that market has been growing by leaps and bounds. And end users, what ultimately they want is exposure to the price performance of the NASDAQ 100, often with some buffers. And those products make it possible with index options working behind the wrapper. So big picture, that's something we're...
This guy's hard to understand.
The index option volume continues to be strong. And against this backdrop, I would expect that to continue.
Okay. So as we try to wrap our head around risk in this market, obviously you think, volatility is here to stay for at least a little while, but do you see risks skewed significantly one way or the other?
I sure wish
There's
I could
95.
give, a good answer there. It's a great question and one where a response could age really poorly. My opinion is kind of generally informed by watching derivative markets and price action. Front and center, something that Kevin that preceded me was talking about is the technical perspective. So for those that sort of follow that sort of look at the market, we're about to see a death cross, which is an unfriendly term in both the S&Ps and the NASDAQ 100, where the 50-day moving average falls below the 200-day.
On what?
Trending lower.
What time frame?
So I don't want to put too much weight on that technical, but it is one that concerns me. In many ways, sort of bigger picture, this market reminds me of 2022, where we see multiple compression, really centered.
I'm going to get out of this trade at 90 cents.
Meaningful uncertainty around interest rates. Granted, they're likely
I got 3 more minutes
this
but
time. As I mentioned earlier, I would anticipate that both implied and realized volatility remains elevated in the near term. I think that could continue indefinitely. It's important to note and for the audience to understand, and we alluded to it earlier, but volatility is a non-directional measure. So a day like yesterday, upside volatility is volatility too. And if you look at 10-day or 20-day realized volatility levels in the NASDAQ 100, they're at the highest level since March of 2020. You look out a little bit further, and it's weird to think that earnings are kind of feel like an afterthought, but banks are going to start reporting Q1 earnings tomorrow. Next week, and then we'll get into the meat of earnings season later on this month in early May. And I'd like to note that the NASDAQ 100 does not include financials, so the bank numbers won't directly influence the tone in NDX. Just wrapping up, my expectation would be that we continue to see whippy, headline-driven markets, which I think can be off-putting for investors. And it can be very attractive to those that are kind of adept at using options generally and index options specifically. That's my expectation, and I would still be concerned on the downside.
Okay, so banks not in the NASDAQ, but some of the members of the NASDAQ that do have an influence are down sharply today. Tesla off more than 9%, Meta and Nvidia off more than 7%, Amazon off 6%, so definitely a tough day in the tech space. Kevin Davitt, head of index options content at NASDAQ, thanks for helping us make sense of all of this. Really appreciate the context.
It makes sense.
Thanks for the opportunity.
All right, coming up, let's close out this market session and get the big picture from the team at Charles Schwab. We'll be right back. Stay with us.
Caroline, I'm sorry I got mad at you today. Forgive me.
Schwab Bank Investor Checking, the checking account built for investors, named highest in client satisfaction by J.D. Power for 6 years in a row. With Investor Checking, you get the award-winning features of our checking account, plus cash management solutions, all designed for investors like you, with unlimited ATM fee rebates for cash withdrawals worldwide, no overdraft fees, and enhanced security features to keep your money safe. Also, because your investor checking account is linked to your Schwab One brokerage account, you can manage your checking and investing in one convenient location. Moving funds between your accounts is easy. Cash moved to your brokerage account is available in seconds. That means you can stop waiting and start investing in stocks, bonds, money market funds, and more. Get more with Schwab Bank Investor Checking, the checking account built for investors.
Morning Movers brings traders the biggest headlines to start the day, from volatile overnight swings to the earliest analyst calls. Get your watch list ready. 8 a.m. Eastern, Morning Movers, only on Schwab Network.
Opportunities don't stop when the market day ends. So neither do we. Schwab gives you round-the-clock access to over 800 of the most popular stocks and ETFs, plus a wide variety of futures markets. All with 24-hour support from trading specialists who understand the ins and outs of 24-hour trading. No matter the hour, you can trade brilliantly with Schwab.
No politics, no noise. From bell to bell and beyond. Available anytime, anywhere, on any device for free. Schwab Network.
Welcome back to Market on Close. I'm Caroline Woods. Just a few minutes left in the trading day, about 9 to be precise. It's time for the big picture. Let's welcome in Cooper Howard, Director and Fixed Income Strategist at Schwab Center for Financial Research. Cooper, thanks so much for joining us.
Thank you for having me, Caroline.
Randy.
All right, so Cooper, we've seen some monster moves in bonds. It's a technical term. Can you help us make sense of the action we've been seeing?
Yeah, we have seen some monster moves in bonds, and obviously a lot is related to the trade volatility and what's going on.
Watch it run all the way back up here to $2.50 or $3.
That was the implementation of tariffs, and since then we've seen quite a bit of volatility. In terms of where yields are right now, they've continued to move up.
Yeah.
We've seen that more on the longer term of the yield curve. So to me, there might be some deleveraging trade going on in terms of kind of trying to liquidate some positions to sell off some things. I think it's a difficult market, Caroline, to really navigate through and to make a analysis of exactly what is happening, because there is a lot of narratives happening. It is very much headline driven, but I think what's important, especially from an investor standpoint, is to take a step back, and what we try to do is help calm the nerves and kind of help them understand, control what you can control. So in terms of what to do in this market, Caroline, really what our team has been suggesting is focus a little bit more on a cautious position. Focus on higher rated issuers, focus on a benchmark duration. We think given all of the volatility, given the headline risks that are out there right now, makes sense to take a little bit cautious of approach.
When you say, higher benchmark duration, how high are you talking about? What sort of duration are you talking about?
Yeah, and I want to clarify, not a higher benchmark duration. We think stick with a benchmark duration. So when we're looking at a higher rated, yes. So higher rated benchmark duration, two kind of separate things, if you will. But when we're looking at a benchmark duration, because I think that this is a very important point, we're looking at the Bloomberg US Aggregate Bond Index. That has a duration of about 6 years. So we think that's probably a pretty good starting point. That doesn't mean just focus all on 6-year bonds. Spread out across the
I'm not going to look at them.
Bonds. If we potentially
they look disgusting.
Move up even more from where they are right now, we'd get a little bit more attractive in terms of.
I could have got 160 out of them for sure.
Duration.
Another $120.
That's a benchmark duration. The other side of things is where to focus on credit quality. We think it makes sense to
170. These things are all over.
It's going to be issuers.
It's been hard to get out of them.
Corporate bonds, investment grade municipal bonds. Right now, if we are facing a slowdown in the economy, and there's no doubt that the odds of a recession
25 cents.
A lot of strategists have increased their probabilities recently of a recession.
145 to 20 cents. In a split second.
Balances, less volatile revenue sources. They should be able to weather through that storm a little bit better than those that
even hit 10.
Yeah, I'm curious about what you think in terms of the recession forecast, Cooper, because we did see Goldman Sachs rescind that recession forecast. I think they were at like 65%. They rescinded it back to 45% because of the tariff developments. We'll hear from Jamie Dimon, of course, tomorrow. He's always has, pretty insightful economic commentary. I'm pretty sure JP Morgan was at something like 60%, said it's probably likely because of tariffs, but then there's been some developments. Obviously, we did get inflation data today that's, that was better than expected, and some Fed commentary that seems like the Fed's not going to really step in at all, at least in the nearer term. So do you think that we should be thinking about a recession right now?
Our team doesn't come out with a formal probability of a recession or kind of here are the odds of a recession or a formal call on a recession. But I do think
recession,
that the odds of an economic slowdown definitely have increased.
Would you shut up, Caroline, about this recession? How much do they pay you? I'm just $250,000. Had to pay you that much.
Really, what's going to be the big driver is what happens with the tariff policy. how big are the tariffs and how long ultimately are they implemented? You asked me this
I'm gonna have to
morning,
get tired of
it was
listening to these.
125% on China.
They keep it
Asking
up.
this afternoon, and we're seeing 145% on China. So you mentioned earlier in your opening statements that we only have 9 minutes left to go in the market. 9 minutes can be a lot in this market.
Yeah, it is.
So we're seeing things shift every minute, and a lot is being driven by headline risk. I think that gets to the point about, excuse me there.
No, go ahead. That gets to the point about.
I was going to say that gets to the point about the Fed and ultimately what are they going to do? And what we're anticipating is they're going to take a little bit more of a cautious approach. We heard from Chairman Powell last week that they want to be patient. Other Fed officials have really reiterated that point. It seems like they're preaching from the same playbook, is that they want to look, see what happens with the economy, what happens with the employment numbers, inflation numbers, what happens ultimately with the tariffs, and then begin to react from there. They're looking at the same data that we're looking at. They're probably piecing it quite a bit though right now and trying to anticipate what's coming down the pipeline, but this is a market that's really being driven by headline risk.
Okay. All right. In terms of what this market, I was just trying to take a look at the CME Fed Watch tool, but I can't look through the rest of the year in that quick of time. Is the market coming around to maybe not seeing 5 rate cuts this year?
You know, right now, again, that's been bouncing around quite a bit because to your previous speaker's points, volatility has been the theme, and that's volatility in treasuries, volatility in munis, volatility in terms of expectations for what the Fed is going to do. That's been about 4 rate cuts is where the CME watch tool is coming in right now. Our expectation is unless there's a significant sell-off unless there's a significant deterioration in the economy, probably think 4 right now is pretty aggressive.
Okay. All right. Yeah, I was just taking a look. So 4, we'll see. But we've seen the expectation shift so much over the past couple of years, so we know that can change as well. Cooper Howard, Director of Fixed Income Strategist, Schwab Center for Financial Research. Always appreciate your insights. Thanks so much. Coming up, we'll welcome in our closers panel to recap the trading day. We'll be right back.
Trading at Schwab is now powered by Ameritrade, giving traders even more ways to sharpen their skills with tailored education. Get an expanding library filled with new online videos, webcasts, articles, courses, and more. All crafted just for traders. And with guided learning paths, stacked with content curated to fit your unique goals. You can spend less time searching and more time learning. Trade brilliantly with Schwab.
Accelerate your market knowledge
and shift your perspective into full gear. Real-time example trades, a full hour of trading insights.
I'm Tom White.
I'm Kevin Hicks. Catch me on Fast Market, weekdays at noon on the Schwab Network.
Fast Market, ready for you, ready to go at 12 p.m. Eastern on the Schwab Network.
Alrighty. Well, what a day. What a day, what a day, what a day. I had 1 loss today, 2 losses. That last one I kind of played with and should have got out of it a lot sooner, but I wanted to wait it out and see if we would get a little bounce, and nah, it just kept going down, 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 down. Then when it did kind of go up, I said 90 cents. I think I could have got 160, but that still would have been a $200 loss, 180. So, green again. I've only had 2 red days this year. Completely red. And we're in month 4. And I got new glasses I can see. I mean, it's weird looking at these monitors. The ones I had to kind of squint a little bit. So I'm excited to have them. Probably it's hard to do dishes with my other ones that didn't have that right side. The glasses would always fall off. So I'm going to get out of here do a little exercising. Hope everybody had a good day today. Wow, everybody leave all of a sudden? Everybody left all at once? I'm the only one listening to myself in the room? That's strange. Can anybody hear me? I don't think I've ever seen that before. YouTubers? Hope Discord died? Well, that was strange. Everybody was gone. Well, we'll get at it again tomorrow.